Yes, morning everyone. So in our last, that is previous session, so actually that I came back to Chennai, and now I'm taking the classes in from Chennai only. So I came back from Bangalore. So the 3 days was amazing 3 days I had in Bangalore, and I could not complete the portion in 3 days because lot of portion is there due to that reason. And today I am starting with customs and FTP. Okay, so customs and FTP is the area which I did not touch at all. So therefore we are starting with the customs and FTP. So you can take segment number 21, page number 138. Segment number 21, page number 138. Voice not audible? So can you please confirm whether my voice is audible or not? Yes. So segment 21, taxable event under customs. So that yes. So this is the maximum voice here. I'm using the normal mic only. So I will increase my voice. Okay. Sure. You try to increase the volume now. You try to increase the volume at your end also. Please try to do that. And so today we are starting with customs and FTP. So please take page number 138, segment number 21, taxable event under customs. So quickly we will complete the customs and FTP, and then we will proceed to the balance leftover topics that we have in GST. So a few topics are there. So first, section 12 of the Customs Act 1962 you need to understand. So what is a Customs Act? Customs Act is 1962. Customs Act year is 1962, and the basis of charge of the levy section is section 12 of Customs Act 1962. There are four conditions that should be satisfied for the purpose of levy of customs duty. What are the four conditions? Number one, there must be goods. Of course, customs duty is on goods only, not on services. So there must be goods, and that goods must be dutiable goods. So what are the meaning? What is the meaning of dutiable goods? Dutiable goods means those goods which are specified under the Customs Tariff Act 1975. So there are two acts that you need to remember when you are into customs, that is Customs Act and Customs Tariff Act. Customs Tariff Act. Customs Tariff Act 1975. Okay, so Customs Act 1962 and Customs Tariff Act 1975, these are the two acts that we have. So Customs Tariff Act contains the rates related to import and export of customs duty, import and export whenever it happens, what is the rate at which we need to pay customs duty is given in Customs Tariff Act. But Customs Act contains the provisions related to customs. Okay, so what are the conditions here? First, there must be goods, and that goods must be dutiable goods, and that dutiable goods must be imported or exported, and such import or export must be from India. So these are the four basic conditions. If all these conditions are satisfied, then there will be levy of customs duty. And in this regard, we need to understand the meaning of various terms. So first, goods. See, in old syllabus, like they used to ask the definitions, but in the new syllabus they were not asking the definitions, but maybe they could ask. That's the reason why we are learning the definitions. Just if you try to understand what is the meaning of what, that is sufficient. So first, goods definition, if you see, goods means vessel, aircraft or vessel, vehicle. So vessels, aircraft and vehicles will also come under goods. Then stores, then baggage, currency and negotiable instruments, and any other kind of movable property will be coming under goods. Okay, so then stores. So stores means what? So because stores is also included in the meaning of goods that you can see. So stores means what? Stores means like whatever goods that are used in the conveyance, like during the travel, so that will be known as stores. So stores means goods for use in a vessel or aircraft, and includes fuel, spare parts and other articles. So all these will be coming. So therefore, so goods, its definition is simple. So any other kind of movable property will be coming under goods. So all movable items will come. But worth noting point here is the currency and negotiable instrument. So if you see the meaning of money, so money includes even negotiable instruments also. So money is excluded from the meaning of goods and services under GST, but money is included in the meaning of goods under customs, which means that on import of any currency, we need to pay customs duty, but on import of currency, we are not required to pay any IGST. So because along with the customs duty, we will be required to pay IGST also now. So that IGST we are not required to pay. Okay. So that is with respect to this. And then stores are for consumption during the travel. So during the journey from outside India to India, or India to outside India, or within India, so whatever are the goods that are for consumption, that could be food and beverages or spare parts, fuel, etc. So that will be coming under stores. Then next definition what we have is import. So what's the meaning of import? In GST itself we studied. Import means what? Bringing goods from outside India to India is known as import, and export means taking goods from India to outside India. So the meaning of import and export is same even under GST as well as under customs. Then India, what is the meaning of India? So here India is up to 12 nautical miles from baseline, but under GST India is up to 200 nautical miles from baseline. So there is a difference in the definition. So in case of meaning of India under customs, it is only 12 nautical miles, whereas the meaning of India under GST is up to 200 nautical miles from the baseline. So therefore import is said to take place whenever the goods cross the territorial waters and enters into India, and the goods are said to be exported when the goods crosses the territorial waters of India. So that is the purpose of this territorial waters. So all the provisions of the Customs Act will be applicable so up to the territorial waters, and thereafter beyond territorial waters up to 200 nautical miles is known as Indian customs waters. Because if you see the customs waters, Indian customs waters definition is there in the next page, which says that up to 200 nautical miles. So therefore the meaning of India is up to 12 nautical miles only, but the meaning of Indian customs waters is up to 200 nautical miles. So what does it mean? It means that few sections, so empowering the proper officer under customs to exercise their powers, so that will be applicable beyond 12 nautical miles and up to 200 nautical miles. Then beyond 200 nautical miles is known as what? That is beyond 12 nautical miles and up to 200 nautical miles, customs officer will have certain powers. So those sections are only applicable. Whereas beyond 200 nautical miles, it is known as high seas, and only provisions relating to offence and penalties are applicable. So that is beyond 200 nautical miles. Okay, that is the customs officer can arrest a person who is dealing in smuggling or etc. beyond 200 nautical miles. So that is with respect to this meaning of India. Then customs area, in every customs, that is in every port or airport is not a customs port or airport. So there will be some notified ports or airports where import and export is allowed, and those ports or airports where the import and export is allowed is only known as a customs port or customs airport. So in that customs port or airport also, not the entire area will be under the control of customs department. So that will be under the control of Airport Authority of India or Port Trust of India. But in that, so there will be some notified space that will be under the control of the customs, that is known as customs area. Then, so that is the place where so the import of goods or export of goods will be ordinarily kept. Okay, so that place will also be coming under customs area. So dutiable goods means, already I told you, dutiable goods means those goods which are covered under Customs Tariff Act are known as dutiable goods. So here we need to understand one important definition point here is that, so in case of GST, taxable goods do not include exempted goods, but under customs, in GST, taxable do not include exempted, but under customs, dutiable includes even exempted goods also. So those goods which are coming under Customs Tariff Act are known as dutiable, and those goods so may be exempted or may be chargeable to duty, but it will come. So therefore, what is the simple point that you need to remember is that in GST, taxable goods do not include exempted goods, but under customs, dutiable goods includes exempted goods. So here if you see, dutiable goods means any goods which are chargeable to duty, that is on which there is charge. When there will be charge, if it is covered under the Customs Tariff Act 1975, there is charge, and on which duty has not been paid. So once the duty is paid, it will become what? Duty paid goods. So right now duty is not yet paid, so that's why it is known as dutiable goods. So once the duty is paid, it will automatically become duty paid goods. Okay, so that is the meaning of that. Then export goods means goods which are taken out of India to a place outside India. And who is the exporter? So exporter is the person who is the owner of the goods, or who is beneficial owner of the goods, or who is holding himself out to be exporter. For example, if I am manufacturing goods and I am exporting the goods, I am known as owner of the goods and exporter. And suppose if I am manufacturing the goods but I am not exporting, but you are exporting on behalf of me, so then I will be called as beneficial owner and you will be called as merchant exporter. You are holding yourself to be exporter, so you are also called as exporter, I am also called as exported. So therefore, who is called as the beneficial owner? That is, on behalf of me you are exporting, so I will be called as the beneficial owner. That is, on whose behalf the goods are being exported, on whose behalf the goods are being exported or imported is known as beneficial owner. If you see, the meaning of exporter and the meaning of importer are similar. In case of the meaning of exporter, if you see, owner or beneficial owner or any other person holding himself out to be an exporter, but the beneficial owner, that is importer, if you see, owner or beneficial owner or any person holding himself out to be an importer. So therefore ditto. So the meaning of exporter and the meaning of importer, if you see, that is literally ditto the same, and there is no difference in that at all. Okay, so whereas in case of imported goods, any goods brought into India from a place outside India. So this is also like similar definition only. And in both places they use the word beneficial owner. That beneficial owner is also same. That is, on whose behalf the goods are being imported or exported is known as the beneficial owner. Then goods also includes baggage. So what is the meaning of baggage? Baggage refers to passenger's luggage. So that can be either passenger's luggage or the crew luggage is known as baggage. Okay, and this baggage can be accompanied or unaccompanied. Accompanied means what? So the person who is coming to India or going from India will be taking the goods, that is the bag along with them, the luggage along with them, that is known as accompanied baggage. Unaccompanied baggage means either it will come before their arrival or after their arrival, that is known as unaccompanied baggage. Then coastal goods. Coastal goods means goods which are going from one place in India to another place in India but by waterways. So this word coastal waters we have already studied in GST while discussing the exemptions. So in that exemptions I told you coastal waters, that is within India, that is between two ports where the goods are being taken from one port in India to another port in India, say from Gujarat port, that is Surat port to Mumbai port, or Mumbai port to Chennai port, that will be coming under coastal goods. So these coastal goods are not treated as imported goods or exported goods. These coastal goods are just, it is traveling in the seaways, but it is not covered under import or export. Then next thing is known as foreign going vessel or aircraft. Foreign going vessel or aircraft attain some importance because whenever we are importing some goods for sale to foreign going vessel or aircraft, those goods should be deposited in a special warehouse. There is a concept of warehousing, so that is made applicable for your May 22 exam. So this May 22 exam warehousing under customs is applicable. So in that warehousing, so you will be studying, like there are three warehouses: public warehouse, private warehouse and special warehouse. Like the three warehouses are there. So whatever goods I am importing and I am selling to a foreign going vessel or aircraft, those goods should be deposited in a special warehouse. Like that one provision is there. So this foreign going vessel or aircraft is the vessel or aircraft which takes the goods or passengers from India to a place outside India is known as a foreign going vessel or aircraft. And one more point is also there, that in duty drawback, whenever you are selling goods, imported goods on and payment of custom duty is made, and thereafter you are selling to a foreign going vessel or aircraft, on import of that goods, whatever custom duty you paid, on that you will be getting duty drawback, because under duty drawback provisions it is given that sale to a foreign going vessel or aircraft is treated as exported. Due to that reason, whatever customs duty I pay on import of goods and which are sold to this foreign going vessel or aircraft, that will be treated as an export. So on import of that goods, whatever customs duty I paid, on that I will be getting refund. Suppose without payment of customs duty, is there any option? Yes, you can deposit in the warehouse without payment of customs duty and then sell to this foreign going vessel or aircraft. So what is foreign going vessel or aircraft? An aircraft or a vessel which is taking goods from India or passengers from India to a place outside India is known as a foreign going vessel or aircraft, basic definition. But there are few cases, so it will, like a foreign going vessel or aircraft also includes few things. What are they? That is, it includes any naval vessel of the foreign government taking part in any naval exercises. That is, that if there is any navy vessel of the foreign government which is coming to India, so that is also coming under foreign going vessel or aircraft, or any vessel carrying out the fishing operations outside the territorial waters will also be coming under foreign going vessel or aircraft. And any vessel or aircraft proceeding to a place outside India for any purpose. So means if it is carrying the goods or passengers, it will anyhow come. But if it is like jet flights or any flights or any vessels which are going for carrying out the drill operations, so then that will also be treated as foreign going vessel or aircraft. Okay, so these are the definitions. These are some important definitions you must be knowing. So therefore, what is that we have seen so far is the levy under customs section 12, import when there will be levy of customs duty, 4 basic conditions should be satisfied and few definitions we have seen. So now what are the options available to importer of the goods? So the goods, once it is landed into the port or airport, in case of land route, then it will be called as a land customs station. If it is import by airways, it is known as airport. If it is import by waterways, it is known as port. And if it is import by land route, it is known as land customs station. So once the goods are imported and it is kept in the port or airport or land customs station, once it is unloaded, thereafter the importer is having two options. Remember, two options are there. Concentrate. So option number one, the imported goods can be directly taken to his place, and for that he will be filing one bill of entry called as bill of entry for home consumption, and duty is also payable. So therefore option number one, clearance for home consumption upon filing bill of entry for home consumption and upon payment of customs duty. Option number two, the goods can be deposited in warehouse without payment of customs duty, and at a later point of time the goods can be cleared from the warehouse upon payment of customs duty. For depositing the goods into the warehouse, we will be filing a bill of entry called as inbound bill of entry or into-bound bill of entry, or even bill of entry for warehousing. These are the different names for the same bill of entry. So it will be called as inbound bill of entry or into-bound bill of entry or bill of entry for warehousing, because at the time when we are depositing the goods in the warehouse, we need to execute a bond. Due to that reason, it is known as inbound bill of entry, and we don't have to pay any customs duty. Whereas at the time of clearance from the warehouse, we need to execute one bill of entry for home consumption, that is ex-bond bill of entry, because we are clearing the goods from the warehouse. So the bond, whatever we have given, will be cancelled because we are now paying the duty. That's why it is known as ex-bond bill of entry for home consumption, and of course we need to pay the customs duty. So these are the two options available to an importer, so who is bringing the goods from outside India to India. And one important point here is that without filing bill of entry, the unloaded goods cannot be cleared from the warehouse or for home consumption directly from the port or airport, and goods can be cleared to warehouse without payment of duty, but thereafter for clearance from warehouse for home consumption we need to pay customs duty. So that is this point. And bill of entry can be filed before arrival or after arrival. So before arrival means that, so that is before the aircraft comes, or after arrival. But so here the point is that now there is a point that bill of entry has to be filed before the date of arrival only. Okay, so now there is a requirement that bill of entry, so this after arrival you can file, but there attracts a penalty, okay, late fee. See, you can file the bill of entry either before arrival or after arrival, so there is no restriction. So but if you file after arrival, so there will be a late fee that is attracted, okay, late fee that is attracted. And if you file the bill of entry before arrival, so there is no late fee, okay. So that is what you need to understand, because now the due date of filing bill of entry at present, that is also an amendment applicable for your exam. The bill of entry has to be filed at least, that is before the date of arrival. So which means that today is the arrival, before that it should be filed, and before that could be a holiday also, whatever the case may be, the bill of entry has to be filed before the date of arrival. So therefore due to that reason, so here I have given either before arrival or after arrival it can be filed, but before arrival if you are filing, it will speed up the process. At the same time there is no late fee, but after arrival when you are filing, so there will be a late fee that is payable, okay. So then prior bill of entry is also there. Prior bill of entry, which means that, so you will be filing the bill of entry before, that is within 30 days prior to the expected date of arrival, like that it is there. But now previously that customs officer permission was required, and now the customs officer permission is not required for filing prior bill of entry, okay. So prior bill of entry, previously the point is there, but this point is not yet updated in the book, in the sense like in the study material. So that's why I have just given this. And of course now at present there is no requirement of any permission from the customs officer for the prior bill of entry. So prior bill of entry can be always be filed, so you can erase that point. So then as the clearance from the warehouse or clearance from the port or airport is the taxable event. So here what happens in case of warehouse goods, so the taxable event gets attracted only when it is cleared from the warehouse. So which means that at the time of deposit of goods into the warehouse, if there is no customs duty, but at the time of clearance from the warehouse, if there is any customs duty leviable on the goods, should we pay the customs duty? Yes, we need to pay the customs duty. Same way, at the time of deposit of goods into the warehouse, there is customs duty, but at the time of clearance from the warehouse, the customs duty has been withdrawn, say exempted. Should we pay any customs duty? No. So because the date on which you are trying to clear the the goods for home consumption, that is only the taxable event. That's the reason why when we deposit the goods in the warehouse, we are not required to pay any customs duty. That is this. And then I'm talking about customs warehouse. Customs warehouse is not a warehouse which is owned by the customer but licensed by the customs. So at present, customs warehouses are being licensed by the customs department. It is not owned by the customs authorities. So there will be like physical control and record based control also is available. So therefore these are basically licensed by the customs department. So that is known as customs warehouse. Okay. And so what happens, suppose if I have a customs warehouse, I can import the goods and I can keep it in the customs warehouse without payment of customs duty. So only when I actually need, I will be clearing the goods from the warehouse, and at the time only I will pay customs duty. Is that possible? Yes, it is possible. So I need to get a license for that customs warehouse, and I can deposit my goods into that warehouse without payment of customs duty. At the time when it is actually used for the factory for manufacture, at the time if I pay customs duty, that is sufficient. And here one more point you need to remember, there is something called as 90 days period. So 90 days is the interest free period for deposit of goods in the warehouse, and after crossing 90 days we need to pay interest because there is a deferment of duty liability. So when you deposit the goods in the warehouse, you are not paying customs duty, but at the time of clearance from the warehouse only you will pay customs duty. Means there is a deferment of duty payable. So as there is a deferment of duty payable, so what is they are telling, like 90 days is the interest free period. After crossing 90 days, definitely you need to pay interest because you deferred the duty liability. That is the reason. Okay, so these are the basic aspects that we need to understand related to import of goods. Okay, so then you can see there various documents involved. So in case of import and in case of export, what are the various documents that are involved? Suppose if it is import goods, so import goods, what are the documents to be filed by the person in charge? So person in charge of the conveyance has to give the details of what are the goods that are present in the vehicle or conveyance, or that document is known as import manifest or arrival manifest or import report. In case of vessel, it is known as import manifest. In case of aircraft, it is known as arrival manifest. In case of vehicle, it is known as import report. So this is the document that is to be filed by the person in charge for bringing the goods into India. And these goods this document contains a list of the goods that is present in the conveyance. Same way, importer has to file one document for clearance of the goods, either for warehouse or for home consumption. What is the document? Bill of entry. So in all cases, it is the same document, bill of entry. Upon filing import manifest or arrival manifest or import report, so what will happen? The goods can be unloaded. Until that point of time, the goods cannot be unloaded. And moreover, in case of vessel, the vessel can enter into India. The grant of entry inwards will be given only when the import manifest is filed. Okay, but remember, without filing these documents, so sometimes the vessel only cannot arrive, but aircraft or vehicle can arrive, but unloading of the goods is not possible without filing this document. So the proper officer, after verification of these goods which are there in the conveyance, so he will be giving grant of entry inwards. Whereas the importer will be filing one document that is known as bill of entry. So that bill of entry contains the details of the goods, details of the importer, from which place it is brought in, and that contains the details of valuation and the rate and the even computation of customs duty also. Okay, so then in case of export, what is the name of the document? So person in charge who is taking the goods from India to outside India should give the declaration as to what are the goods that are present in the conveyance which is going from India to outside India. So for that they will be filing one document. In case of vessel, as in case of import, it is import manifest. So export, it will be called as export manifest. And in case of aircraft, as in case of import, it is the arrival manifest. So in case of departure, that is known as departure manifest. And in case of vehicle, in case of import, it is import report. So therefore in case of export, it is export report. So therefore this appears to be similar. And then in case of, that is exporter, he will be filing one document that contains the details of the goods, the valuation, and suppose if any customs duty is payable on those goods, the details of the customs duty payable will be mentioned. And what is the name of the document? The document name is known as shipping bill or bill of export. Suppose if it is vessel or aircraft, the document name is known as shipping bill, and if it is vehicle, the document name is known as bill of export. So this is the document that needs to be filed by the importer and the exporter. Okay, then so we have person in charge. Who is person in charge? Person in charge means in case of vessel it's master, and in case of aircraft it's pilot, and in case of vehicle it's conductor or guard will be taken as a person in charge. So they need to file those documents. Okay, and only after filing import manifest, grant of entry invoice is given for the vessel to enter into India, but aircraft and vehicle can enter even without grant of entry invoice, but they need to file this import manifest, or this arrival manifest or import report only for unloading of the goods. The concept of grant of entry invoice is not applicable in case of aircraft and vehicle, but arrival manifest or import report should be filed before arrival. So what is the time limit before within which that arrival manifest or import report should be filed? Arrival manifest and import manifest should be filed before the date of arrival. So if they are filing it late, there is a belated filing that attracts some penalty. Okay, whereas in case of import report, in case of vehicle, that can be within 12 hours after arrival, that is coming in the procedures. Okay, so then along with bill of entry, the importer has to submit even certain documents that he is the owner of the goods. So document of title to the goods should also be produced. Suppose if it is airways, the airway bill; if it is waterways, the bill of lading; and if it is by vehicle, lorry receipt or railway receipt needs to be produced along with the bill of entry, and even a copy of the invoice also to be produced, just to check whether whatever the valuation that is done in the bill of entry is as per the value as per invoice or not. So for that purpose. Okay, so what are the supporting documents filed along with the bill of entry? It will be nothing but the document of title called as AWB or bill of lading or lorry receipt or railway receipt, and then the invoice needs to be filed. Okay, then so again, so these are the various aspects which we need to understand. So all these things whatever we have discussed in these 2 pages are mainly for the purpose of understanding the taxable event and relevant date for determination of rate of duty. So as per section 12, so when there is levy of import duty, whenever the goods are imported, when the goods are said to be imported, is it the date when it entered into the territorial waters? No. So there are 2 Supreme Court cases, which is like Garden Silk Mills case and Kiran Spinning Mills case. Kiran Spinning Mills case and Garden Silk Mills case says that so the import of goods is said to have taken place only when the goods cross the customs barrier. Customs barrier refers to the customs control. Customs control means that customs control don't understand it as some customs gate. So it is even the goods which are deposited in the warehouse is also under the control of customs. So till the time the goods are under the control of the customs, the goods are not said to be imported. The date when goods crosses the customs control, then only the goods are said to be imported. That's the reason why on deposit of goods the warehouse, as the warehouse is still under the control of customs, it may not be physical control, it can be records based control, it may be at a different place also, but still it is under the control of the customs department. So we are not required to pay any customs duty. Only when it crosses the customs control, the goods are said to be imported. And because of this, what will happen when the goods are imported and it is kept in the warehouse, and if it is exported, it is not treated as import at all, because the goods did not cross the customs control due to that reason. Okay, so then next one, what is taken as the taxable event we have seen, and what is relevant date for determination of rate of duty, that is given in section 15. As per section 15, the relevant date for determination of rate of duty, if it is option 1. Option 1 is what? Clearance for home consumption, date of presentation of bill of entry or grant of entry invoice, whichever is later if it is vessel, and if it is aircraft or vehicle, date of presentation of bill of entry or arrival, whichever is later. Okay, so this is in case of option 1, that is imported goods are cleared for home consumption. In case of vessel, date of presentation of bill of entry or grant of entry invoice, whichever is later. In case of vehicle or aircraft, date of presentation of bill of entry or arrival, whichever is later. So here grant of entry invoice is replaced with arrival. Then what is the relevant date for determination of exchange rate? So because whenever we are importing, the goods will be invoiced in foreign currency, so that needs to be converted into Indian rupees. So what should be taken as the relevant date for determination of exchange rate? It is nothing but the bill of entry date. Bill of entry date should be taken. And then we have something called as option 2. In case of option 2, what should be taken as the relevant date for determination of exchange rate? It is the date on which goods are deposited. So inbound bill of entry. What should be taken as the relevant date for determination of rate of duty? It is export bill of entry. For deposit of the goods, we file inbound bill of entry, exchange rate relevant. For taking the goods from the warehouse, we need to file export bill of entry, that is relevant for determination of rate of duty. That is in case of option 1 and option 2. When it is said to be export, so the goods are said to be exported when the goods cross the territorial waters As per Rajendra Dyeing and Printing Mills case and Sun Export case, suppose if the goods are sunk within the territorial waters, it is not said to be exported. And as per section 16, the relevant date for determination of rate of duty is the let export order. So the date on which let export order is passed, that should be taken as the relevant date. And next, what is relevant date for determination of exchange rate? It is the shipping bill date. Shipping bill or bill of export which will be filed with the exporter, that date should be taken. And exchange rate as notified by CBIC should be considered, and not RBI rate or not any free exchange rate etc. It should be the rate notified by CBIC. And in case of improper import or improper export, that is in case of smuggling, so we will not be filing any bill of entry or shipping bill. Therefore, the date on which we pay the customs duty, on that date, whatever is the relevant rate, that will be taken. So this is the taxable event under customs. Okay, so this you need to remember. And now the next segment we are moving on to, that is classification of goods under customs. So in this classification of goods under customs, there is only one important area, that is general interpretative rules or rules for interpretation of tariff. That is, in the tariff there are a lot of goods and with different headings and rates of duty. So which product will be taken, like which heading will be taken for the goods that are being imported. So that we need to able to identify in the given tariff the proper heading. For that we need to understand the general interpretative rules. So in that rule 1 says that the titles are for reference only, the classification will be based on chapter notes. So if you have any conflict between the headings, so please refer to the chapter notes, and the chapter notes will provide the clarity as to this particular product will come in which place. So therefore the classification should be based on chapter notes along with headings. Then Rule 2A says that any reference to complete goods also includes reference to incomplete or unfinished goods. So having the essential features of completed goods, for example, car which is imported without tires or seats will be treated like car only. So because any reference to incomplete goods also includes reference to completed goods. Our incomplete goods or unfinished goods should be having the essential character of the finished goods, then it will be coming. Then rule 2B says that any reference to a material includes combination of that material with the other material. So for example, coffee also includes coffee mixed with chicory. Then rule 3A, so when there is one specific heading and when there is one general heading, always prefer specific heading over general heading. And 3B, suppose if the article is a composite articles, like mix of articles is there, so then in that case we need to take it as per essential character. So that's what usually I take, like say that there is a pencil with eraser, so that should be classified with pencil only, even if there is a different heading for pencil and different heading for eraser, like that. So therefore we need to take what is the essential character, based on that we need to do the classification. And then suppose if there are two headings which are specific, then rule 3C says that which comes last in the numerical order, the later the better, that should be taken. And rule 4 akin goods, that is similar goods. So whenever the classification is not possible as per any of the above ways, so then we need to take the similar goods as the classification. So then rule 5, packing material should be classified along with the main article if the packing material is capable of using only for that article. So then rule 6, goods can be compared at same level only. So heading in one particular chapter and subheading in another chapter cannot be compared. So because at the same level only it should be compared. So that is with respect to this general interpretative rules. So beyond this, in this classification of goods under customs, there is nothing that you need to remember. Then next, the next area, the important area that we are moving on to is segment 23, types of customs duties. Types of customs duties. So we have basic customs duties, then social welfare surcharge, integrated tax, and GST compensation cess. So this is the basic customs duty. So first what we need to do, first if you know the value, so we need to take the value, and thereafter we need to compute the basic customs duty. So basic customs duty will be at the given rate. So the rate will be given in the question itself. You don't have to worry about the basic customs duty. So whatever is the value that is given, you take that value, multiply with the basic customs duty. So you will be getting that percentage, you will get the basic customs duty. Then to that you need to add social welfare surcharge. Social welfare surcharge will be how much? 10% of the basic customs duty. Whatever is the basic customs duty, on that 10% will be social welfare surcharge, and the social welfare surcharge. So basic customs duty plus social welfare surcharge will be the first block. So there we will be getting customs duty excluding additional customs duties. Then in the second block you need to add additional customs duties. There are 3 additional customs duties: safeguard duty under section 8B, and countervailing duty or anti anti-subsidy duty under section 9 and anti-dumping duty under section 9A. So these are the three additional customs duties that needs to be added, and after adding that you will be getting customs duties excluding IGST and compensations, and thereafter you need to add IGST. While computing IGST, remember the rate will be given in the question, but IGST should not be computed only on the value. So we need to take the taxable value plus basic customs duty, all customs duties till that stage. So we need to add, because we have section 15 subsection 2 clause A which says that, so in the valuation for the purpose of GST we need to include all taxes, duties and cess by whatever involved other than GST. So as we are computing here GST, we need to add the customs duties, and then on that we need to compute the IGST, and GST compensations is also will be computed in the same way. While computing GST compensations don't include the IGST. So that is with respect to this various customs duties that we have, basic customs duties that we have. So these are the general customs duties, and previously we had education, secondary and higher education. Now we don't have, we have only social welfare surcharge, that you remember. And then there was something called as countervailing duty and special additional duty in order to counterbalance excise duty and sales tax. So previously, in order to counterbalance excise duty, there was countervailing duty, and that countervailing duty rate, if suppose if it is there, that will be given in the question, and the countervailing duty will come next to the social welfare surcharge, that is in the first block. So basic customs duty, social welfare surcharge and countervailing duty. So that stage itself it will be coming. Whereas special additional duty will be like IGST, which comes in the last. So that is in the last block, it will come just like IGST only. So while computing special additional duty, we need to take taxable value plus all customs duties. On that only special additional duty will be computed. And this countervailing duty and special additional duty is to counterbalance the excise duty and sales tax. So at present, whatever are the products on which excise duty and sales tax is applicable, on import of those products, definitely there will be CVD and SAD. So for example, when you are importing alcoholic liquor for human consumption, on local sale of alcoholic liquor for human consumption, we have excise duty, state excise duty and sales tax. So therefore, on import of alcoholic liquor for human consumption, we have only CVD, we don't have SAD. And thereafter, petroleum products, local sale, we have excise duty and sales tax. So on import of petroleum products, we have CVD and SAD. Then on tobacco products which are locally sold, we have excise duty and GST. So on import of tobacco products, we have CVD and IGST. So wherever excise duty is there, then CVD will come. Wherever sales tax is there, that their SAD will come upon import. But the exception to that is in case of alcoholic liquor for human consumption, only CVD is there, SAD is not applicable. So that is with respect to this note number 1. Note number 2, in case of export, we don't have any additional customs duties, only the basic customs duty is applicable. Even social welfare surcharge also don't take on export. Then note 3, in case of warehoused goods sold by way of transfer of warehouse receipt. So that is whenever I have deposited the goods in the warehouse and that warehouse goods I am transferring by way of warehouse receipt, then in that case the IGST shall be computed, which is A, taxable value plus basic custom duty plus social welfare surcharge. Generally how IGST computed? So we will take taxable value, basic custom duty and social welfare surcharge, or any additional custom duties, or B. So we need to compare that with the transaction value of the goods. So whichever is higher should be taken. Okay. So this is only for computing IGST, not for computing basic custom duty. So therefore I am depositing the goods in the warehouse and I am transferring the warehouse receipt to you. So now you are clearing the goods. When you are clearing the goods, you will pay basic custom duty on the price at which I have imported. Whereas IGST will be computed on the basis of taxable value under customs plus basic custom duty plus social welfare surcharge, or transaction value at which you have purchased from me, whichever is higher will be taken, and on that only IGST will be computed, don't forget. Then one more point, in case of IC sale, that is sale before import. So whenever I am selling the goods to you, that is by way of transfer of documents to the title, the goods are not at reach. This is sale of warehouse to goods. So the previous, like the next point what I am talking about is the high seas sales. So when the goods are sold on high seas basis, that is the goods are still in the transit, I transfer the document of title to you, then in that case you will be paying customs duty itself. So not just the IGST, the entire customs duty will be payable on the price at which you have purchased from me. So that only will be taken. We don't have any higher or lower computation. The price at which you have purchased from me, that will be taken. Then additional customs duty on import. So I told you that there are some additional customs duty which is payable on import, that is protective duty, safeguard duty, anti-subsidy duty and anti-dumping duty. Protective duty, please don't understand it as additional customs duty, because so protective duty is just enhancement of the basic customs duty. Already some basic customs duty will be there, that will be enhanced, that is only known as protective duty. Whereas safeguard duty, additional and anti-subsidy duty and anti-dumping duty are the separate line items. So now first we need to understand when there will be safeguard duty. Safeguard duty will be levied whenever the goods are being imported in large quantities, then safeguard duty will be applicable. Anti-subsidy duty will be applicable whenever the goods are imported which enjoys the export subsidy. Anti-dumping duty is applicable whenever the goods are imported at a price less than their domestic selling price. And in case of safeguard duty, actually the exports are fair exports. Only thing we are dependent on that product excessively. And in case of next to anti-subsidy duty and anti-dumping duty, that is unfair because the exporting country is giving some subsidy when they are exporting to India. And in case of anti-dumping duty, the exporter is trying to sell in India at a price less than their selling price. So therefore that is unfair export. And protective duty is levied in order to protect the domestic industry. So whenever the goods are being imported that causes damage to the domestic industry, then protective duty. So perhaps conclusion is that all these four are to protect the domestic manufacturer only. Protective duty is levied under section 6 of Customs Tariff Act, and safeguard duty section 8B of Customs Tariff Act, and countervailing duty, that is anti-subsidy duty. Actually this anti-subsidy duty is known as countervailing duty. In some places it is used as countervailing duty, but already we have one countervailing duty to counterbalance excise duty. That's the reason why I changed it to anti-subsidy duty. So this anti-subsidy duty is in order to like levy some duty because the product has enjoyed some export subsidy, because of it the product is being imported at a cheaper price. So therefore we have anti-subsidy duty also for the same reason that goods are imported at cheaper price. Anti-dumping duty also we have for the same reason that the goods are imported at cheaper price, but the situation is different. That's the reason why these two are mutually exclusive. These two are mutually exclusive. That is, when anti-subsidy duty is there, anti-dumping duty will not be there. When anti-dumping duty is there, anti-subsidy duty will not be there. Section 9 and 9A, these two sections are. Then authority to levy. Protective duty is levied by the Tariff Commission. That is all the recommendations of the Tariff Commission. Central government will be levying protective duty, whereas safeguard duty, anti-subsidy duty and anti-dumping duty will be levied by the central government based on the complaint. So therefore here voluntarily they will not levy, but protective duty based on the Tariff Commission which is appointed by the central government that will be looking into the goods which are being imported. They will give recommendations to the Union Finance Minister, and the Union Finance Minister incorporate the increase in the rates with respect to basic customs duty. But these three are in case of any complaint only. When it is received, then they will be investigating and then they will be trying to levy the additional customs duties. So relief against already we have seen. So mainly protective duty is to protect the domestic manufacturer, and this in case of imports in large quantities, this when the product enjoys export subsidy, and this when the goods are imported at a cheaper price than the price at which it is being sold there. And what is the extent of relief? What is the extent of relief? That is in case of protective duty, it is just the increase in the basic customs duty, there is nothing else. Whereas in case of safeguard duty, so they will be giving a notified percentage in the question. That notified percentage you need to take. So that notified percentage can be a percentage of assessable value or a percentage of landed value. Assessable value means the value given in the question. Suppose if it is landed value, then basic customs duty plus social welfare surcharge should be added. Okay, so please remember the landed value is something generally we will get confused. So landed value is nothing but assessable value plus basic customs duty plus social welfare surcharge, that should be taken as the landed value. So sometimes the percentage given is only on assessable value, we will take on assessable value. If the percentage is given on landed value, we will take on landed value. In the absence of information, that is I am talking about safeguard duty, in the absence of information, we will take it on the assessable value only. Then anti-subsidy duty also like a percentage only. They will give one percentage, that percentage we need to apply on the assessable value or landed value. If nothing is given, then on assessable value. Whereas anti-dumping duty is not like that. Anti-dumping duty will be dumping margin or injury margin, whichever is lower. Dumping margin which will be done by the exporter. That is the price at which they are selling to India and the price at which they are selling in their country, that should be taken. So normal selling price in their country minus the price at which they are selling to India. So that difference should be taken as the dumping margin. Whereas injury margin will be like in India, the domestic manufacturer. What is the price at which the goods are locally sold minus what is the landed value of the imported goods, that is known as injury margin. So these two margins, whichever is lower, should be taken. Now there is one important point in case of dumping margin. That is, in case of dumping margin, what we need to see is that suppose if that country is not selling in that country, exporting country, there is no local sales, then the exporting country will be selling to a third country apart from India. That will be taken as the normal selling price in the exporting country. If that information is also not available, we will be taking cost of production plus 10%, and that will be taken for the purpose of determining the dumping margin. Then investigation. In case of protective duty, there is no need of investigation, but in case of additional custom duty, investigation is required, because so first an application or a complaint will be made, then only they will be initiating investigation for the purpose of levy of additional customs duties. What is the period within which the investigation has to be completed? In case of safeguard duty, the investigation should be completed in 2 days, as a 200 days, and in case of anti-subsidy duty 4 months, and in case of anti-dumping duty it is 6 months. So till the time they complete the investigation, they can levy a provisional duty, and upon finalization, if there is any difference, that will be payable. If there is any shortfall, like that will be refunded. Okay, that is if there is any less. Suppose if they waive off also, then whatever they have collected as provisional, that will be refunded. What is the duration of levy? That is very important. In case of safeguard duty, the duration of levy is 4 years plus 6 years. The maximum time limit is 10 years. But in case of anti-dumping duty and anti-subsidy duty, there is no time limit. So they can extend it for any time. But for every 5 years, they need to conduct a review. So 5 years plus for every 5 years, it can be extended. But they need to conduct a review at the time of every 5 years, whether to continue it for next 5 years or not. And there is no time limit, so that can be extended for any time limit. There is no maximum period. And exemption from levy, all these 3 additional customs duties as a common exemption, that it is, if it is imported into 100% EOU or SEZ, there is no need to pay. Suppose if the product attracts safeguard duty or anti-subsidy duty or anti-dumping duty, if that product is imported to 100% EOU or SEZ, no need to pay that. Suppose if it is cleared from the EOU or SEZ to DTA, then we need to pay that. Then retrospective levy is possible up to 90 days prior to the date of notification. So today they are giving notification, they can levy it retrospectively within 90 days prior, that is this. And suppose if within 5 years they are not able to complete the review to extend, then there is an automatic review for a period of 1 year. That's a May 22 amendment, you need to remember. But it's within 5 years, if they are not able to complete, then there is an automatic renewal for a period of 1 year, and within that 1 year they need to review whether to extend it or not. Then in case of safeguard duty, the alternative to safeguard duty is tariff rate quota system. That is also available. In tariff rate quota system, they will be telling, so this much is the quantity that you can import without customs duty, and that is without payment of any additional customs duty. Beyond this quantity only you need to pay, like that. They can fix a slab rate model, that is this. And so non-applicability of safeguard duty. Safeguard duty is, not applicable in few cases. So is review assessee specific, sir. Now review will be like in the general interest of the domestic industry. Okay, so it is like not assessee specific, it is overall industry only they will take into mind for the purpose of conducting the review. If they feel like the domestic industry still needs to revive and it will take time, so then they will be continuing. It's not particular importer or etc. Then non-applicability of safeguard duty. Once an article attracts safeguard duty, if that article is imported from a developing country and the percentage of imports from that developing country does not exceed 3% of the total imports of that article into India, no need to pay safeguard duty. Okay, we are importing from a developing country. A developing country means one developing country we are importing, and import from a developing country does not exceed 3% of the total imports of that article into India, so no need to pay safeguard duty, provided we are importing only from a developing country. Suppose if we are importing from more than one developing country, then what we need to do? So with less than 3%, all these things you group together. If that is does not exceed 9%, then there is no safeguard duty. If that exceeds 9%, then there is safeguard duty on the group. So grouping is like less than 3%, not less than or equal to 3%, less than 3%, and all these things will be grouped, and we will check the total. The total should not exceed 9%. Then on this group, whatever developing countries from which we are imported with less than 3%, there is no safeguard duty. Suppose if it exceeds 9%, then on that group there will be. Then circumvention of anti-subsidy duty, anti-dumping duty, that is also May 22 amendment. Circumvention means if you try to escape from anti-dumping duty or anti-subsidy duty by altering the description or name, or you are importing in unassembled or disassembled form, or you are changing the country of origin, or in any other manner you are trying to escape from that. So now even for that altered description or unassembled goods, or even for different country of origin also, they will extend this anti-subsidy duty and anti-dumping duty. Then absorption of anti-subsidy duty and anti-dumping duty whenever we are importing the goods that attracts ADD or ASD, and in order to nullify that effect effect, suppose if the further subsidy is given by the exporting country, or if the exporter is further reducing the selling price, then previously there was no power to increase the notification whatever rate that was given. So now the government is having the power to increase the rate whatever they have notified, so that if the further subsidy is given by the exporting country, here they can increase the rate. If the exporter has further reduced the price, so here they can increase the rate. And this increase in the rate will be done only if there is reasonable assurance that the price that has been reduced by the exporter or the exporting country is not because of the demand. Suppose if because of the demand and supply or some other factors, if the price is reduced and that is genuine, then in that case the rate will not be increased. So that is with respect to this absorption of ASD and ADD. So these are the amendment areas which you need to remember: circumvention of ASD ADD, absorption of ASD ADD. So that may be asked as a short note question for this coming exams. Then, so this is what I have already given to you, that alcoholic liquor for human consumption, what we need to pay, petroleum products, etc. So this is in comparison with local sales and imported, I just gave you. And this is the computation of customs duty in case of import. So with this we completed types of customs duty and how to compute the customs duty payable. Then the next area that we are moving on to is segment 24, valuation under customs. So what should be taken as the value in case of import? So there are two parts that we are going to discuss this: valuation in case of import and valuation in case of export. What should be taken as the value in case of import? Value in case of import will be assessable value plus basic customs duty, like that, and all we will take for IGST. Here what should be the assessable value? That assessable value is nothing but CIF price. In case of import we will be taking CIF price. In case of export we will be taking FOB price. What is CIF price? CIF refers to cost insurance price, and this CIF price will be FOB price plus insurance plus freight, and FOB price will be the price that is prevailing at the exporter's port, and this FOB price will be free on board price, which will be given in the invoice. So for that FOB price we need to add insurance and we need to add freight, so we will be getting the CIF price. So insurance, if it is actuals, we will be taking the actuals. If it is not available, we will take 1.125% of the FOB. So freight again divide into two freights: air freight or other freight. If it is air freight, actual ascertainable, also we will compare with 20% of FOB. So actual of 20% of FOB, whichever is lower, only if it is air freight. If it is other freight, we will take 20% of FOB. Okay, that is if it is other freight, actuals available, I will take actuals. If actuals not available, then only we will take 20% of FOB. Whereas in case of air freight, even if actuals are available, we need to do the comparison. That's what I mean to say. So whenever you are computing 1.125% or 20% on FOB, remember it is not the FOB that is given. We need to make the adjustments to the FOB. We need to arrive at the adjusted FOB price or the revised FOB price, and thereafter on that only we need to compute 1.125% or 20%. But whenever we are taking this freight 20%, which means that all costs are included in that, so further don't add anything else. For example, this freight generally includes handling charges, any actual handling charges not at the port of import. So in import, that is at the port of import, if there is any unloading charges, that will not be coming into the freight. So for during the transit, if there is any charges, so that will only be coming into that freight. And ship demurrage charges, suppose if the ship is anchored at the outer space, for that they need to pay ship demurrage charges, that is also part of freight. And for bringing the goods from the ship to the shore, they will be bringing through small boats, for which they will be paying light rate charges and bar charges, that will also be part of freight. So when you take 20%, all these are already included in that, so no need to add again these charges. Okay, then suppose if the actuals you are taking, then we need to add all these charges. But remember, at the time of importation, if there is any unloading charges, that should not be taken. Then adjustments to the FOB price. So why we need to make adjustments, that is given. So far what we have discussed, this is rule 10 sub rule 2. These are the adjustments what we need to make, that is given in rule 10 sub rule 2 of customs valuation rules 2007. Now what we are going to discuss as the adjustments to the FOB price is given in rule 10 sub rule 1 of customs valuation rules 2007. So what does it say? First point, commission. So commission is divided into buying commission, selling commission. Buying commission is the commission paid to the importer's agent. Selling commission is the commission paid to the exporter's agent. To importer's agent, importer is paying the commission. Definitely it will not be included because it is an expenditure of the importer on his own account. Suppose if it is the indirect consideration to the exporter, then we need to add. So therefore this is not an indirect consideration. It is the commission which is payable by the importer to his agent. So that will not be included in the value. Whereas selling commission which is payable by the exporter. If exporter pays, no issue, but if it is paid by the importer, that's an indirect consideration to the exporter, therefore it should be included in the value. And the other name for selling commission is local agents commission, because the exporter's agent will be in India called as local agent, so that's why local agents commission, and importer's agent will be outside India. Okay. Then next, second adjustment is, suppose if importer is sending any material or any capital goods etc. used in manufacture of finished goods, and then when finished goods is imported, so the value of this material also should be included into the value of the finished goods, because we compute the imported goods value on which custom duty payable. So it is like any material supplied by the recipient to the supplier, so any amount that the supplier is liable to pay but which is paid by the recipient logic, so therefore it should be included in the value. And if it is capital goods, the amortized value will be included. So if it is material, the actual value will be included. In case of capital goods, amortized value. If amortized value not applicable, then full, like not available, we will be taking full value of the capital goods into the value of the finished goods. Then apart from this, any other expenses incurred by the exporter and recovered from the importer, so divide it into two, whether it is before import or after import. If it is before import, no doubt it will be included. And if it is after import, so then if it is as a condition of sale of imported goods, for example, installation charges as a condition of sale, so that is installation charges payable after import, so but that is as a condition of sale, therefore it should be included. Suppose if there is customization charges, that customization charges is not as a condition of sale and it is incurred after import, so that will not be included. And then one important point is also there, if there is any like license or designs, drawings etc. which is procured elsewhere than in India and that is sent to the exporter, and that value also should be included in the value of imported goods. Suppose if the drawings and designs are procured in India, so that cost will not be included in the value. Okay, only when it is procured elsewhere than in India, it should be included in the value. That is one point which is there. And suppose if the transaction value fails, what we need to do? So when the transaction value fails, first of all, why transaction value fails? So in case of GST also we have this point that price must be the sole consideration, supplier and recipient should not be related. Suppose what if the price is not sole consideration, or what if the supplier and recipient are not related? So or if there is some restricted sale or conditional sale, which means that importer has to sell only to the person to whom the exporter is selling, or importer has to make the sales in this way only, like that whenever there is a restricted sale or conditional sale, all these cases, then the transaction value will not be applicable. So 4 conditions should be satisfied for applicability of transaction value. Number 1, unrestricted sale, unconditional sale, price must be sole consideration, and they both should be unrelated. Okay. Also, one more case, also transaction value will be rejected. Suppose if the customs officer is of the opinion that there are comparable imports, and because of the comparable imports, the value at which you have imported the goods is not correct, so then also they will reject the value. So that is this point. So rule 3 of customs valuation rule says that first we will take transaction value. So remember this keyword TISTCR. T for transaction value, if not identical goods or similar goods, then deductive value, then computed value, then residual value. First transaction value, if it fails, then identical goods. Then if that also fails, then similar goods. If that also fails, then deductive value. Then that also fails, computed value. Then residual value. So now what is identical goods? Identical goods is given under rule 4. Identical goods means also imported goods, some other imported goods, and that some other imported goods having the same physical features, characteristics. So it should be same to same, and that should be also imported from the same country. Okay, and it may be manufactured by the same producer or may not be. So it may or may not be. Not necessarily that it should be manufactured by the same manufacturer. It can be by any other producer also, but it should be from the same country. So then it is known as identical goods. So there is imported goods having same physical features or quality, same country, and same producer preferably. And to that we need to make some changes. That is 3 changes we need to make. Difference in the quantity. If we imported some quantity, other person has imported another quantity. So that another quantity, if whatever quantity we imported, if he imported, so what is the price? That should be made as adjustment. And difference in the transportation cost. If we imported to one port, he imported to another port. What if he imports to our port? So what could be the cost? That should be added. And then suppose if there is any difference in the commercial level of importation, we imported from the manufacturer, he imported from the dealer. Suppose if he imports from the manufacturer, what would have been the price? That adjustment has to be made. So these are the 3 adjustments to be made, and we need to arrive at the transaction value of identical goods. If in the transaction value of identical goods, suppose if we get more than one value, we need to take whichever is lower. Whichever is lower should be taken. Okay, then next, assessable value equals to transaction value of the similar goods. Suppose if identical goods fails, so then we need to go for similar goods. What is the meaning of similar goods? Similar goods are also imported goods, and these similar goods imported should be commercially interchangeable. Commercially interchangeable means what? Commercially interchangeable means, so rather than like taking the same goods, maybe some minor modifications could be there, some changes could be there. For example, I used to give in the class that a top load washing machine can be replaced with a front load washing machine, so that will be taken as the similar goods, commercially interchangeable. For that washing machine, fridge cannot be taken, that cannot be taken as the commercially interchangeable, and that should also be produced in the same country, produced by the same person preferably. So same, whatever is there in identical goods, the same point is there in similar goods. Only difference is that in case of identical goods, same physical features and quality, but in case of similar goods, need not be same, it can be commercially interchangeable. And we need to make some adjustments. What are the adjustments that we need to make? Suppose if there is any difference in the quantity, difference in the transportation cost, difference in the commercial level of importation, and difference in the materials or engineering work. So the first three are same as identical goods, but extra fourth point because commercially interchangeable in our example, top load and front load. So what, there is a difference in the engineering work that has to be done, so then we will be bringing it into parity, and then we can make it as a comparable. Suppose if we get more than one value of similar goods, then we will take whichever is highest. Okay, whichever is highest or whichever is lowest, whichever is lowest, not whichever is highest, whichever is lowest only we will take. So here identical goods also whichever is lowest, here also similar goods also whichever is lowest. Then when the above rules are not applicable, suppose if you are unable to determine the value as per identical goods or similar goods or deductive value or computed value, so when the above rules are not applicable, then the value will be determined as per rule 7 or rule 8. So here rule 7 or rule 8 we can interchange. Rule 7 is deductive value, rule 8 is computed value. First we can go for, that is we can make a request to the customs officer. First of all, these rules are not applicable to importer, because importer will not do this valuation. This valuation will be done by the customs officer. So therefore the importer can request the customs officer to go for deductive value first or computed value first, whichever is okay. So that is interchangeable. Now let's see deductive value, rule 7. So what does it say? So first let's see the sale price at which the imported goods are first sold in India. So the price at which the imported goods are first sold in India minus all the additions we need to remove, that is post import additions, like all post importation expenses we need to deduct, including the profit margin of that person importer. So if you take out, we will get the price prevailing at the time of importation. So customs duty you need to exclude, and transportation cost you need to exclude, profit margin you need to exclude, and any commission that we paid we need to exclude. So GST, suppose if there is any sale on which GST is payable, that is also to be excluded. All these are excluded, and whatever is remaining, that should be taken, and that will be taken as the price prevailing at the time and place of importation. So that should be taken here. Okay, that is known as deductive value. Whereas computed value, in case of computed value, we will be taking cost of production. So that is, computed value means the value which will be done by the exporter. So therefore we need to take what is the cost of production of the exporter, and we need to add profit and general expenses, and we need to add freight and insurance. So after adding all these things, we will be getting the computed value, and that computed value should be taken. Okay, that is with respect to rule 8. And rule 9, suppose if computed value not available, see computed value is simple, just take the cost of production plus any usual profit margin, that is of the exporter, plus freight and insurance from there to here, that cost should be added. And best judge value, rule 9 says that you take the best judge value. So what is this best judge value? The officer will determine based on some principles of valuation, and he will be determining just like the residual value what we have in rule 31 of GST. In GST rule 27, 28, 29, 30, if that fails 31, we have not the same way residual value that we have here. So that is with respect to this. Then valuation in case of exports. So valuation in case of exports, always we need to take what? FOB price only should be taken. So it is not the AF price. So therefore it should be taken as FOB price. FOB price means what? Price prevailing at the exporter port should be taken as the FOB price. So that should be taken as the assessable value. Then customs valuation rules in case of exports. Suppose if the value fails, that is if the transaction value fails, so then for exports also we have the valuation rules. So in case of export, it's very simple. We will take the FOB price only. Okay, so then customs valuation rules will come into the picture, that is when transaction value fails. When transaction value fails, same way, proper officer should satisfy that the declared value is correct, and in case of related party, transaction value may be acceptable. But what is that you need to see is that whether the declared value is correct or not, that the proper officer will check. Suppose if that fails, then we have like kind and quality. Like kind and quality means like identical goods, that is their imported goods, here exported goods, then same physical features, here same physical features, produced in the same country, produced by the same person, everything same. Here also adjustment should be made, difference in the quantity, difference in the commercial level of importation, difference in the freight cost. Suppose if we get multiple values, we need to take lowest of such value. This is ditto like identical goods only. Then suppose if it fails, then directly computed value. There is no similar goods in case of export. Directly computed value, that is cost of production plus usual profit margin. Don't add freight and insurance, because we will take the price prevailing at the exporter's port, that is FOB price. If that is also fails, we don't have deductive value and all, directly budget value. So with this, the valuation in case of import and export is over. Then there is one small area, that is valuation in case of second hand goods. Whenever we do the valuation in case of second hand goods, we need to remember that suppose if there is any chartered engineer certificate is obtained outside India, that value will be taken. Suppose if there is no chartered engineer certificate obtained outside India, then so we need to get a chartered engineer certificate in India, and that should be produced before the customs officer. The customs officer will compare between the declared value by the importer, whatever is the value that is declared by the importer, and the chartered engineer certificate, and the depreciated value of the goods. So based on the depreciated value of the goods, they will determine. So how to take the depreciated value of the goods? Actually, the depreciated value of the goods concept is there in import of goods at concessional rate of duty rules. The depreciated value will be simple. That is for every quarter or part thereof, in the first and second year, okay. For every quarter or part thereof in the first and second year, it will be 4%, okay. Then for third and fourth year, and so then for fifth and sixth year, like that we have, okay. So 4, 3%, 2.5%, like that, okay. So you can see that I'll just show you this information. You can take the import of goods at concessional rate of duty rules. So there I have given, so please look into that in page number 116. You can see that, okay. For every quarter or part thereof in the first year it is 4%. So remember the percentages: 4, 3, 2.52, 4, 3, 2.52. For every quarter or part thereof in the first year it will be 4%, not first and second year. First year it will be 4%. For every quarter or part thereof in the second and third year it will be 3%. For every quarter or part thereof in the fourth and fifth year it will be 2.5%, and thereafter it will be 2%. So how to do this computation? It is simple. Depreciation depending upon the period of usage. For example, it has been used for 3 years. So what we need to do first, for first year it will be 4 into 4, 16%. Then second year and third year 3%. So total 8 quarters, 8 into 3, 24. So 24 plus 16, that will be 40%. So 40% will be taken out, that is the depreciated value. So like that we need to compute the depreciated value. Here we have. So in the same way, we need to compute the depreciated value of these goods, and that depreciated value needs to be compared. So there are 3 things that needs to be compared, okay. So for every quarter or part thereof in the first year, okay. First year it will be 4%. For second and third year it will be, for second and third year it will be 3%. So that is 4, 3%, 2.5 and 2, that should be taken, and that is the depreciated value. So we need to compare between those two, and we need to take, officer will do this comparison, and after officer is being satisfied, yes, so whatever value that is declared is correct, then the officer will go for transaction value. If the officer is of the view that this is not correct, then the officer will seek explanation from the importer. If the officer is not satisfied with the explanation, then the regular valuation. What is the regular valuation? Rule 4 onwards we have now, Rule 4, Rule 5, Rule 6, Rule 7. So that will be applied, okay. So with this we have completed the valuation under customs, okay. So that is here, and 1 second. So why number of students are very less? I am taking class for you only, guys. Please ask your friends also to attend, because yesterday night I boarded the train, and today morning only I came. I could not properly sleep also. So then immediately I am coming and taking class for you only. So I don't know. So this is the problem with you. So when I put that much effort for you also, you will not realize that. Fine. So what to do? It's all our fate. Okay, so now we are moving on with the next area, that is segment number 25, customs procedures. So in this customs procedures, so what we need to understand is what is the procedure for import and what is the procedure for export. Okay, so you can see that in page number 152. So customs procedures is mainly important from MCQ perspective here. Mainly for MCQ perspective, nothing else. Okay. So quickly have a look into this. Just give me 1 second. Yes, you can see this. So see this page. This is the procedure for import to be made by an importer. So what is the procedure for import? First, so there is an importer, there is an exporter, there is a shipping company, master of the vessel, that is person in charge. So first the exporter will hand over the goods to the shipping company. When the exporter hand over the goods to the shipping company will give bill of lading. Bill of lading is the document of title to the goods. That bill of lading will be sent by the exporter to the importer, and the importer is now having the proof that he is the owner of the goods. Now the master of the vessel will bring the goods to the country and he will be filing import manifest. When he files the import manifest with the customs officer, the customs officer will grant entry in goods, and thereafter the goods will be unloaded with the port trust authorities. And port trust authorities are like custodian. So the goods will be under the control of the custodian. Okay, till the time the goods are cleared by the importer. Now what importer has to do? He need to file a bill of entry. Okay, and so after this bill of entry is filed, the customs officer will be filing, will, like, after filing bill of entry, the customs officer will verify whether the valuation has been proper or not and the customs duty is properly computed or not, and they will be collecting the customs duty. So once the bill of entry is filed and acknowledgement is generated, immediately after generating the acknowledgement, so the importer will be making payment of customs duty. Upon payment of customs duty, the customs officer will pass out of customs charge order. So this out of customs charge order is relevant for the purpose of clearing the goods by the importer. So now then importer will also give the bill of lading, that is document of title to the goods with the master of the vessel, and for which the master of the vessel will be giving a delivery order. So delivery order is because he is the owner of the goods. You need to prove that he is the owner of the goods. So first you need to prove that he is the owner of the goods. Second, he need to prove that he has paid the customs duty. So these are the two orders, delivery order and out of customs order. He will submit with the port trust authorities, and the port trust authorities will release the goods. So these are the 12 points that we need to keep in mind. So usually in MCQ they have asked this once, that is the order. The order is very, very important that we need to remember. Now in case of aircraft, what will happen? If you see this bill of lading, wherever this bill of lading is there, in that place it will be changed to airway bill. That is in case of point number 2, then point number 3 and point number 9. So we will be taking it as airway bill. Airway bill. So the name of bill of lading is in case of vessel. In case of aircraft, it will be known as airway bill, and in case of vehicle, it will be known as lorry receipt. Lorry receipt or railway receipt. Lorry receipt or railway receipt, or it can be called with any other name. Okay, so that will be taken as the document in case of vehicle. Okay, so that is the change that we will have, and remaining procedure will be the same. Okay, then so see the notes in the next page. All the import and export procedures under customs are through the common portal. What is the customs common portal? The customs common portal is icgate.gov.in. In case of import by aircraft, 239 replaced with airway bill, and vehicle 239 replaced with lorry receipt or railway receipt. Already it is there. In case of aircraft and vehicle, grant of entry inwards is not required to enter, but for the purpose of unloading. And now we are going to discuss what are the compliances to be followed by the person in charge. Who is person in charge? Already we have seen. In case of vessel, it's master. In case of aircraft, it is the pilot. And in case of vehicle, it's conductor or guard or any other person in charge. So place of arrival, as per section 29, they need to arrive only at the port or airport, and in case of emergency they can arrive at any other port. And file import manifest, arrival manifest or import report. Import manifest and arrival manifest to be filed before the date of arrival. Suppose if there is any delay in filing, so there is a belated filing fee. So always belated filing penalty under customs. So this customs penalty itself is up to 50,000 rupees. So in every place it is the same, up to 50,000 rupees. And how the import manifest and arrival manifest has to be filed? Import manifest and arrival manifest has to be filed electronic mode only. And import report is filed in case of vehicle and within 12 hours after arrival of the vehicle. So that will be filed, and the mode of presentation will be manual only. Okay. So then principal commissioner may allow manual filing in case of these two, that is import manifest and arrival manifest. Principal commissioner may allow manual filing also. So then file passenger name record information along with import manifest, arrival manifest or import report. So that is, so along with the import manifest, arrival manifest, import report contains the details of the goods, but arrival report contains the details of the passengers who are coming in the vessel. That is as per section 38. And as per section 31, so if the goods are to be imported by vessel, the goods can be unloaded only after obtaining grant of entry inwards. And once the goods are unloaded, that will be going into the custody of the custodian, and the custodian will be responsible for the goods. And in case of any pilferage means loss of goods. So in case of any loss of goods, the custodian is only responsible for payment of customs duty. Then as per section 32, only goods specified in the manifest, import manifest, arrival manifest or import report to be unloaded. As per rule 33, goods should be unloaded at the approved place only. And as per 34, goods should be unloaded under the supervision of proper officer. As per section 35, if the goods are transported from the ship to the shore, so that should accompany a board note. And as per section 36, if the goods are unloaded after office hours or during holidays, then they need to pay merchant overtime charges. So these are the various sections, section 29 to section 36, that is applicable in case of person in charge at the time of import. Then what is the compliance to be followed by the importer? So as per section 46, the importer has to file one bill of entry. That bill of entry, we have three types of bill of entry. Bill of entry for home consumption, bill of entry for warehousing, inbound bill of entry, export bill of entry for clearance from the warehouse. Okay. So now what is the time limit for filing bill of entry? So this place there is a change. What is the minimum time limit? So that is before the date of arrival. Before the date of arrival including holiday. So it can be Sunday or it can be a public holiday. holiday, whatever it is, before the date of arrival, they need to file the bill of entry. And suppose if they want to file even before that, then within 30 days prior to the expected date of arrival. What does it mean? Means the life of a bill of entry is 30 days. After 30 days, the bill of entry will expire. So therefore, we should ensure that the goods are arriving within 30 days. Suppose if the goods are not arriving within 30 days, then again we need to file a fresh bill of entry only. Okay. Then what is the late fee for delay in filing bill of entry? Suppose if there is any delay, that is bill of entry not filed. Actually today goods have arrived, that is vehicle has arrived or vessel has arrived today, and by yesterday it should have been filed. Suppose if it is not filed, from today there will be a late fee. Say for example that it is filed late for 5 days. Now you can see the late fee for delay up to 3 days, it will be 5,000 rupees per day. For the delay beyond 5 days, it will be 10,000 rupees per day. In this example, 5 days means first 3 days it will be 5 into 3 15,000. Next 2 days it will be 10 into 2 20,000. So 20,000 plus 15,000, 35,000 will be taken as the late fee. But remember, the late fee is subject to maximum customs duty payable on the goods. And suppose if it is exempted goods, subject to maximum 50,000 rupees. So that will be taken as a late fee. And pay customs duty after filing bill of entry for home consumption. So what is that? Like when we should pay customs duty. So once we file the bill of entry, I told you that an acknowledgement will be generated. Once acknowledgement is generated, if we go for immediate payment option, there are two payment options available: immediate payment option and deferred payment option. Immediate payment option means immediately you have to pay. Deferred payment option means it is a frequency, like 15 days once we have, so that 15 days once we need to make the payment. That is deferred payment option that we will be discussing in assessment, that is as per section 47. And then as per section 48 and 49, if the imported goods are not cleared within 30 days from the date of unloading, so then that goods may be either disposed of or can be deposited into the warehouse by the proper officer. So this warehouse is not done by the importer, this warehouse is done by the proper officer. Okay, and for how many days it can be kept in the warehouse? 30 days. And again for every 30 days they need to do a review as to whether to dispose it off or to continue to keep it in the warehouse for a next period of 30 days. So these are the compliances to be followed by the importer. Then next, export procedures you can see. In case of export procedures, so here again it starts from the exporter. So exporter will hand over the goods along with the shipping bill or bill of export. In case of vessel, it will be known as shipping bill, aircraft shipping bill. In case of vehicle, it is known as bill of export. So when the exporter hands over the shipping bill or bill of export with the customs officer, and then the customs officer will be verifying the shipping bill and will be passing late export order. Suppose if any customs duty is collected, so that will be specified. If not, so then late export order will be passed. The exporter will submit the shipping bill or bill of export with the person in charge, and the person in charge should not unload the goods, should not load the goods. So before loading the goods, the person in charge should get grant of entry outwards. So because if the goods are loaded and the grant of entry outwards is not obtained, again the goods needs to be unloaded. Due to that reason, first they need to get a grant of entry outwards, and then the goods will be loaded into the vessel, and whatever goods that are present in that vessel, that needs to be submitted in export manifest. In case of aircraft, it is known as arrival, that is departure manifest. In case of vehicle, it is known as export report. Okay. Now, what are the compliances to be followed by person in charge? This is a shaded area between import and export. So you can see that. So section 33, they are unloading only at the approved place, here loading at the approved place. Section 34, so there under the supervision of proper officer unloading, here loading under the supervision of proper officer. 35, boat note for bringing the goods from ship to shore. But for taking the goods from shore to ship, no need of any boat note, because shipping bill is there, that will be sufficient. And as per section 36, same. So they are unloading on holidays, merchant overtime charges, here loading on holidays, merchant overtime charges. Then section 39, this is separate only for export, should obtain entry outwards from the customs officer before loading of goods, and they will be filing these documents, that is export manifest, departure manifest or export report, and also passenger name record information. Even in case of import also they need to file a passenger name record information. The same is required even in case of export also, passenger name record information. And they should obtain a permission to leave from India from the customs officer. Okay. So these are the complaints to be followed by person in charge in case of export. Whereas, what is the complaints to be followed by the exporter? So they will be submitting a document. What is the document that they will be submitting? Shipping bill in case of vessel, and aircraft in case of vehicle. It is known as bill of export, and that should be submitted in the customs common portal. What is the customs common portal? ICE gate, as per section 15. And as per section 18, suppose if they don't know the assessment, if they know the assessment, they can do the assessment under section 17, that is self assessment. Otherwise they will be resorting to provisional assessment, and they shall pay the customs duty if applicable immediately on filing shipping bill. Okay. So deferred payment option is not available. Deferred payment option is available only in case of importer, not in case of exporter. And they will be obtaining let export order. That is, whenever they hand over the shipping bill or bill of export with the customs officer, the customs officer will verify, because not all goods exported attract customs duty. There are only limited goods that attract customs duty. So that customs duty will be verified, and then let export order will be passed. Okay. So this is about import procedures and export procedures. Then the other areas in this procedures under customs is there, that is transit and transshipment. Transit means goods which are brought into India in a vessel or aircraft. The same vessel or aircraft is taking the goods, the remaining goods, from that port or airport to another port or airport. So very important point that we need to know is that, so in case of transit, the transit freight and insurance, okay, freight and insurance, the transit freight and insurance, shall be included in value, shall be included in value. Okay, shall be included in CIF price. In CIF price, when we do the valuation, freight we take na, in that freight the transit freight will be included. Okay, so because the same ship which is coming to first airport or port is taking the goods to another port or airport, so therefore that transit cost will be there, that will be included in the freight. Whereas transshipment a different shape, so that cost will not be included. Okay, so freight and insurance, transshipment freight and insurance shall not be included in CIF price, okay. So while computing the freight, that is cost, insurance, freight, in that freight, transit freight should come, transshipment freight should not come. That is the meaning. Okay, so transit means what? The same ship which is bringing the goods to the first port is taking to the another port, but in case of transshipment, the goods are taken in a different ship to the another airport. In case of transit, no need to file any document, but in case of transshipment, a bill of transshipment or declaration of transshipment to be filed. Continuity in the records. In case of transit, the goods will be there, so therefore it will continue in the records. But in case of transshipment, as the ship changes, a new set of records to be maintained. In the first port or airport, in both cases, they need to file the import manifest, arrival manifest that contains the details of all goods. So transit goods, transshipment goods, everything will be there. In the subsequent port, whatever is the transit good, transshipment good, that will be submitted. Okay, that is with respect to transit and transshipment there. Then, in case of import or export by post, so what should be taken as the relevant date for computation of rate of duty? So post includes courier. So only thing, postmaster will be changed with courier agency. First we will see import by post. So import by post can be by vessel or by aircraft or by vehicle. Suppose if it is import by vessel, generally import by vessel, what we will do, date of presentation of bill of entry or grant of entry inwards, whichever is later, correct? So here we will take date on which parcel list is submitted to the proper officer, or the date of arrival of the vessel, whichever is later. In case of aircraft or vehicle, the date on which parcel list is submitted to the postal authority. The postal authority submits a parcel list to the proper officer will be taken. And wherever we have postal authority, that postal authority will be replaced with courier agency in case of imports by courier. This is in case of relevant date for determination of rate of duty in case of import by post. In case of export by post, very simple, the date on which parcel is handed over to the postmaster or courier agency, that will be taken as the relevant date for determination of rate of duty in case of exports by post. Then in customs also, they brought in the concept of electronic cash ledger and electronic duty credit ledger. Instead of calling it as electronic credit ledger, they call it as electronic duty credit ledger. So electronic cash ledger is like whatever customs duty that we need to pay, that will be deposited into the electronic cash ledger, and that money can be used for payment of customs duty or whatever is the interest, penalty, fine, etc. And whatever is the unutilized balance in the electronic cash ledger will be refunded. But in electronic duty credit ledger, so whatever are the incentives that we are eligible to get, or any refund that we are getting on export, so all those will be credited to electronic duty credit ledger, so that there is no cash outflow. Whatever balance that is there in the electronic duty credit ledger can be used only for payment of customs duty. It cannot be used for payment of penalty, interest. This is just like GST also. Okay, and whatever is the unutilized balance, that unutilized balance cannot be claimed as a refund, and that will be there, so it will be carried forward and it will be adjusted only against payment of customs duty. But in case of GST, the balance in the electronic credit ledger we will get as a refund in two cases. Number one, that is zero rated supplies. Number two, in case of inverted tax structure. Here there is nothing like that. So this is with respect to payment of customs duty through cash ledger and credit ledger. Then faceless assessment is brought under customs. That is, whenever we file a bill of entry, that bill of entry which is filed by the importer, so will be going to the RMS. RMS, there are a lot of officers. The RMS will allocate the bill of entry to the respective officer, and that respective officer need not be jurisdictional officer. That officer will verify the bill of entry and they will be filing customs compliance verification report. So if that customs compliance verification report, whatever they are submitting, if everything is found in order, so which means that so the out of customs charge order will be passed. Suppose if it is not in proper, then the bill of entry is rejected. Again, we need to file a fresh bill of entry. Okay, so this is the faceless assessment, because here there is no jurisdictional officer. We don't know which officer will be doing this customs compliance verification. Okay, so there is no change in the mode of filing bill of entry. It is the same. Only thing, we don't know which officer will do the verification. Then we have the next area, that is import of goods at concessional rate of duty. So this particular import of goods at concessional rate of duty was not tested in the last exam, so maybe it can be tested in this forthcoming exam. That is, first of all, a manufacturer or a service provider is eligible to make some manufacture and sale of notified goods, or is eligible to make some notified services. For making these goods or for providing these services, they can import the goods without payment of customs duty or at concessional rate as per the exemption notification. So now what they will do is that, so they will be importing that goods. While importing the goods, they need to follow a procedure. So that procedure is only given in these rules. First, a manufacturer or service provider is eligible for exemption notification. Why that exemption notification is given? So because they need to manufacture notified goods or provide notified services, but they should not be engaged in providing after sale service. Okay, and that they will import without payment of customs duty or import of goods at concessional rate. And such manufacture, either the person who import the goods can do, or they can get it done through job worker. But in case of jewelry sector, okay, gem and jewelry sector, gold, jewelry, precious stones and metals, so job work is not permitted, which means the one who is importing should only do the manufacture. Okay, and what is the procedure? First, there is an importer who is manufacturing notified goods. For example, you take COVID vaccine. So he is manufacturing COVID vaccine, and for that, whatever raw material that is required can be imported without payment of customs duty. Now he need to submit the information that he wanted to manufacture COVID vaccine, and as per the exemption notification, he can import this much quantity, and that he is importing from which port. So that details he need to submit to his jurisdictional customs ACDC. Suppose if this person manufacturer is located in Coimbatore, Tamil Nadu, so they will be informing to their jurisdictional ACDC Coimbatore that they wanted to import the goods, and that information along with bond will be executed. 2 copies of the information with bond. So then the ACDC of Customs of Coimbatore will be forwarding 1 copy to ACDC of Customs Chennai Port, and when the copy is forwarded to this ACDC of Customs Chennai Port, then that ACDC of Customs Chennai will be allowing this person to bring the goods without payment of customs duty or payment at concessional rate. As soon as the goods are received into Coimbatore factory, so they need to communicate within 2 working days. Within 2 working days that they have received the goods, and that communication should be given to both the jurisdictional officers, ACDC, jurisdictional ACDC of Coimbatore, as well as jurisdictional ACDC of Chennai Port. Okay, so once that is submitted, so then they have to use it only in manufacture of notified goods or providing notified services. If there is any unutilized goods, if there is any unutilized or defective goods out of imported goods, that can be exported without payment of duty, or it can be sold in India on payment of duty along with interest. Why interest is payable? Because if had it been paid at the time, you would have paid. That is, we are clearing the goods from the Chennai port without payment of customs duty, and now we are clearing the goods within India. So now we are paying the customs duty. So therefore, there is a delay in payment of customs duty. So for that, we need to compute the interest. What is the rate of interest under customs? The rate of interest under customs is 15% per annum. Okay, or you can export the unutilized goods without payment of customs duty. Suppose if you want to dispose of the unutilized goods, so for that only, For that goods only we need to pay customs duty along with interest. Okay. What is the information that is to be submitted? So we need to submit name and address of the importer and his job worker. Suppose if the manufacturer details, and if the manufacturer is getting it done through a job worker, the job worker details. What are the goods produced or process undertaken? And what is the nature and description of the imported goods used in above, and nature of the output service rendered using the imported goods. So these are the details that needs to be submitted where. So this importer will be submitting one information with the jurisdictional ACDC na. So these are the details to be submitted. Then what is the maximum period for which the goods can be sent for job work? 6 months from the date of challan, which means delivery challan. So the goods will be sent to the job worker. So the goods should be brought back within 6 months. So but in case of GST, that 1 year time limit is there plus 1 year. All these are not applicable here. Within 6 months, the goods should be brought back. Can the capital goods also be imported under these rules? Yes, capital goods can also be imported under these rules without payment of customs duty or concessional, and that should be used for manufacture of notified goods or provision of notified services. After that, the capital goods can be disposed of in India, and on depreciated value we need to pay customs duty along with interest. Okay, so that should be taken. So value of the imported goods minus depreciation percentage. How to calculate? Depreciation percentage will be like first year 4%, second and third year it will be 3%, and fourth and fifth year it will be 2.5, and thereafter it will be 2%. So that will be depreciated value. So for original value, what is the customs duty payable? For original value, what is the customs duty payable? For the depreciated value, so that much is the proportionate customs duty payable, and on that interest needs to be computed. That's how we need to compute. And then interest, remember, always under customs the interest rate is 15% per annum. When the unutilized or defective goods should be exported, that is this unutilized goods are there now. What is the time limit within which either it should be exported or sold in India along with payment of interest? 6 months. 6 months from the date of import. But for capital goods it is not applicable, only in case of the normal goods. For capital goods we can use it. Okay. Then, so what are the other compliances? What are the goods that are brought into India? How much is used in notified goods manufacture or provision of notified service? How much is sold or how much is exported back? All these details they need to submit on a quarterly basis by 10th of the month following every quarter. So these are the points related to import of goods at concessional rate of duty. Okay. So these are the points that you need to keep in mind. And the next area, that is exemptions under customs. You take a small break for 10 minutes and thereafter we will continue with this exemptions under customs. Okay. So meanwhile, if you have any queries, you can just post your queries related to the discussion what we have made so far from the morning. So up to this procedures under customs. So after the break, I will clarify those queries and I will continue to the exemptions under customs. Okay. Hello, hello. Hello, 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 hello. Okay, so we'll start. Fine. So there are no queries, I presume. So let's start with the next segment number 26. Exemptions under customs. See, in this segment number 26, exemptions under customs, there are total 4 main sections deals with the exemptions under customs. So what are they? So number 1, section 13, section 23, 23 subsection 1, 23 subsection 2 and 22. So these are the 4 main sections that deals with the exemptions under customs. First, section 13 says that there is no duty on the pilfered goods. Pilfered goods means goods which are stolen away, petty thefts. And then section 22 talks about the abatement in case of damage or deterioration. So whenever the goods are damaged or deteriorated, then the abatement will be available under section 22. Then 23 subsection 1, remission of duty. So that is when the goods are destroyed. So 22 is in case of damage or deterioration. But whenever the goods are destroyed, then in that case destroyed or abandoned or lost, then remission of duty. And in case of goods not conforming to the specifications, then relinquishment of title. So try to understand that there are total 4 sections: 13, 22, 23, 1, 23, 2. So 13 is in case of pilferage. Pilferage means petty theft. So then next section 23 subsection 2, 22 is about abatement in case of damage or deterioration, and 23 subsection 1, remission of duty when the goods are destroyed or abandoned or lost. And 23 subsection 2, if the goods are not conforming to the specifications, there is a relinquishment of title. So what is the benefit that is available? In case of pilferage, no need to pay customs duty. So because those goods are not available, no need to pay customs duty. But if the goods are identified back, the customs duty is payable. Until that point of time, the customs duty is payable by the custodian. So custodian is liable to pay the customs duty with respect to the goods. Whereas in case when the goods are brought back, so then that recovery will be from the importer, and whether that is refunded to the custodian or not, irrespective of that, so the importer has to pay the custom duty when the goods are brought back. And then in case of abatement, so we will pay customs duty proportionate to the value of damaged goods. So we need to take the value of the goods. For that, what is the customs duty payable? Now, what is the value of damaged goods? For that, what is the proportionate customs duty payable? So based on the proportionate computation, we need to make. And then in case of abatement, we have seen, so in case of relinquishment of title, no need to pay customs duty at all. And in case of remission of duty, pay customs duty, prove that the goods are destroyed, and then you will get the refund of the customs duty paid. So that is the benefit in case of these 4 sections. And which section is applicable? So suppose before order for clearance, if the goods are pilfered, before order for clearance, if the goods are not conforming to the specifications, then we will be getting relinquishment of title, pilferage. Before order for clearance, first the goods will be unloaded in the port or airport. Thereafter order for clearance will be made. Then either it will be taken for home consumption or for warehouse, and thereafter from warehouse it is cleared for home consumption. Now before the order for clearance, if the goods are pilfered or if the goods are not conforming to the specifications, then section 13 and 23 subsection 2 will be applicable. Suppose if it is before actual clearance, the other 2 cases before actual clearance, that is applicable even before order for clearance and before actual clearance. Which 2 sections? That is remission of duty and abatement. And remember, if the damage is in warehouse goods, yes, abatement is available. If the destruction of warehouse goods, abatement available, and that is a remission available. But if the goods are deteriorated, only at the time of unloading we will get. So deterioration, only before unloading of goods, if there is deterioration, we will get the benefit. But in case of damage, even in case of warehouse goods, we will get benefit. But as the pilferage section 13 and relinquishment of title is before order for clearance, in case of warehouse goods it is not possible. But for warehouse goods, relinquishment of title is given under proviso to section 68, not in this section. So this gives the comparison of various exemptions that are there from section 13 to section 23 subsection 2. Okay, so then we have section 21. Section 21 deals with derelict, jetsam, flotsam or shipwreck. That is any goods that got derailed or which are thrown out of the ship or which continue to be floating, so which is brought into the shore, so are duty payable as if the goods are imported, unless they are admitted duty free by the customs department, customs duty is payable. That is what section 21 says. Then section 20, so it gives the concession with respect to reimportation of the goods. First we are importing some goods. Upon import of goods, we are paying customs duty. Now these goods are exported. For what purpose it is exported? Normally it is exported. Then in that case, at the time of export, are we claiming any incentive? Yes. Upon re-import, just that incentive, if it is paid, that is sufficient. No need to pay the original customs duty on the goods which are re-imported. So no need to pay customs duty on the full value. So just the incentive which we claimed at the time of export, that if we pay, that is sufficient. Suppose if it is exported for repairs, if it is exported for repairs or any other process outside India, upon re-import we need to pay customs duty on the fair value of the repairs plus freight and insurance both ways. That too, if the goods are re-imported within 3 years plus 2 years. If the goods are re-imported after 3 years and 2 years, then we need to pay customs duty on the original value as if the new goods are imported. Okay. So if the goods are exported and that export we got any incentive at the time of re-import, just pay back that incentive. At the time of export, if it is exported for repairs, at the time of re-import you need to pay fair value of the repair. So whatever is the fair value, whether we pay money or not, fair value of the repair should be taken. That is material cost and the labor cost, and then freight and insurance both ways. And this export, if it is subject to export duty at the time of export, upon re-import, whatever customs duty we paid at the time of export, we can get it as a refund. That is covered under refund 26. So that is at the time of export, if we paid any customs duty, upon re-import, we will pay back that customs duty paid. Okay. And that is, we will get the refund of the customs duty paid under section 26. Okay. So that I have not given here because that is covered under refund. I just gave two situations only here. And then even IGST is payable on fair value of repairs. So that is, here when you are importing, this should be taken as the value not only for customs duty, even for payment of IGST also. So that is a clarification given for that May 22 exam, that is applicable. So even before that also we were following the same. Then next one, this is notification number 45/2017. The next notification is notification 60/2018. What does it say? So here it is processing carried outside India. So whereas in the second case the processing will be in India. First the goods are exported and these are imported for carrying out repairs or reprocessing, refining, remaking, etc. And after completing that process, we are sending it back. Suppose if it is brought back for refining, remaking or reprocessing, it should have been brought back within 1 year. Suppose if it is brought back for repairs or reconditioning, so it should be brought back within 3 years. If it is notified goods, 7 years. And if it is from Nepal or Bhutan, 10 years. So this is the time limit for bringing the goods back into India from the time we have exported the goods. And once the goods are brought back into India, so we should complete the process and we should export. And upon import, no need to pay customs duty if you are bringing it within this time limit. So reprocessing, refining, remaking is on account of manufacturing defects. Repair or reconditioning is based on usage. Okay. Suppose if it is notified goods within 7 years, and if it is other than notified goods, it will be 3 years. But this 7 years and 3 years will be taken as 10 years in case of bringing goods from Nepal and Bhutan. And upon import, no need to pay any customs duty. And thereafter, we need to export it back within 6 months, and it can be extended for a further period of 6 months. So therefore, this import do not attract any duty. And imported goods and re-exported goods should be same, and a bond to be executed. If there is any processing loss, it is permitted. Okay, if there is any loss from export to import and import to re-export, that is permitted here. Okay. So what are those notified goods? Certain machineries, computers and color TV, etc. So section 13, we have seen section 20, we have seen section 22, 23 and 21 also we have seen. Now section 24, denaturing or mutilation of the goods. Denaturing or mutilation of the goods means, so whenever the goods that are being imported are capable of twin purposes, and depending upon the purpose, we have the customs duty payable. Now we will make that goods unfit for the other purpose, and we will clear it only for one purpose. So therefore, when we make it unfit for the other purpose, the confusion will not arise, so that we will pay the customs duty accordingly. That is known as denaturing of goods. For example, H2SO4, which is imported into India, diluted attracts a lower rate and concentrate attracts a higher rate. So therefore, we will dilute it and clear so that we pay the lower rate of customs duty that is permitted. Even though at the time of import it is concentrated, but at the time of clearance it is diluted. So we will pay customs duty on the diluted H2SO4 at a lower rate. Same way, mutilation of the goods. Mutilation of the goods means whenever we are importing the goods in one form, but we don't need the goods in that form, we need only in a different form, we can mutilate the goods. For example, we are importing one old car, we don't need the car, but we need the parts of the car, so we'll separate the parts of the car, and remaining body of the car, etc. will be destroyed, and we will remove it like a scrap, so that we will pay customs duty only on the parts of the car and the scrap that is imported. That is known as mutilation of the goods. and central government may make rules regarding the scheme, and duties payable as if the goods are imported in denatured or mutilated form. So that is with respect to section 24. Then we have one section 19. So rate of duty for determination of set of articles. So whenever we are bringing set of articles in a package, so just like composite supply, mixed supply concept is there, na? Like that. So what is that we need to do when we are bringing set of articles? So that set of articles are chargeable to specific duty method. Specific duty method means what? Specific duty method means depending upon the quantity we pay the duty, volume, that is not based on the price, not based on the value, but based on the volume or based on the units of measurement we pay. In that case, there is no confusion because anyhow customs duty is payable based on the quantity. Whereas when the customs duty is payable based on ad valorem, ad valorem means when duty is payable as a percentage of some value, then it is known as ad valorem. Ad valorem again, so if the rate is same, then also there is no problem. Suppose if there is a difference in the rate, so then we need to see whether the separate value can be ascertained. For example, 4 articles are brought having separate values can be ascertained. So then respective rate for the respective value. What if the separate rates cannot be ascertained? We will be taking the highest rate. We will be taking amongst the 4 products, whatever is the highest rate is there, that will be taken and multiplied on a single price. This is just like mixed supply. Suppose if there is an article compels main article and accessories compulsorily supplied along with the main article, then in that case for that accessories also we will be taking the rate applicable to the main article only. So we will not be taking highest rate. So but remember that should be compulsory supplied and that accessories price is already included in the price of the main article. Then we will take the rate applicable to main article only, highest rate will not be taken. Now when you are taking highest rate, there is one problem that is involved, that is whenever there are some non-dutiable goods also, that non-dutiable goods also getting taxed or dutiable at the highest rate. That problem is there in this. Okay, so that is with respect to section 19, import of goods at like different rates of customs duty. Okay. So please explain implication of loading charges and landing charges for valuation of import, which should be included. So that is, we need to include loading charges, but unloading charges at the time of importation should not be included. Loading charges, handling charges, everything will be included, but unloading charges at the time of import will not be included. Okay. So this is about exemptions under customs. Then the next area you can see segment number 27. Assessment and audit under customs. In this assessment and audit under customs, we have total 2 sections. Section 17 self-assessment, section 18 provisional assessment. First, self-assessment means like normally you will file the bill of entry and shipping bill by computing the customs duty payable. So importer will file bill of entry and exporter will file shipping bill by computing the customs duty payable. So these bill of entry and shipping bill which is filed by the importer and exporter will be taken up for scrutiny. So when they are taking up for scrutiny, and not all bill of entries will be taken up for scrutiny, so they will be selecting based on risk parameter basis. Under GST we have self-assessment separate, scrutiny assessment separate. The merger of that self-assessment and scrutiny assessment is there in case of self-assessment under customs. So in self-assessment under customs we have even scrutiny assessment also inbuilt. So therefore when these bill of entries and shipping bills are taken up for scrutiny, and if they identify that the valuation is not done properly or the duty computation is not correct, so then they will do the reassessment. So that reassessment either you can accept and pay, or they will pass a speaking order within 15 days. On that speaking order you can go for an appeal. So first, duty to be self-assessed by importer or exporter in their bill of entry or shipping bill. Verification by the proper officer, that is scrutiny, and then reassessment done by the proper officer if the self-assessment is not done correctly. So either pay that, or a speaking order will be passed within 15 days of reassessment, and on that you can go for appeal. So that is in case of self-assessment. Okay. Then, sir, import in a same vessel for multiple importers also mean import a set of articles? No. By the same importer in the same package, it contains multiple articles. So then only we will be applying section 19. So not different importers. No, same importer, same package, but that package contains multiple articles. So in that case, only section 19 will be applied. For example, remember camera imported, that camera, DSLR camera plus tripod plus SD card plus lens, all these things come as a pack. So for that only we will be taking section 19. Okay. Then we have section 18 provisional assessment. So provisional assessment in customs is resorted only in 4 cases. In case of GST, only one case, that is when the registered person is unable to compute the value or tax, he will make an application for provisional assessment under GST. But under customs, it is not like that. Under customs, the provisional assessment will be resorted by the importer or exporter when making application, or suo motu proper officer can initiate provisional assessment under customs. But under GST, suo motu proper officer will not initiate provisional assessment. But under customs, it is possible. So what are the cases in customs provisional assessment? First, importer and exporter unable to do the self-assessment, or proper officer deems it necessary to carry out the chemical examination or test. So in that case also provisional assessment, or proper officer needs some documents and the documents are not submitted, then also provisional assessment. And the documents are submitted, still the proper officer deems it necessary to have the further set of documents, so then also provisional assessment. So these are the 4 cases where provisional assessment is possible, that can be asked for a short note question. Now what is the procedure for provisional assessment? First, whenever proper officer needs the documents, he will be intimating for want of documents, and within 15 days that documents needs to be furnished. Suppose if the documents is not furnished within 15 days, then an extension of 1 month is given by the officer, and then plus 3 months by customs officer, plus 3 months by ACDC, plus unlimited time by the commissioner. So within that time, if it is not done, then the order for provisional assessment will be passed. Okay, so once the order for provisional assessment will be passed, then the finalization of provisional assessment, whether the documents are submitted or documents not submitted, even after provisional assessment order. After the provisional assessment order, they will wait for 1 month. Within that 1 month, if the documents are submitted, then within 2 months from the date of submission of documents, they will pass the final assessment order. Suppose if the documents are not submitted within 1 month, immediately the provisional assessment will be finalized. Okay, so 1 month they will wait for documents, and that is after provisional assessment they will wait for documents for 1 month. Within that 1 month, if the documents are not submitted, immediately that will be done. If it is submitted within that 1 month, then from the date when the documents are submitted, within 2 months from that date, the final assessment will be done. So upon finalization, that is what is the finalization of assessment, this is the time. Can this time limit be extended? Yes, it can be extended for a further period of 3 months by the commissioner. And upon finalization of the provisional assessment, 3 possibilities could happen, just like GST. So final assessment greater than provisional assessment, final assessment equal to provisional assessment, final assessment less than provisional assessment. If final assessment is greater than provisional assessment, which means that we need to pay the differential duty. But remember, the interest is 15% per annum from the first day of the month in which provisional assessment is resorted. For example, provisional assessment is resorted on 28th of March, from 1st March. If on 25th of March, 1st March, from 15th of March, 1st March. So any day during the month, if the provisional assessment is order is passed, from that month, first day onwards, till the date we pay the differential amount. So the interest will be computed 15% per annum. Suppose if the provisional assessment amount is less than final assessment amount, in the sense like final assessment amount is less than provisional assessment amount, means we will get a refund. So when we get a refund, the refund will be granted within 3 months from the date of final assessment. There it is 60 days from the date we make application. Here it is 3 months. Suppose if the refund is not granted within that time limit, then interest there also 6% per annum, here also 6% per annum. Okay. Then importer at the time of warehousing, so he will be executing a bond, and that bond will be thrice for the amount of duty payable. So at the time of deposit of goods into the warehouse, they will be executing a bond. And what is the value for which bond will be executed? Thrice the amount of duty payable, and they will furnish a security. And upon final assessment, if there is any refund, that refund is subject to unjust enrichment. This point is there even in case of GST. That is, we need to prove that there is no unjust enrichment. So that is, we have not passed on the burden to the next person. If we fail to prove that, then we will not get refund. That refund will be transferred to consumer welfare fund. That refund will be transferred to consumer welfare fund. And this provisional assessment concept is applicable in case of importer and exporter, and any contravention of the provisions of provisional assessment leads to penalty up to 50,000. So in customs, everywhere the penalty is up to 50,000 rupees. So this is about assessment under customs. Then section 99A deals with audit under customs. Like how we have audit under GST, departmental audit, special audit, but under customs we have only one audit. And this audit will be post-clearance audit. It will not be done at the time of clearance of the goods, imported goods or exported goods. After completion of the clearances, then the audit will be conducted. There are 2 types of audit, that is transaction-based audit and premises-based audit. Transaction-based audit means few transactions, few bill of entries or few shipping bills they will be asking. And those few shipping bills or few bill of entries details we need to submit, and they will do the audit. This is like audit of the transactions. And thereafter, if they have identified that there are some discrepancies, then entire premises, all the imports and exports, they will be conducting the audit. That is known as premises based audit. This audit can be conducted either at the premises of the importer or exporter, or this audit can be conducted at the premises of the officer. Okay, and every importer and exporter has to preserve the records for a period of 5 years, and that 5 years from the end of the relevant financial year. In case of GST, it is 6 years from the due date of furnishing annual return, and that records may be manual or electronic. And how the auditee will be selected on some risk parameter basis. Will the CRCMA conduct this audit? No. The audit under customs will be conducted by customs officer, but if they want, they can take the support of CA, CMA or any other person during conducting the audit. Okay, and so contravention of any provisions of the audit leads to penalty up to 50,000. So these are the points that we have in case of audit. And who will be audited? So not only importer or exporter, even custodian, even customs house agent, that is the clearing and forwarding agent, customs broker, warehouse keeper. So every person who is connected with the clearances can be audited. Okay. So then interest on account of delay in payment of customs duty. So this is what I was referring, that there are two options available to the importer for payment of customs duty after filing bill of entry. Number one, immediate payment option. Number two, deferred payment option. And the immediate payment option, once they file the bill of entry and acknowledgement is generated, immediately the same day they should have made the payment of customs duty. Otherwise there will be interest. Mainly for that reason only the electronic cash ledger concept is brought. So therefore you can make a deposit into the electronic cash ledger. Once the bill of entry is acknowledged, immediately the debit will be made from the electronic cash ledger. You don't have to pay, so that the interest will be avoided. So otherwise we need to pay the interest. How much? 15% per annum for the period of delay. And there is another option also, deferred payment option. Under deferred payment option, what will happen? So we need to see the bill of entry is returned with, that is bill of entry submitted during which period. So 1st to 15th of a month. Returned here means acknowledgement generated. So 1st to 15th of a month, we need to pay the duty by 16th working day of that month. 16th working day of that month. Okay. So bill of entry returned for payment from 1st to 15th day of any month. Due date is 16th working day of that month. Okay. Suppose between 1st to 15th, so there is 2 days holidays. So then we need to add the 2 days, and that's where we get the 16th working day. Suppose if the bill of entry is returned for payment between 16th to end of that month, 16th to end of that month, then in that case, so next month first working day is the due date. Suppose if it is month of March, it is 31st March itself, and interest will be payable at the rate of 15% per annum every day delay beyond the due date. For example, if you see, so if the bill is written between 1st to 15th March, so between 1st to 15th March, we have only 2 Sundays. So therefore, 16th working day will be 18th March. 18th March will be taken as the 16th working day. Then between 16th to 31st March, suppose don't see anything, so 31st March will be taken as the due date. Suppose if it is April, so 1st April to 15th April, so we need to take 2 Sundays, so 16th working day will be 18th, that is Monday. Suppose if there is any other government holiday or public holiday, that we need to add. Then between 16th to 30th, if there is any bill that is returned for payment, then we need to pay in the next month first working day. Next month first working day is a Sunday, so therefore we need to pay on 2nd, like that. For the month of March alone, it will be 31st March. For delay, we will be paying interest at the rate of 15% per annum here. And suppose if there is any duty payable on account of reassessment or provisional assessment, they will be passing a provisional assessment order or reassessment order. So that duty has to be paid within 1 working day. Within 1 working day we need to pay, otherwise interest at the rate of 15% per annum. And if it is finalization of provisional assessment, we need to pay 15% per annum from the first day of the month during which the provisional assessment is resorted till the date of payment. Okay, so that is with respect to this duty payable on account of this. So this is regarding the interest computation that we have. So with this we completed assessment and audit under customs. So look into the next area, that is segment 28, duty drawback and refund. Okay, so here there are two concepts in this segment 28, duty drawback and refund. So look into duty drawback. So first, duty drawback is available to an exporter only. So imported goods exported as such without use. So then the duty drawback will be under section 71 sub 74 subsection 1. That is, for example, if the goods are imported for carrying out any exhibition, and if we have displayed the goods in the exhibition, and once the exhibition is over, if the goods are sent back, so in that case we will be getting duty drawback under section 74 subsection 1. So imported goods are exported as such without use, and imported goods are exported as such after use, then that will be 74 subsection 2. For example, imported goods for carrying out the racing, and once the racing is completed, the goods are exported back, so we are using, so therefore the duty drawback will be available under 74 subsection 2. If the imported goods are for manufacture, we completed the manufacture and then it is exported, then we will get duty drawback under 75. So imported goods exported as such, 74 subsection 1 without use, 74 subsection 2 is after use, 75 is imported goods used in manufacture of finished goods which are exported, 75. Now, there is a difference between input tax credit and duty drawback. That is, on import, whatever customs duty we paid, in that IGST component also will be there. Suppose if you are claiming duty drawback, don't claim the refund of that IGST. That is, don't claim the ITC of that IGST. So that is this. In case of section 74, duty drawback covers IGST as well as GST compensation cess, and therefore ITC cannot be availed with respect to the same. However, in case of section 75 duty drawback, the duty drawback covers only the customs duty component. So there on import of goods, IGST paid can be taken as credit. Okay. So we have 74 and 75 duty drawback. 74 is what? Imported goods exported as such, either after use or without use. What is the time limit within which it should be exported? 2 years from the date of payment of customs duty. So it is not the date of import, date of payment of customs duty. It can be extended for a further period by CBIC. Whereas in case of section 75, there is no time limit. Imported goods used in manufacture of finished goods, that finished goods can be exported anytime. And what is the rates of duty drawback? In case of 74 subsection 1, when imported goods are exported as such without use, 98% of the customs duty paid on import will be given as duty drawback. And in case of 74 subsection 2, duty drawback at notified rates. Okay. So what are the notified rates? So in case of 74 subsection 1, imported goods exported as such without use, 98% of the customs duty paid, total customs duty paid, all customs duties paid, we will be getting 98%. So 2% is only the loss. In case of 74 subsection 2, duty drawback at the reduced rates. What is the duty drawback at the reduced rates as per 74 subsection 2? You can see in page number 171. So first we need to see what is the type of goods. If the goods are motor vehicles imported by any person, or other than motor vehicle imported by an individual for personal purpose, so the duty drawback will be after reducing a prescribed percentage like depreciation. So that depreciation, you remember 432.52. Just like how we remember the depreciation in case of imported concessional rate and second hand valuation, the same way. So 432.52, but here it is every year. So for every quarter or part thereof in the first year 4%, for every quarter or part thereof in the second year it will be 3%, for every quarter or part thereof in the third year it will be 2.5%, for every quarter or part thereof in the fourth year it is 2%. Thereafter, sir, what will happen? Thereafter, you will not get duty drawback because already the time limit itself is 2 years. You are crossing the time limit of 2 years. So therefore, after 4 years, you will not get any duty drawback. For example, we are taking the we are using it for a period of 2 years 3 months. 2 years 3 months. So first year, second year. In the third year 3 months. So therefore first year, so we need to take 4 into 4 16%, then second year 4 into 3 12%, in the third year 1 quarter, that is 2.5%, so that is 30.5% will be reduced. For example, on import we paid 1,20,000, 1,20,000 minus 30.5%, so we will be getting the duty drawback like that. Okay. So then in other cases means what? Other goods imported by other than individual for personal purpose, okay, or individual for other than personal purpose, other cases, balancing figure. Now we need to get the duty drawback at reduced rates. How? So we need to first inflate it, like increase it for every 3 months, 0 to 3, 3 to 6, 6 to 9, 9 to 12, 12 to 15, 15 to 18, more than 18. More than 18 you will not get any duty drawback. So now we need to start with 95. It comes down by 10%, 10% for 75, and thereafter it comes down by 5%. So first it will be 95, then 85, then 75. Thereafter it will come down to 70, then 65, then 60, and thereafter it will become 0. Okay. So that is with respect to this duty drawback in other cases. Okay. Now there are some cases where duty drawback is not available under 74. So that is what we are going to discuss. So first we completed the rates and then look into the mandatory prohibition. Duty drawback less than 50, we will not get the duty drawback, and market value of the exported goods is less than the duty drawback amount. So why that will be less than the duty drawback amount? For example, if we are importing the goods and at the time of import the value of the goods is 1 lakh and the customs duty paid is 30,000, and we are using it for a period of, like, we are not using it, we are just keeping it for a period of 18 months and exported it back, we will get 98% of the customs duty paid. But because of 18 months, so definitely the value of goods, the market value of the goods would have come down, so the value of the goods will be now 20,000 only, but duty drawback available will be 30,000 into 98%, so that is 29,400, but the market value of the goods is only 20,000, so we will not get duty drawback. Then 74 subsection 2, 74 subsection 2, which means that imported goods are exported after use, not applicable in case of wearing apparel. So if any garments are imported and if it is exported without use, we will get duty drawback 98%. If it is exported after use, we will not get duty drawback. Same way teachers. Teachers refers to the tea boxes which are imported for doing the packing and then it is exported for teachers, also the same case. That is, we will not get duty drawback if it is imported and exported after use. And expose the cinematograph films. Expose the cinematograph films also the same way. That is, whenever we are importing the film reels and we are doing the recording and thereafter we are sending it after usage, we will not get. And unexposed photographic films, X-ray plates, films, etc. So in that case, these are the 4 products for which duty drawback not available if the imported goods are exported after use. Suppose if the imported goods are exported without use, we will get. So the restriction is only in case of 74 subsection 2 but not in case of 74 subsection 1. Then there is a discretionary prohibition. Discretionary prohibition means central government may notify that no duty drawback shall be admissible if any goods which are likely to be smuggled back to India. So that is where importing goods from Germany and the goods are taken to Pakistan, and there is a possibility that the goods can be brought back into India from Pakistan. So then in that case, so what they will do is that the duty drawback may be disallowed because it may be likely to be smuggled back to India. So then they will enjoy the duty drawback also, then there won't be any customs duty payment. So for that cases, then there can be discretionary prohibition, duty drawback may not be granted. Identity satisfaction, yes, in case of 74, imported goods and exported goods should be the same, and we need to prove that to the satisfaction of the officer. And application, yes, we need to make a duty drawback claim. On application, we need to file in that case. Okay. So that is in case of 74. Now we look into 75. In case of 75, first there is no time limit to export the goods, and rates of duty drawback, we have 3 types of rates. All industry rate. All industry rate means as per duty drawback schedule, they will be specifying for which product what is the rate that we need to pay. So that rate should be taken for the purpose of payment of, for the purpose of computation of duty drawback, and this duty drawback will be computed by the customs and they will be giving. So in the shipping bill itself, we will select the option, so duty drawback. That's the reason why there is no separate application. You can see here that no separate application, shipping bill itself is treated as application. So in the shipping bill itself, there will be one column wherein we will select duty drawback. So automatically the duty drawback will be created as per all industry rate. Suppose if there is no all industry rate for that product, then we will make an application for special brand rate. So special, like brand rate, not special brand rate, brand rate. So then they will be specifying this much duty drawback we will be getting. But remember, the duty drawback under 75 is without recourse to your customs duty paid on import. In case of 74, it is recourse to the customs duty paid on import. That is how much customs duty you are paying. Out of that, a percentage you are getting as a duty drawback. But in case of 75, it is not like that. Whatever is your FOB value of export, on that a percentage you will get as a duty drawback. So that is without reference to whatever is the duty drawback, like whatever is a customs duty paid on import, we will be getting duty drawback under section 75. So which means that section 75 forgets about how much customs duty we paid on import. Due to that reason, it so happens that the duty drawback at the time of export may be less than the customs duty paid on import. And the duty drawback under 75, when they are giving, their objective is to recover only the basic customs duty, additional customs duty and social welfare surcharge, not IGST. Which means that under section 75, so when we are getting duty drawback, still can we take IGST as input tax credit? Yes, the IGST paid on import can be taken as input tax credit. So here, whenever they are giving the duty drawback a percentage, suppose if that money is less than the customs duty burden excluding IGST 80%, less than 80% of the customs duty paid on import excluding IGST, then we can make an application for special brand rate. But remember, first you need to make application for special brand rate. It does not mean first all industry rate and then application for special brand rate. No, you should not make application for all industry rate, directly special brand rate you need to make the application. Means you should not have selected all industry rate in the shipping bill and you need to make application for special brand rate directly. That is this point. Now whatever excess duty drawback, suppose if you have got, you are already enjoying a huge benefit. Now duty drawback amount is more, so then compared to your tax instance you are getting more money, then the duty drawback will be reduced as per rule 4. Then mandatory prohibition. Duty drawback less than 50 rupees, that is same. So suppose if the duty drawback amount is less than 50, we will not get. And the market price of the export goods less than the duty drawback, this is also same. We have, for example, if the value of the goods exported is just 30,000, the market value, but we are declaring it as 4 lakhs. So 10% of 4 lakhs, 40,000. We will not get duty drawback because the market value is less than the duty drawback amount. Same way, another rule is there. The maximum duty drawback will be 1/3 of the market value of the goods. For example, if FOB value of the goods is 1 lakh and the duty drawback will be 30%, 30,000. The market value is 50,000. So definitely market value more than the duty drawback will get duty drawback, but the maximum duty drawback will be 1/3 of the market value of the exported goods. What's the value of exported goods? The exported goods value is 1 lakh. 1 lakh into 1/3 will be market value is 50,000. 50,000 into 1/3 will be 16,667. That is the maximum amount of duty drawback we will get. Okay. Then rule 8. That is no duty drawback if there is a negative value addition. What is the meaning of negative value addition? Negative value addition means that suppose if the value of the exported goods is less than the value of the imported materials used therein. So which means the CIF value of import is less than the FOB value of export, we will get duty drawback. What if the CIF value of import is more than the FOB value of export? There is a negative value addition, we will not get. If it is equal to, we will get duty drawback. If it is less, we will not get. Then another point, suppose if there is any notified value addition percentage, so we need to exceed that percentage, then only duty drawback will be given. For example, 10% is the notified percentage. Our FOB value of export should be, for example, CIF value of import is 1 lakh. What should be the FOB value of export? More than 1,10,000. Then only we will get duty drawback under section 75. Okay. And this discretionary prohibition is same. And then whether any identity to be proved? No, because definitely the imported goods and exported goods are not same. So no need to prove any identity satisfaction. And application, no separate application. So whatever is the shipping bill, that itself is sufficient. Okay. So then interest. So interest, two types of interest is there. Number one, whenever the application is made, but they are not granting the duty drawback within 1 month, then in that case, they have to give us refund, that is duty drawback, along with interest at the rate of 6% per annum. So whenever we make an application for duty drawback, they need to sanction the duty drawback within 1 month. If within 1 month they are not giving duty drawback, they need to give us interest at the rate of 6% per annum after expiry of 1 month till the date of payment of duty drawback. This is payable by government to exporter. Then second case, whenever we got the duty drawback erroneously, we are not supposed to get the duty drawback, but we got the duty drawback, so that we need to pay. Suppose if we are not paying immediately, then from the date when we got the duty drawback till the time we are paying the duty drawback, so we need to pay interest at the rate of 15%. This is payable by exporter to government. Okay. So with this, we completed duty drawback. Okay. Then the next one, baggage. So here you need to remember in this duty drawback that there is something called as section 26A. So section 26A, like that one section is there which says that if imported goods, okay, so that refund under section 26A is also connected here. So refund under section 26A. So what does it say? We are importing some goods. Okay. So imported goods. We have imported some goods, and these imported goods are cleared for home consumption. Cleared for home consumption. Okay. Cleared for home consumption. After clearing it for home consumption, we came to know that the goods are, defective or not conforming to the specifications. Suppose if we know that before, we would have relinquished the title to the goods. But here it is after clearance for home consumption, we came to know that it is defective or not conforming to specifications. Not conforming to specifications. Not conforming to specifications. Then what we can do? So then what we can do is that we can either export it, we can either export it, or we can either relinquish the title, abandon, relinquish, or we can either destroy the goods. Okay, so imported goods cleared for home consumption. Suppose if it is defective or not conforming to the specifications, either it can be exported or relinquished or destroyed. But this relinquishment of title is after clearance from the home consumption. We paid the customs duty. Okay, so we paid the customs duty, So now in this case, what will happen after this? So then we will get refund. So that refund will be 100% of customs duty paid. 100% of customs duty paid we will get as a refund under 26A. So always whenever you are writing 26A in the, that is whenever you are writing 74 subsection 1. So 74 subsection 1 needs to be compared with 26A. So whenever 74 subsection 1 you are writing, so please link it to 26A. So in case of 26A we will get refund, that is 100% of the customs duty paid. Okay. So this is with respect to that imported goods cleared for home consumption, paid customs duty, defective or not conforming to the specifications, either export or relinquish or destroy, then you will get refund 100% of customs duty paid. Then the next area, segment 29, baggage. Baggage refers to passengers' luggage. Passengers' luggage means that like whenever some person is coming into India, they will be bringing some dutiable articles along with them in their luggage. So when they are bringing the dutiable articles along with their luggage, so that will be chargeable to baggage duty. And what will be the rate at which we need to pay baggage duty? 38.5% will be taken as the baggage duty. So this 38.5% when we are paying, then on all articles are we required to pay? No, there are certain concessions. So that concessions only we are trying to understand. So prima facie one concession is there, that is used personal effect is completely exempted. So that is the first point you need to know. Used personal effect is completely exempted. What is used personal effect? Used personal effect means which are used by the passenger. Necessity, not luxury. Not luxury, necessities. So satisfy the daily necessities of that person will only come under used personal effect. Used personal effect, irrespective of the value, it will be exempted. Okay, that's the first point that you need to keep in mind. So used personal effect will be fully exempted irrespective of the value. And used personal effect does not include jewelry, all other articles which are required to satisfy the necessities. That's where many people will be bringing goods into India after removing the tag, opening the seal, etc. So that will be coming under used personal effect. Whatever may be the value, that can be admitted duty free into India. Then next thing, we have a general free allowance. General free allowance, remember total 4 points. So whether the person is coming from Nepal, Bhutan, Myanmar or other than Nepal, Bhutan, Myanmar, simple. Nepal, Bhutan, Myanmar again divided into two. That is coming by land route or other cases. If they are coming by land route, no general free allowance. Other cases, the general free allowance will be 15,000. Okay. Coming by land route, no general free allowance. So coming by other route, the other cases, the general free allowance will be 15,000 when Nepal, Bhutan, Myanmar. Suppose if it is other countries, suppose if the person is coming from other than Nepal, Bhutan, Myanmar, then again it is divided into two. Tourists of foreign origin, 15,000, other cases 50,000. Just 4 points you need to remember. Nepal, Bhutan, Myanmar, and land route, no GFA. Other cases 15,000. So other than Nepal, Bhutan, Myanmar, tourists of foreign origin, So then it will be 15,000. Other cases it will be 50,000 is the general free allowance. Who is the tourist who stay in India? So it's not more than 6 months and he is coming for non-immigrant purpose. He is known as tourist. Okay. Now, while computing the general free allowance, annexure 1 item should not be taken. Means annexure 1 items so will be chargeable to duty, and that annexure 1 items we cannot bring it under general free allowance. So what are those annexure 1 items? So you can see that annexure 1 items here. So firearms, cartridges of firearms exceeding 50. So then up to 50 can we claim general free allowance? Yes. So beyond 50 we cannot claim general free allowance. Then cigarettes exceeding 100, cigars exceeding 25, tobacco exceeding 25. So up to that limits can we claim general free allowance? Yes. Suppose if we are bringing these 3 articles, the rate of duty will be 110%. How? Basic customs duty will be 100% and social welfare surcharge will be 10%. So that will come to 110% will be taken as the customs duty for these 3 articles. Firearms, cartridges of firearms exceeding 50, cigarettes exceeding 100, cigarettes exceeding 25, tobacco exceeding 125 grams. You cannot claim any general fee allowance, whatever may be its value. On that we need to pay 110% as the customs duty payable. Okay, but up to that limits you can bring, and on that general fee allowance you can claim. Beyond general fee allowance we need to pay 38.5%. Okay, then next, alcoholic liquor or wine in excess of 2 liters not covered under general fee allowance. Up to 2 liters is covered under general fee allowance. Gold or silver in any form other than ornaments, so which means ornaments are covered under general fee allowance, but gold or silver in other form, that is gold bars, gold coins, gold biscuits, etc. not covered. LED, LCD, plasma television also not covered under general fee allowance, which means that we need to pay duty. We cannot claim that 50,000 rupees benefit. And in case of 4 and 5, the rate will be 38.5%. How the 38.5% will be? So 35% basic customs duty and social welfare surcharge will be 10% of that. So therefore it will be 38.5%. General fee allowance not available. Okay, so there are 5 articles for which general fee allowance not available: firearms, cartridges for firearms exceeding 50, cigarettes exceeding 100, cigars exceeding 25, and tobacco exceeding 125 grams, and then gold or silver in any form other than ornaments. Then alcoholic liquor or wine in excess of 2 liters, and then LED, LCD, plasma TV. So these cases general fee allowance not available, but in these places wherever we are telling about the limits, there general fee allowance is available, and there 50,000 we can deduct, and beyond 50,000 or 15,000 we need to pay 38.5%. After crossing this limit, general fee allowance not available, and whatever may be the value, even though general fee allowance is available, so we need to pay baggage duty. And what is the baggage duty? First, second and third it will be 110%, and the third, that is fourth and fifth, it will be 38.5%. So this is the customs duty that you need to remember. Rates you need to remember, no other go. These rates you need to remember and you need to apply. Okay. And as baggage already asked in December 21, I am doubtful as to whether it will be tested. Maybe in MCQ it could be tested. Okay. So then infants, there is no general fee allowance for infants, that is up to 2 years. Only personal effects. Beyond 2 years, yes, they can get general fee allowance. Then jewelry allowance is there, rule 5. So what we have seen so far is rule 4, rule 3 and rule 4 general fee allowance, and all these are of baggage rules 2016. Okay, so rule 3 and 4 we have seen. Rule 5 jewelry allowance. So that is jewelry allowance is available only if they are staying for more than 1 year. This point is tested in last exam, December 21 exam. So their stay should be for more than 1 year, then only jewelry allowance is available. Okay, so more than 1 year, their stay should be for a period more than 1 year. That is important. And what will be the jewelry allowance? That is male passenger 20 grams with a value cap of 50,000, and female passenger 40 grams with a value cap of 1 lakh. So first we need to restrict it to the weight, and thereafter restrict it to the value. So that much is only allowed. Remaining value will be dutiable. Okay, first we need to restrict it to the weight, and thereafter we need to restrict it to the value, and the remaining value will be dutiable. And laptop, one laptop can be brought by any passenger more than 18 years of age. 18 years and above, they can bring one laptop, that is duty free. Then next, so what are the entitlements to a passenger who is transferring his residence? So when a passenger is transferring his residence, so he can bring not only the used personal effects but also household articles. But household articles, how much is allowed? You remember the limit. If the stay is 3 to 6 months, 6 for 60,000. If the stay is 6 months to 1 year, 1 for 1 year, 1 lakh. 1 year for 1 lakh. Okay, 6, whatever is the number, 6 months na 60,000, 6 months na 60,000, then 1 year na 1 lakh, and minimum 1 year in the preceding 2 years, 2 lakhs, and more than 2 lakhs, more than 2 years 5 lakhs. More than 2 years 5 lakhs. Okay, so this is with respect to the household articles that can be brought under transfer of residence. But in that household articles, again, no, annexure 1 articles will not be there. Annexure 2 articles also not allowed. Annexure 2 articles are like color TV, video home theater system, dishwasher, then refrigerator above 300 liters, below 300 liters allowed, deep freezer, video camera, cinematograph film of 35 mm and above, gold or silver in any form other than ornaments. These are the annexure 2 items not allowed under this particular transfer of residence. Okay, annexure 1 and annexure 2. Gold or silver in any form other than ornaments is already there in annexure 1 also. Okay, so then other points, all the above provisions are equally applicable to unaccompanied baggage. What is an unaccompanied baggage? The baggage comes which within 1 month after or 2 months before. Remember, A for after, B for before, and A is first alphabet, B is second alphabet. So within 1 month after arrival, 2 months before arrival. A for after arrival, B for before arrival. 1 month after arrival, 2 months before arrival is known as an unaccompanied baggage. For that unaccompanied baggage also, whatever baggage provisions that we are discussing will be applicable, but not that one unaccompanied baggage one time, again accompanied baggage one time. So like 2 times they will get allowances. No, one visit, one time only. One visit, one time only. So either for accompanied baggage or for accompanied baggage, that they need to decide. Then member of a crew. Member of a crew, during the time they are in the service, they can bring the articles up to 1,500 rupees during the time they are in service. So once the service gets over and at the time when they are coming out of their service, so normal, like a normal passenger, they can bring the articles with regular duty free allowances. Then passenger carrying non-dutiable goods or non-prohibited goods should walk through the green channel. If they are bringing any dutiable articles or prohibited articles, they need to walk through the red channel. And for making wrong declaration, there will be penalty. Okay. So next, there is something called as temporary detention of baggage. That is, whenever they are bringing the goods, they can detain the goods in the customs officer's place and no need to pay baggage duty. At the time when they are returning, they can take those dutiable articles. But here, with respect to only declared goods, they can do this temporary detention of baggage, not with respect to prohibited goods or undeclared goods. Okay. And GST rates on baggage, this is what I told you. Firearms not at all allowed under GFA. What is the rate? 110%. Cartridges of firearms up to 50 allowed under GFA. What will be the rate? 38.5 after crossing GFA. And then beyond 50, GFA not available, 110%. And cigarettes up to 100 numbers, GFA available, and after crossing GFA 38.5%. Beyond 100, so GFA not available, 110%. Cigars up to 25, GFA available, 38.5%. After crossing that, 110%. Okay, GFA not available. And tobacco up to 125 grams, GFA available after crossing GFA, so then 38.5. And suppose if it is beyond 125 grams, GFA not available, 110%. So then alcoholic liquor and all is not 110. 110 is only applicable for these articles, not for other articles. Alcoholic liquor up to 2 liters GFA available, beyond 2 liters GFA not available, but the rate will be same, 38.5%. Gold or silver ornaments, GFA available. Jewelry allowance is there na. The jewelry we can even accommodate in general fee allowance. Every allowance is independent of each other. So we after general fee allowance we can claim jewelry allowance, and the jewelry we can claim even general fee allowance also. Okay. So then other than ornaments, GFA not available and 38.5 only. LED LCD plasma GFA not available, 38.5%. So these are the rates that we need to remember. And so I doubt whether this will be tested in the exam for May 22, because already in December 21 they have asked. So if you ask me between duty drawback and baggage, definitely duty drawback is only important. Okay. And those who are watching now, so like today, like we are left with only 2 topics, that is foreign trade policy and warehousing. We will quickly complete that foreign trade policy and warehousing, and today afternoon we are proceeding into the questions related to customs. So in that mighty 50 questions, we have some questions related to customs that we will complete, so that today customs and FTP is over. After completing that mighty 50 questions related to customs, then the remaining topics in GST and the remaining questions in mighty 50 I will complete. Okay, so don't worry. So today whatever you have spent, you have completed 25 marks, that is customs and FTP is in your pocket. If time permits, even after crossing that, you let me know which areas you want me to solve questions from. So those areas also I will definitely do. Valuation, types of customs duties, etc. I will do that. Don't worry. Okay, this is mainly for you because you are watching live. Okay, so then segment 30. So boat note is simple here. Boat note is like whenever the goods are transported from the ship to the shore or shore to the ship, so that goods should accompany a boat note. But when we are bringing goods from the ship to the shore, that should require boat note. When coming from outside India to India, ship to shore, but from shore to ship when we are taking, anyhow shipping bill is there, so boat note is not required. That is the concept. Okay, then next we have foreign trade policy. So look into segment 30, FTP. So this FTP you need to understand, because this FTP, I thought there will be an updated FTP for May exam, but it did not. So the same old FTP, so it is applicable. And first we need to understand the background of foreign trade policy. So foreign trade policy mainly came because government wanted to regulate import and encourage export. Regulating import and encouraging exports cannot be done by the customs department, because which is a revenue department. Their focus is only on to earning the money. So due to that reason, this job of regulating import and encouraging exports have been delegated to Ministry of Commerce. Ministry of Commerce further delegated that work to DGFT, Directorate General of Foreign Trade. So the Directorate General of Foreign Trade will be coming out with the plan or policy as to how to regulate import and encourage export. That plan or policy is known as Foreign Trade Policy, and that is implemented through their regional authorities. What is the act that empowers the DGFT to do this? That is Foreign Trade Regulation and Development Act. So these are the points that you need to understand. So Foreign Trade Regulation and Development Act 1992, and the DGFT will be formulating this foreign trade policy and implemented through their regional authorities. And foreign trade policy set of guidelines and instructions. So mainly it focuses on what to regulate, that is how to regulate the imports and how to encourage exports. So FTP versus customs, the difference is that FTP is the brain, so which tells what to import, what not to import, how to export, and what are the incentives, and the procedure related to that valuation and the consequences will be taken care by the customs. And FTP is a 5-year policy plus annual updation. Okay. So 5-year policy plus annual updation. So for every year it will be updated. So therefore this FTP 5-year policy plus annual updation is there, but the current FTP even beyond 5 years they are making it applicable. It is extended up to 31st March 2022. They have extended this current FTP. What are the contents of FTP? We have basic policy plus export incentives, that is only applicable in syllabus. Then handbook of procedures, forms, standard input output norms, harmonized system of coding, all these things are also there in FTP, but that is not applicable for our exam. So it is only the basic policy plus export incentives. In that, the basic policy we are trying to understand first. Under FTP, imports are classified into 4. That is, which are prohibited, you cannot import at all. Which are restricted, you can import with a license. And reserved for STA, only state trading enterprise can import, you cannot import. And then freely importable means you can import it without any license. Freely importable does not mean without payment of customs duty, that do not require any license. And in the same way, exports are classified into 3: prohibited, freely exportable, and restricted. Prohibited means you cannot export, restricted means export but that requires a license, freely exportable means you don't need any license to export. And what is this license known as? Authorization. Authorization is a license or permission which will be given by Directorate General of Foreign Trade through its regional authorities. And remember, authorization is not a right, which means that when you make an application, if they are not granting, you cannot import those goods. That is the meaning of that. Restricted goods imported are subject to actual user condition. Actual user condition means only the one who is importing should use it and the other person should not be using. But DGFT can dispense with this condition. They can give relaxation with this condition. And every person who is importing and exporting goods should obtain a IEC, import export code, which is nothing but a 10-digit permanent account number only. Okay. And previously it was 11-digit code. Now they have changed it to 10-digit permanent account number itself. Then you can see in the next page, there is one area, principles and restrictions and prohibitions for import or export. So this is applicable for May 22 exam. What is it they are telling? Like, what are the types of goods which can be prohibited or restricted for import and export? What are the type of goods which are prohibited or restricted for import or export? So like maybe a theory question could be asked under FTP. So what are the principles set out for granting prohibition or restriction with respect to import or export of goods? So any 4 points you need to write like that. So why are they restricting? So because to safeguard the India's external financial position and on export of foodstuffs or other essential products, okay, for relieving the shortages, like already it is shortage in India, so they may prohibit that to export. So either to safeguard India's financial position outside India, or when the food products are shortages in India, and for preventing serious injury to the domestic industry, or for application of the standards of regulation, means substandard goods and all should not be imported, or because of import of fisheries, because already we are depending on fisheries. So that is the reserves, marine reserves already we have. So therefore import of that may be restricted, or to promote establishment of a particular industry, they may restrict import of the goods, or to protect the human or animal life, or export and import of gold or silver they can prohibit or restrict, for conservation of natural resources, or because of the obligation under UN Charter, United Nations Charter, or because of the security interest. So like this, these are all the broad principles for which the prohibition can be made or the restriction can be made. Okay, so it's an important area. Definitely I'm expecting a theory question on this. Then the next one is provisions relating to import and export of goods. In that basic policy, so they have given some policy conditions, like first, if you are importing waste and second-hand goods divided into two: capital goods and other goods. Capital goods again divided into two, that is computers, laptops, diesel generator set, photocopiers and air conditioners. So even though it's first hand do not require authorization, but its second hand import requires authorization. Other capital goods do not require any authorization, freely importable. But other than capital goods, any other goods imported as second hand requires authorization. Then waste and scrap always will require authorization. Okay, and waste and scrap, including metallic waste and scrap, so that requires authorization. However, when the SEZ is selling it to DTA, so even though it is deemed import, but generally waste and scrap requires authorization. But when it is imported from SEZ, as SEZ is in India only, that do not require authorization, just the customs duty payment is sufficient. So in this regard, we need to know an important point, that whenever we purchase the goods from SEZ, we need to pay customs duty. That is this. Then import of goods, including capital goods, used in projects abroad for at least 1 year without any authorization, even though these goods imported otherwise requires authorization. Suppose if the goods are imported which are used in a project, as a project we will be importing it, even though it's normally if you import requires authorization, but when you import it as a whole project, so if you are using it minimum for 1 year there, that do not require authorization. Then import or export of gifts. In case of import of gifts, suppose if the gift contains an article which is restricted, we don't know that it contains, like these are restricted articles, so therefore it can be imported, and we need to give a customs clearance permit rather than authorization. If this gift contains an article which is restricted, then customs clearance permit is required to clear the goods from the customs. Suppose if that gift contains an article which is not restricted, to clear the goods from the customs, we don't have to give any customs clearance permit. And at the time of export, so the goods are restricted or not. At the time of export, if it is restricted goods, get the authorization. If it is unrestricted goods, so what is the value up to which you are exporting? If the value of the goods exported is 5 lakhs, then that do not require authorization. But if the value of goods exceeds 5 lakhs, even though those goods are unrestricted goods, but that requires authorization, because why you need to export value of goods more than 5 lakhs for that reason. Then in case of import of samples, vegetable seeds, bees and nutrients, authorization is required. Okay, vegetable seeds, bees and new drugs, authorization is required because these are hazardous to the country and therefore they are restricting it. And tea up to 2000 rupees CAF value you can bring without any authorization, otherwise authorization is required. Same way, any trade samples up to 3 lakh rupees can be imported without payment of customs duty. This is in case of import of samples. Then export of samples, generally it can be freely exportable, no authorization. Suppose if it is restricted goods, then we need to make an application to DGFT. So not requiring authorization, but only DGFT we need to make an application. Even that samples can be exported as a part of baggage. Then re-import of goods exported abroad for repairs do not require authorization. Suppose new goods imported requires authorization. Same goods is exported for repairs, and after repairs when it is coming, for example, imported car requires authorization. So the car is exported for repairs, again re-import, no need to get any authorization. Then import of capital goods under lease financing. So we are bringing it under a lease financing. So we need to just get a permission from the RBI, and then goods already imported without any authorization. So we don't know that requires authorization, we brought it. But for clearance from the customs, can we get the authorization at a later point of time? Yes. But this is not possible for items reserved for STE, because only they should import, you should not import, due to that reason. Then whenever you are importing the goods, then you need to import the goods or export the goods, and you need to execute a bank guarantee. So bank guarantee, letter of undertaking, bond, all these are to be done by the exporter. So that will be with customs authorities for import without customs duty, and with the regional authority for local purchases. Then warranty spares. Warranty spares means, so when the goods are covered under warranty, so that spares which are damaged, so that warranty spares may be exported along with the main equipment or subsequently, but within the contractual warranty period, subject to approval by RBI, because for export of this we will not get any consideration. Then in case of third party exports means what? So merchant exports. In case of merchant exports, the shipping bill shall indicate the name of both manufacturer and third party exporter. So then only the incentives are given to the manufacturer and third party exporter. Okay. And other documents should contain the name of the third party exporter. These are the points that we have in basic policy. Now we have some export incentives. Okay. Sir, import of samples less than 3 lakhs without customs duty is applicable on restricted goods also. Yes, that is applicable on restricted goods also. So that is irrespective of the nature of the goods, restricted or unrestricted goods. So that is without payment of customs duty, but it should be trade samples. Okay. So then, when part 2 of amendments will be uploaded tomorrow, dear, tomorrow morning I will upload the part 2 of the amendments that will be done tomorrow. So now look into this various export promotion schemes. So we have advance authorization versus duty free import authorization for procurement of inputs without payment of customs duty. So we have these two. So first, advance authorization or duty free import authorization is given to an exporter to bring the goods without payment of customs duty. Using the goods, they will be making the finished goods and they are exporting. And what is the difference between AA and DFIA? Both will serve the same purpose. But the major difference is, under advance authorization, we are not required to pay any customs duty on import. Okay, duties that are exempted will be all customs duties, including IGST and compensations also. And that exemption is up to 31/3/2022 they gave. That is IGST and compensations also. But in case of DFIA, only basic customs duty is exempted. But other things we need to pay. Social welfare surcharge we need to pay. Even IGST we need to pay. But for computing IGST and social welfare surcharge, BCD is 0. No, BCD is there. BCD is there. Social welfare surcharge will be computed. And IGST computation also includes BCD. But for payment, BCD is not there. For payment alone, BCD is not there. While computing, you have BCD. But for payment, BCD is not there. And the other things we have. Okay. That is the main difference between AA and DFIA. And in case of advance authorization is subject to actual user condition, which means that, so the one who is having the license should only use, he cannot transfer it. But DFIA can be transferred to any other person once the export obligation is completed. And what is the export obligation? Minimum value addition should be achieved. In case of AA, the minimum value addition is 15%, which means the FOB value of export should be 15% more than this AF value of import. In case of DFIA, it is 20%. And in case of AA, for T, it is 50%. For T, it is 50%. Then what is the period of fulfillment? 18 months from the date of issue of authorization, we need to fulfill the export obligation, whereas DFIA 12 months. Okay. And then applicability to gem and jewelry sector, AA is applicable, DFIA is not applicable. Standard input output norms needs to be fixed for the purpose of DFIA, and AA need not be, then also advance authorization is available. And when it is available, either on pre-export basis or post-export basis. Pre-export basis means first we will import without payment of customs duty, use it for export, and that we will get, that is pre-export. And post-export basis means first we will export, use the local goods and export, and that local goods will be replaced by importing without payment of customs duty. But DFIA always on post-export basis, first you export, how much quantity of local goods used in that much you can import it without payment of customs duty, that is basic customs duty. So therefore post-export it is useful for the next time. Then how to do the value addition? Value addition is simple. FOB value of exports minus AF value of imports divided by CAF value of imports. That should be taken. And while taking this, suppose if any free of cost material is supplied by the person outside India to us, Now you include it in both FOB value as well as AF value for computing the value addition, the notional cost of that materials. Okay. Suppose if we are importing any goods on which duty drawback we claim, that should also be taken for value addition because we are already claiming the benefit not due to that reason. Then the next area will be export promotion capital goods scheme. So we have completed number 1, advance authorization and duty free import authorization. The second one is EPCG scheme. Under EPCG scheme, whatever customs duty that we pay on import of capital goods, so that will be refunded, which means the duty burden will be zero, and how much ever saved duty saved, so including IGST and GST compensations as also, whatever is the duty saved into 6 times we need to achieve as an export obligation, and that should be achieved for a period of 6 years. So for example, duty saved is 100 lakhs, 100 lakhs into 6 times, that is 600 lakhs. So 600 lakhs over a period of 6 years. So for that, what we need to do? First 4 years we need to achieve half, that is 300 lakhs. Remaining 2 years we need to achieve the remaining half. So that is 300 lakhs. So this is how we need to achieve the export obligation. Plus at the same time, we need to have an average export obligation also. What does it mean? Means we need to maintain the consistency. Every year export should be so at least greater than or equal to the average of the 3 preceding licensing years. For the first year it will be 0, second year it will be previous year, for third year the previous 2 years, for fourth year it is the previous 3 years. So that much of average we need to maintain. Suppose if we achieve specific export obligation but not achieved average export obligation, then whatever the incentive that is granted to it, that will be taken back. Okay, whatever the benefit they have given, that will be taken back. That is up to this. Then what is the validity of the authorization? Means what is the time frame within which this can be imported? So the time frame will be like 18 months. So in a time frame of 18 months, we can bring these capital goods. Okay, 18 months from the date when they give the license. And the other conditions, import of capital goods shall be subject to actual user condition. Actual user condition means only the one who is importing the capital goods should use it, and once the export obligation is over, they can sell the capital goods. But second-hand capital goods they cannot import under EPCG. Even prohibited goods also they cannot import. And whenever we take the export obligation, it can be either physical exports or deemed exports also will be counted. And suppose if they have achieved in 3 years time, 75% of the specific export obligation and 100% of the average export obligation in 3 years. So then the remaining 25% of specific export obligation no need to achieve. And under this scheme, capital goods are imported on payment of customs duty. Later, that customs duty paid on capital goods is remitted. So indigenous sourcing of capital goods also can be done, and that will be treated as deemed exports under GST. Under GST, we have seen what are considered as deemed exports. So first, sale to a advance authorization holder, sale to EPCG holder, or sale to EOE will be treated as deemed export. Now, then next. The next one that we have is reward schemes. So these reward schemes, we had 2 reward schemes, MEIS and SEIS. Merchandise export from India scheme and service export from India scheme. But merchandise export from India scheme was considered to be non-compliance with with WTO norms. So due to that reason, the WTO has ordered that India should not give MEIS scheme. So due to that reason, MEIS is omitted, and that's where replacing that we have brought in RODTEP, remission of duties and taxes on exported products. So that is this RODTEP scheme about. What is this scheme about? Already we are getting lot of incentives on exported goods. Like in GST paid, we are getting as refund of unutilized IDT, etc. And duty drawback also we are getting. So still there are some local levies like Mandi tax or octroi, some municipal taxes, local body taxes, etc. on those goods to give the refund of those taxes. For that purpose, so they are bringing this RODTEP scheme, rebate of duties and tax on exported products. But remember, refund is given with respect to only local duties and taxes that were not so far rebated or refunded. So for that only they brought this. And what they will do is that this refund amount will be like a percentage of FOB, and that percentage will be credited to our electronic duty credit ledger. First, a e-script will be created. So for that e-script, whatever is created, that will be there in our electronic duty credit ledger, and that can be used only for payment of basic customs duty. Okay, so that cannot be used for any other customs duty. So this particular RODTEP benefit is like a e-script. is like a e-script, and that will be maintained in electronic duty credit ledger that can be used only for payment of basic customs duty, or it can be transferred to other importers, but it cannot be used for payment of other customs duties. The rebate under this scheme is not available in respect of duties or taxes already exempted or refunded. Okay. Then how the rebate will be granted here? A notified rate as a percentage of FOB value will be given, or sometimes a quantum, a fixed quantum also can be fixed. Okay, and this rebate, whatever is given, is subject to FEMA proceeds should be realized. So what is the time limit within which we need to realize the proceeds? 9 months from the date of export. 9 months from the date of export, we need to realize the profit. So please change there. It's given us 19 months. It's not 19 at all. 9 months from the date of export. So what is the time limit allowed under FEMA? 9 months from the date of export is a time limit allowed under FEMA. So within the time limit, so we need to bring the proceeds. Then only we will get the rebate. Suppose if you are not bringing the proceeds, export proceeds within the time allowed under FEMA, so then whatever rebate that we will never get. Okay. Then ineligible supplies or items. So this you need to concentrate. Ineligible items, you need to remember that. Suppose if you are exporting prohibited goods or restricted goods, you will not be getting RODTEP. Okay. Only it is freely exportable goods. And already you are importing goods and they are exported, so then also you will not get, because imported goods exported already you are claiming DBK. Already you are claiming DBK, na duty drawback, na, that's why. Then exports through transshipment. First of all, it is not coming into India. These are goods not locally manufactured, coming from one country and going to another country. Again, you will claim DBK in that case. So therefore, due to that reason, RODTEP not applicable. Export goods subject to minimum export price or export duty, then also. Then deemed exports not possible, and supplies of products manufactured by DTA to SEZ or free trade zone units, and products manufactured by 100% EOU, because these people are already enjoying a lot of incentives. Okay. Then products manufactured or exported in discharge of export obligation under AA-DFIA. Under AA-DFIA, we have to export some goods now. On that and all, we will not get RODTEP benefit. So these are the ineligible cases for RODTEP. So this RODTEP can be tested because this is an amendment for May 22 exam. So please go through this and go for the exam. Very, very important area. Then SEIS, Service Export from India Scheme. Service Export from India Scheme, when is it available? There is a service provider in India, and yes, so please update that 9 months. Actually, that 9 months you don't have to remember, because that 9 months is given under FEMA. So for just for reference purpose only, I just gave it to you. So that 9 months is under FEMA. Even if you are not remembering that also, it is okay, no issue. And then service export from India scheme. So there is a service provider in India. That service provider in India is making export of services to a person outside India, or if that person is in India also, he can make the export of services, that is to that person. And there are certain conditions. Service provider should be in India, and they should have an active IEC, import export code. And what should be the minimum NFE? NFE refers to net foreign exchange earnings. Net foreign exchange earnings means income in forex minus expenditure in forex. That is known as net foreign exchange earnings. So that NFE should be there. And how much should be that NFE? That should be $10,000 in case of individual sole proprietorship and $15,000 in case of others. Okay. So that should be there, then only they will be getting SEIS benefit. Sir, how much they will get? A notified percentage. How that notified percentage we need to remember? No need to remember. It will be given in the question itself. That notified percentage will be given in the question, and that notified percentage we need to multiply on that NFE, and we need to get that as the credit. So that will be like a script, SEIS script. What we can do with that SEIS script? We can use it for payment of basic custom duty, or we can transfer it to any other person. Okay. So how the frequency is? Here the frequency is on a yearly basis, but that RODTEP is every time we export. But here it is like a yearly basis. So within 12 months from the end of the relevant financial year, we need to make the claim. And supply of service from India to any other country, or service consumers of any other country, which means a tourist is coming to India, to him we render the services and we collect the payment through his international credit card. Will that also be counted for NFE, income in forex? Yes. And there are few things which will not be considered for computing NFE. That is, telecom sector is ineligible. Then investments and capital receipts, because those are not incomes. Those are all like capital receipts. So that will not be taken. Foreign exchange turnover by healthcare institutions or education institutions like equity participation, donations also will not be taken. Foreign exchange earnings for services provided by airlines, shipping lines, flying from a foreign country to another foreign country without touching India at all. So that whatever income generated will not be taken. Payments for service received from EFC account, that will not be taken. Suppose if there is any income generated outside India, that will not be taken into income in forex. Okay. Then the next area will be status holder under FTP. So status holders are the exporters. Status holders are the exporters. So these exporters, so upon achieving a export performance, will be granted a percentage of the export. That status will be given. What is that export performance that we will take? Okay. So SEIS can be available for each service wise or exporter wise for every service provided by him. No, annual basis. Exporter wise on an annual basis. Yearly we need to see the gross income. So that is income in forex minus expenditure in forex for the year, not service wise. All the services accumulated. So NFE we need to find out. On that we will be making application for a yearly basis. Okay. So now come back to status holder. That is, there is the export performance here. How that export performance will be computed? We will take the current year exports plus the previous 3 years exports. We will take current year exports and previous 3 years exports, and then we will be counting the export performance. Okay. And how the star status will be given? If they have achieved $3 million 1-star status, then $25 million 2-star status, $100 million 3-star status, $500 million 4-star, $2,000 million 5-star. So 3, 25, 100, 500, 2,000. So that much they need to achieve. How many times they need to achieve this? In a block of 4 years, 2 times they need to achieve. Once they achieve it, they will retain that status. So that status will not come down. And again, when they achieve it next time, like in the sense like $3 million they achieved twice in a period of 4 years, they got 1 star. Then again they will not come down, they are 1 star only. Again, when they achieve 25 million 2 times in a block of 4 years, then they will get 2-star status like that. Okay. So now when they get this star status, what are the benefits? Authorization and customs clearance on self-declaration basis. So no need to do it under the supervision of the proper officer. Then standard input output norms fixed on priority, and they are exempted from furnishing bank guarantee. 2-star export warehouse and above can get the license to establish the warehouse, and green channel clearance for above 3-star. Green channel clearance means what? No physical verification of goods, no physical examination of goods, no physical examination of goods. So just the documents will be done, checked. Okay, no physical examination of goods, and they will be given a certification as to made in India, and all status holders can export on free of cost basis for export promotion subject to 2% of the average annual export realization during the preceding 3 licensing years. So they need to take 3 preceding licensing years. So that 3 preceding licensing years, how much is the annual export realization into 2% on free of cost basis, they can be sending the goods other than restricted items. Okay. For gem and jewelry sector, it is 1 crore or 2%, whichever is lower. And so this point we have seen. Then export promotion zone scheme, EPZ. What are various export promotion zones? EOU, EHTP, STP and BTP. These are called as export promotion zones. What type of business can be done in these zones? Any business can be done, manufacturing or service sector, but trading units are not allowed. And there is a positive NFE condition they need to achieve over a period of 5 years. So the status given for 5 years only, and after that they need to again make an application. What if they could not achieve for a period of 5 years the positive NFE? Then that can be extended for a period of 1 year. And already there is a unit in DTA. If they want to convert into unit in EOU, so for that 50 crores should be there in plant and machinery investment, or the turnover should be 50 crores, not necessarily both. Either plant and machinery investment more than 50 crores or turnover more than 50 crores. And what are the tax implications? If they are importing any goods, they don't have to pay customs duty. That's the benefit that they have got. On export also no customs duty, and other things are related to GST. That is, on import of services they need to pay IGST, and on local procurements also there are two options, because it is deemed export under GST. So the supplier may recover GST or may not recover GST, and if they recover GST, whatever GST paid, that they will get as a refund, and whatever supplies they make to a recipient in India, that will be normal sale, and exports will be zero rated, so they will get refund of unutilized ITC. And even IGST and GST compensations on import is also exempted up to 31/3/2022. Who can establish an EOU? Is there any investment criteria? Yes, they should make a minimum investment of 1 crore in plant and machinery for establishment of EOUs. Okay, but this is not applicable for others. And they need to get a board of approval for establishment of EOUs with lower investment criteria, and they can make clearances to DTA, but only certain percentage of their production they can clear in DTA. And exit from EOU scheme, so whenever they wanted to exit, they can exit of that scheme, but subject to payment of applicable GST. Okay, so that is there as exit from EOU. Then, sir, should EOU, HTP, STP, etc. be located in SEZ? No, they are separate. SEZ is a area. So this EOU, EHTP, etc. and all these are like units, businesses. Okay, so not necessarily that they should be in SEZ. Okay, then deemed exports. There are certain cases which are treated as deemed exports. What are they? So already we have 3 deemed exports under GST, that is deemed exports even under FTP, that is supplied to advance authorization holder, supplied to EPCG holder, and supplied to EOU. So that will be coming under deemed exports. Apart from that, projects, that is international competitive bidding project and projects financed by UN or international organization, nuclear power projects. So these are the projects which are considered as deemed exports. So for these projects, when we are selling, that will be treated as a deemed export. Okay, so what is the advantage in FTP for deemed export? That is, if I am making deemed export, I can import goods without payment of customs duty, like advance authorization, or if I pay customs duty, I will sell it to these people and get the refund, that is duty drawback. These are the 2 benefits that are available in case of deemed exports. Okay, then contravention of any provisions will lead to a penalty, and that penalty will be decided by the DGFT. So with this, we completed FTPR. Then warehousing under customs. See, warehousing under customs, if you see, I just gave some brief information only here, and in exam, because it is a new chapter, so there can be some good number of questions that could be asked on warehousing under customs. So what I request you all is that I will just quickly discuss this, but you don't believe, like we don't depend on this alone. So I have uploaded a video on warehousing under customs in my YouTube channel. So in my YouTube channel, it is there along with the PDF. So please go through that. It's approximately some 3 hours video on warehousing under customs. In detail I have discussed. So I request you to please go through that with some 1.5 or 2x speed, and that is really required because it's a new chapter. I request you all to go through that. Then, so look into this warehousing under customs. So warehousing under customs, first of all, whenever the imported goods are there, these goods can be imported into port or airport, and that good should be cleared within 30 days. Within 30 days, either it can be cleared for home consumption or for warehousing. When we are depositing the goods in warehouse, so we need to file one bill of entry, that is bill of entry for warehousing or into bond bill of entry, and these can be deposited into the warehouse. And what are the types of warehouses? So we have 3 types of warehouses: public warehouse, private warehouse, and special warehouse. Okay, and this can be deposited, the imported goods can be cleared and deposited into the warehouse without payment of customs duty, but bond needs to be executed. So what is the value for which bond to be executed? 3 times duty payable. 3 times duty payable. 3 times the duty payable, we need to execute a bond. And when it is public warehouse, suppose if I own warehouse, my goods can be imported and other person's goods also can be imported, then this warehouse is known as a public warehouse. Suppose if my warehouse only goods imported by me can be deposited, that is known as private warehouse. And special warehouse means only some notified goods can be deposited, that is known as special warehouse. All these three warehouses are licensed by the commissioner. In that, public warehouse and private warehouse will be under records based control, which means they will not be under the physical lock and key, whereas special warehouse will be under the physical control, lock and key of customs. Okay, then so what is the period for which we can deposit the goods to the warehouse without payment of customs duty? So that is in case of EOU, EHTP, STP or private warehouse, till the time it is cleared we can deposit, no need to pay interest. But other warehouses, 1 year is the maximum time limit allowed for deposit of goods in the warehouse. If it is perishable goods, they will give a lesser period also. And then within 90 days you need to clear, otherwise interest will be payable at the rate of 15% per annum from 91st day. This 90 days and 1 year will be counted from the warehouse order, not from the date of import. Okay, and even we can do manufacturing and other operations inside this warehouse. So once that is over, that is, so from the warehouse we can do any three clearances. Either it can be taken for another warehouse. When you take it to the another warehouse, no need to file bill of entry because already bill of entry is filed, and no need to execute a new bond. The same bond will be continuing and no need to pay customs duty. Suppose if it is taken to the importer's place, yes, an ex-bond bill of entry needs to be filed and even customs duty is payable. And there is one case or Rayan case. If the goods are not cleared within the permissible warehousing period, on expiry of permissible warehousing period, the goods are deemed to have been removed, and on that day whatever is the rate that is there, that should be taken. However, the interest is computed till the time you actually clear the goods. Okay, and then suppose if you are taking it for export, then no need to file bill of entry because you are taking it for export. There is no import at all and no need to pay customs duty. Now remember, when there is no customs duty, no need to pay warehousing interest. So because after 90 days we are exporting, there is no customs duty payable, then warehousing interest also will not arise. Okay. So then, what are the owner's rights with respect to the goods? They can inspect the goods, they can sort the goods, and they can show them for sale. And so they should ensure that there is no loss of goods, because if there is any loss to the goods, then their customs duty will come down. Now, abatement, section 22. Customs duty will be payable based on the reduced value of the goods for that reason. So with this, we completed entire customs and FTP. Hardly, it is what, some 3 hours 10 minutes only. So the entire customs and FTP we have completed, and appendix B is about meaning of various turnovers that I discussed in GST itself. Now with this we will stop the session, and we need to do the problems and solutions related to this. And what we have is that, like, few topics of GST is remaining, that is payment process, advance ruling, returns, and that segment 20, liability to pay tax in special cases, etc. Okay, so that we will complete in today's afternoon session. So with that, the entire That's It book revision will be completed, along with that 50 questions. Okay, thank you. So we will take a break now. We will meet at 2:30 and we will continue with the remaining discussion. Okay, so first we will do problems and solutions. So take rest for some time. So we'll do problems and solutions. Thereafter we will continue with the remaining aspects. Okay, yes, thank you. 2:30 the class will resume. So please ask your friends also to join, because there is a problems and solutions discussion on customs, that's why. Hello friends, welcome back. So in our morning session, we completed customs and FTP, and now we are going to discuss few questions related to that. Yes. Have a look into question number 43. Have a look into question number 43 related to this. Good afternoon everyone. Look into question number 43. So we are going to complete now some 7-8 questions which are there related to customs. So page number 70, question number 43, have a look into that question. Determine the safeguard duty payable by X Limited, Y Limited and Z Limited, A Limited under section 8B of the Customs Tariff Act from the following. Import of sodium nitrate from developing and developed countries from 26 February 2018 to 25 February 2019, both days inclusive, are as follows. So whenever safeguard duty is levied, so safeguard duty when it is levied, we will see for the last 1 year, if we are importing from one developing country or more than one developing country. Okay. So now if here you see more than one developing country, correct? More than one developing country. Now, developing country with each less than 3% taken together. So therefore, take X Limited. X Limited how much? 70 divided by 2500. So 70 divided by 2500 will be 2.8%. Then again next. So 82. 82 divided by 2500. So into 100. So 3.28%. Now next 52. 52 divided by 2500. So will be coming under 2.08%. Then 50 divided by 2500 into 100, that is 2%. Okay. So now what we need to do is that less than 3% you group together. Less than 3% you group together. Okay, less than 3%. These three. Cumulatively you see. Cumulatively 2.8 plus 2.08 plus 2. So that is 6.88. Okay. So that does not exceed 9%. So therefore, X Limited, Z Limited and A Limited import from these three countries does not attract safeguard duty. Okay. So import from three countries does not attract safeguard duty. What are those three countries? So X Limited, Z Limited and A Limited. What about import from Y Limited? Definitely that attracts safeguard duty, and other countries also attract safeguard duty. But the question they have asked is only about X Limited, Y Limited, Z Limited and A Limited. So due to that reason, about that only we are writing that except Y Limited, in the first, like other three cases, there is no safeguard duty, because we have that point, imports from each country with less than 3% taken together does not exceed 9%. So this question is based on that. Okay. Then question number 44. Product Z was imported by Mr. X by air. The details of the import transaction are as follows. Price of Z at exporter's factory $8,500. Freight from factory of the exporter to the load airport. So airport in the country of exporter $250. Loading and handling charges at the load airport $250. It's a very important question. Please focus. Okay. Freight from load airport to airport of importation in India 4,500. Insurance charges 2,000. Though the aircraft arrived on 22/8/2018, the bill of entry for home consumption was presented by Mr. that is X on 28/2018. So therefore, for exchange rate, we will take which date? Date of presentation of bill of entry, that is 28. So 28, what is the exchange rate by CBIC? 60 rupees per dollar, that will be taken. And for rate of duty, what we will do? Date of presentation of bill of entry or grant of entry, that is arrival of the aircraft. In case of aircraft, date of presentation of bill of entry or arrival of the aircraft, whichever is later. Which is later? 22/8 is later. So therefore, we will be taking 10%. We will be taking 10%. Okay. So therefore, for the purpose of exchange rate 60 rupees per dollar, for rate of duty we will take 10%. So now, first we need to compute the value. So here it is imports by air. When it is imports by air, what we will do? So first we will take FOB price plus insurance plus freight. So that's where you will be getting CIF price, correct or not? So therefore, what is taken as FOB price? FOB price will be price prevailing at the exporter's port. So therefore, 8,500 plus 250 plus 250, because price prevailing at the exporter's port or airport should be taken as FOB price. So therefore, what will be taken as FOB price? $9,000 will be taken as FOB price, plus insurance will be how much? $2,000. Then what will be taken as freight? Freight will be 20% of FOB. So what we will do? 9,000 into 20%. 9,000 into 20%. 1,800. But don't do 1,800, because this 1,800 when you are taking, when you take 20% of FOB, ICI study material took one assumption. That is, when you take 20% of FOB, that is for cost of transportation from the factory of the exporter. So that is for cost of transport from the factory of the exporter. So when you take 20%, that 20% is for cost of transport from the factory of the exporter, means 1,800. So $1,800, but wait. From this $1,800, you take out 250. Why, sir, you should take out 250? Because already that we included in FOB. And another 250 loading charges also you take out, because that we include in FOB. So which means how much will be taken towards the freight? The freight will be taken as 1,300. The freight will be taken as 1,300. Okay, again I am repeating, when we take 20% of FOB, so that 20% of FOB is for cost of transport from the exporter's factory. That's how it is assumed by ICI. So therefore, in ICI study material it is given that way. So that's the reason why we need to follow. If you ask me for CMA and CS exams, so that is 9,000 plus 2,000 plus 1,800 will be the answer. For CMA final and CS professional program, that itself is the answer. But CA Institute is taking a view that 20% of FOB when you take, that is from the load airport, that is from the factory of the exporter till the port of import or airport of import, due to that reason. So which means 9,000 plus 2,000 plus 1,300, that will come to 12,300. So 12,300 will be taken as the answer. Is it clear or not? So actually approach 1, so 12,800 is the answer. Again I am repeating, approach 1, 12,800 will be taken as the answer. Why 12,800? 9,000 plus 2,000 plus 1,800, 12,800 will be taken as the answer. But that is not at all being followed. So that is not being followed. So ICI is following a different approach. So as per ICI, it is 12,300 only should be taken. Okay. So this is for CA Institute. So as you are writing CA final exam, you need to please follow 12,300. If you are writing CMA final or CS professional exam, you can take 12,800. And what will be taken as the exchange rate? 60 rupees. And when you convert, you will be getting value. Okay, 12,300 into 60 rupees, that will be 7,38,000. Then customs duty at the rate of 10% and social welfare surcharge. Okay, so 10% of 73,800. So 10% of 73,800 will be coming to what? 7,380. So then on that IGST is given in the question as 12%. Okay, so for IGST also we need to take the same 22 date. date of presentation of bill of entry or arrival, whichever is later only should be taken. So 12% should be taken. So the 12% IGST is computed. That's where we got the total customs duty payable. Understood or not? So mainly in this place, what is the assumption taken by ICA? You please keep in mind, whenever we take 20%, that 20% is from the factory of the exporter to the port of importation or airport of importation. But whatever is the cost up to the port of exporter or airport of exporter will be part of FOB. So that adjustment, whatever we have added for FOB should be adjusted from the freight. So this point you please keep in mind, okay? Then look into the next question. Mr. X imported certain goods from a related person, Mr. Q of US. So whenever goods are imported from a related person, transaction value not applicable and the transaction value has been rejected. Rule 4 and 5 of the import valuation rules are found inapplicable. Rule 4 is what? Identical goods. Rule 5 is what? Similar goods are found inapplicable and no similar or identical goods are imported into India. Mr. X furnishes the cost data of imports and requests customs authorities to determine value accordingly as per Rule 8. The relevant data is as follows. Cost of materials incurred by Mr. Q, $2,000. Okay. So that therefore this is what method? Rule 8 is computed value method, not deductive value method, computed value method. In computed value method, what we will do? We will take cost of production plus usual profit margin plus freight and insurance up to the port of importation. Okay. So first we need cost of production. For this cost of production, we will be adding, profit margin. Usual profit margin will be added. And thereafter freight and insurance will be added. So when you add that freight and insurance, that's where you will be getting computed value. Okay. So first we will see cost of production. Cost of materials incurred by Mr. Q, $2,000. We will take it in cost of production. Fabrication charges incurred by Mr. Q, $1,000. That also we will take. Conversion cost. Other chargeable expenses incurred by Q, $400 we will take. Other indirect cost also, yes. Freight from Q's factory to US port, that is also part of cost. And loading charges at the US port, that is also part of cost. Now, if you take this total, point number 1 to point number 6, you will be getting some cost. Please do how much? 2000 plus 1000 plus 400 plus 250 plus 250 plus 100. That will be $4,000. So $4,000 will be taken as the cost of production. So we are taking $4,000 as the cost of production. Then what is the usual profit margin? So they are telling the usual profit margin will be 20% of FOB. So that is 20% of FOB. We need to find sale price. On sale price it is 20%. Then on cost price it is how much? 20 by 80. 20 by 80 on cost. So 20 by 80 on cost means what? 25%. Okay. So usual profit at 25% of cost. They have given 20% of FOB. Only when you add profit you will get FOB. So therefore we need to take 25% of cost. So 4,000 into 25%, that will be coming to $1,000. So when you take $1,000, we got the FOB. Okay. So the sum of these two will be known as FOB price, that is $5,000. Then freight. How much we will take as freight? The freight will be taken as 20% of FOB. 20% of FOB means 5,000 into 20%, 1,000. But stop there. When you take 20%, that is for freight from the port, that is freight from the factory of the Q to the port of Q, airport or port of Q. So when you take 20%, cost of transport from his factory is included. What is the cost from his factory? $250 and $100. So from his factory, what is the cost? $350, which is already there. So in this 1,000, already in this freight, $1,000, 350 is taken in the FOB. So therefore remaining we need to add. What is that remaining? 1,000 minus 350, that will be $650 will be added as freight. And insurance. See here it is given as air freight. That's why we are taking. Air freight will be actual or 20% of FOB, whichever is lower. Okay. So therefore, as it is given as air freight, that's why we are taking it this way. What if air freight is not given? Directly actuals we would have taken 1500. So 1500 we would have taken as actuals. We will not do all this comparison. Okay. So $650 and insurance will be how much? Insurance will be $50. So therefore, please do the total. $5,700 will be taken as the value. $5,700 will be taken as the CIF value. Okay. 5,700 will be taken as the CIF value. This is as per ICI. This is as per IPI. Suppose if you are writing CMA final or CS professional exam, so what you need to do is that 5,000 plus 1,000, 1,000 will be taken, 20% of FOB plus 50. Then the answer would have been $6,050. Okay. And then suppose if air freight is not given, what will you do? If the word air freight is not given, actual freight is there, na? So then we will take actuals. So when you do actuals, don't say already few thing is included minus nothing like that. So therefore we will take 5,000 FOB plus actual air freight 1,500 plus insurance 50 will be taken. So 6,550 will be the answer. Okay. But in this case, the answer is 5,700. Convert into Indian rupees using 70 rupees. You will get the value under Rule 8. Then next, question number 46. Question number 46. It is product Z was imported. I think it got repeated. So yes, it got repeated. See, just like this question only, product X imported by product Z was imported by Mr. X by air. So it got repeated here, question number 46. Okay. So 12,300 same. This question got repeated. Okay, sorry for that. And so I will replace it with another question, don't worry. So this got repeated. So then question number 47. Sir, is the ICI view correct as per the law? No, it is not correct as per the law. But for exam, we need to take ICI view only. So because law is silent, law they use the word, the cost of freight will be, the cost of transport shall be 20%. But the cost of transport from where is not given in the law. As the law is silent, that's where this interpretation came. Law is silent because of that. Then, if we want to include freight in 20% and while computing cost of purchase, we can ignore that freight cost. No, we cannot ignore, because while taking the cost, so we need to add that cost also, because we need FOB price. FOB price means price prevailing at the exporter's port or airport. So we need to definitely take that in cost. Okay. Then question number 47. Kankan Corporation had imported a machine from USA for 365 lakhs on payment of appropriate customs duty in February. However, in July, the machine has to be sent back to supplier for repair, not amounting to manufacture, from the factory of Kankan Corporation. The machine was repaired and thereafter re-imported by Kankan Corporation in November next year. The supplier has agreed to provide discount of 40% of the fair cost of repairs, resulting in Kankan Corporation paying $12,000 when exported goods are for repairs, and after repairs when it is brought back, we need to pay customs duty upon re-import for fair value of the repairs. What is the fair value of the repairs? Fair value of the repairs, see this, the supplier has agreed to provide 40%. No, it is not that. So there is a different machine that is coming. If the same machine is coming, then we need to take fair value of repairs. But a different machine is coming. The machine was repaired and thereafter re-imported. The supplier has agreed to provide 40% of the fair cost of repairs, resulting in Kankan Corporation paying $12,000. Okay. So then we need to take $12,000 or full value. Full value should be taken. Why full value should be taken? Fair value of the repairs. So first, if a new machine is coming, we need to pay on the value of the machine. That is 365 lakhs will be taken. Suppose if the same machine is coming on fair value of repairs. So $12,000 is for what? Is after 40%. So which means this is 60%. So if you take 100%, how much it will come to? 12,000 divided by 0.6. That is $20,000 will be taken as the value. Okay. So 20,000 will be taken. 1 second. agreed to provide 40% of the fair cost of repairs. You change this to 60% of the fair cost of repairs. You change that to 60% of fair cost of repairs. So which means they are giving 60% as the discount. Then what we pay is 40%. The 40% is 12,000. Then what will be the 100%? 40% is 12,000 means 100% will be 12,000 divided by 0.4. That is $30,000 will be taken. Okay. So we will be taking $30,000 as the value. Okay. So 12,000 divided by 0.4. What is the logic? How much discount is given? Thereafter we pay the remaining amount. But so suppose if 60% is the discount, so then 40% only we pay. If 40% is 12,000, 30,000 is a fair value. But we should take fair value, not how much amount we pay. So what is the fair value of the repairs? 30,000. Then freight and insurance both ways. So what is that freight and insurance both ways? Whether that information is given here, freight and insurance both ways? No. So therefore we need to convert this into Indian rupees. So what will be the rate? Date of presentation of bill of entry or arrival, whichever is later will be taken for rate. So for rate we will take 15%, and for exchange rate we will take bill of entry date, that is 62. So we need to convert it into 62. So 30,000 rupees into 62. So $30,000 into 62, that will be 18,60,000. Okay. Then freight and insurance should be taken. So that freight and insurance should be given in the questionnaire. Actually in this question the freight and insurance information should be given. Okay. So in the absence of that freight and insurance, we will not be able to take. So therefore this inward and outward insurance and inward and outward freight. So assuming that it is like this is given in the question. Actually there is some information that is missing in the question. So that will be given in the question. So we will be taking that. That's where we will be getting assessable value. For the assessable value, so then basic customs duty will be at the rate of 15%. Then social welfare surcharge and IGST will be 12%. So that's how we need to arrive at the answer. Understood or not? So this freight and insurance is given in the question. That information is missing here. Okay. So that table is there. Freight and insurance table is there. That is missing. So that's where we will be getting this. I will rectify all these things and I will share with you the revised PDF weight. Okay. So then that will be the total customs duty payable. Then look into question number 48. Abdul Overseas Private Limited was erroneously refunded a sum of 30,000 rupees in excess of actual duty drawback on 16/6/2020. A demand for recovery of the same was issued by the department on 24/8/2020. Abdul Overseas Private Limited returned the erroneous refund to the department on 16/10/2020. You are required to calculate the interest. Is this payable by the exporter to the department, or department is giving that to the exporter? Exporter is paying it to the department. Erroneous duty drawback. Now in the case of erroneous duty drawback, okay, so we need to compute from within from the date when we got the refund. When we got the refund on which date? So 16/6/2020 we got. And when are we paying it? So recovery is made on 24. Return the refund to the department on 16/10. So therefore count the number of days. That is, don't count 16. So count the next day. That is 17. So in June, 30 minus 16. That is 14 days in June. July 31 days. August 31 days. September 30 days. October 16 days. So for 122 days, we need to pay interest at the rate of 15% per annum on the erroneously duty drawback amount. What is the duty drawback amount? 30,000. 30,000 into 15% into, so 122 divided by 365. That will be 1,504 will be taken as the interest. Okay. Then next, 122 days will come here. Then question number 49. PMR Limited, a service exporter of specified service having net free foreign exchange earnings of US dollar 20,000, NFE of $20,000 during preceding year, requires you to compute its duty credit strip. Actually previous year is irrelevant. So current year only we need to take. Current year the NFE should be crossing $15,000 for BMR Limited. Now current year information, supply from India to US dollars. So supply from US dollars, India to US, how much? 30,000. So we will take the 30,000. Then supply from India to service consumer of US in India, that will also be taken into income in forex. Supply from India through commercial branch in a city of US, that is an income which is received outside India, that will not be taken. Supply from India through presence of employees in another city, again that income is accruing in the other country, that will not be taken. Okay, and there is an expenses. The total expense or payments of BMR Limited relating to aforesaid supplies are 5% of gross receipts in foreign exchange. So which means from this 30,000 and 12,000, 5% should be taken out. Okay. So therefore 30,000 plus 12,000 minus 5% is $39,900. $39,900. BMR Limited also informs that it has received loans of $5,000 from US. Loans of $5,000 from US will not be taken into income. And another amount of 2,500 on behalf of a client who is also an exporter. So on behalf of another person is received will not be counted towards their NFE. And 39,900 only will be taken. And 39,900 into 5%, that is 1,995 will be taken. Okay. Now, actually current year, it should be more than $15,000. So current year more than $15,000, actually preceding financial year is irrelevant. So current year only we should see. Current year more than $15,000. So yes, they can go for SEIS benefit, and 5% of that 1,995 will be credited to them. Then question number 50, the last question here in customs. X Limited imported a machine from USA under EPCG scheme with zero customs duty in the financial year 15-16 for production of product P. Customs duty otherwise payable is 20 lakhs. Find the specific export obligation and average export obligation. Exports of finished goods P in the preceding 5 licensing years are as follows. So you need to take average export obligation. What will be the average export obligation? First year 0. Second year, the previous year will be taken 40. Third year, the previous 2 years average 40 plus 20 divided by 2. So that is 30. Then again next year we will be taking 40 plus 20 plus 25 divided by 3. So 28.33. Then again 40 plus 20 plus 20 plus 25 plus 15 divided by 3, that is 20. Then again preceding 25 plus 15 plus 15 divided by 3. So 18.33 lakhs will be taken. Okay. So this is how we got. And whether we achieved in the first year by default, yes. Second year, no. Third year, no. Fourth year, no. Fifth year, no. Only sixth year we achieved average export obligation. Okay. And what about this specific export obligation? How much is the duty saved? How much ever is the duty saved? That is 20 lakhs into 6 times. So 20 into 6, 120. So here 40 plus 20 plus 25 plus 15 plus 15 plus 20. So we have achieved this specific export obligation. More than 120 we achieved, but the average export obligation is not achieved. So due to that reason, whatever benefit that has been claimed under EPCG shall be taken away along with interest. Okay. So these are the type of questions, the standard questions that we have on customs. Okay. Apart from this, I'll be doing solved workbook revision. In that solved workbook revision, you can see the questions related to that. Okay. So we completed customs along with some standard questions related to that. Then we will quickly complete some portion what we are left with related to GST. Okay. So come back. So 49th and 50th question is taken from solved workbook only, I think. From solved workbook only it is taken. So look into this. So we have completed the major part in customs like GST, customs fully over, customs and FTP over, along with the questions also we completed, and more questions we will be doing in this, what is that, solved workbook revision I will do. In that solved workbook revision I will incorporate all those things, don't worry about that. Okay. So now come back to this returns under GST. Returns under GST, please have a look into that. Returns under GST. Segment 11, page number 100. Returns under GST. No, I did not include baggage and duty drawback in this top 50 questions because no, that is not that much important. So maybe rarely it could be asked. So what I have included is like the best 50 questions that could be tested for exam. Okay. So now actually one question got repeated. So I want to incorporate one more question from duty drawback, that I will incorporate that question and I will share that PDF with you. Okay. So that 50 questions you please revise once again at your end. Then look into segment 11, returns under GST, page number 100. So in this returns under GST, majorly an important area that we have is QRMP scheme. So QRMP refers to quarterly return monthly payment scheme. So first of all, we need to understand. So when this returns are required to be filed under QRMP and to whom it is available. QRMP scheme is available to a person whose aggregate turnover during the previous year does not exceed 5 crores, okay, or in any quarter in the previous quarter does not exceed 5 crores. So therefore, if the previous quarter it exceeds 5 crores, for the current quarter you cannot go into QRMP. That's how it is. So therefore, previous year also it should not exceed and previous quarter also it should not exceed. Even though the words given are, but you need to understand it like both and also. That is, and is the way you need to understand. That is, previous year also it should not cross 5 crores and previous quarter also it should not cross 5 crores. Previous quarter in the current year. So then for the current quarter, you can go for QRMP. Okay. So in that QRMP, the returns will be filed on a quarterly basis. And what is that quarterly frequency? GSTR1 will be filed by 13th of the month following every quarter. GSTR1, whereas GSTR3B will be filed by 22nd or 24th. Okay. 22nd or 24th. You remember Gujarat, Madhya Pradesh, okay, then Chhattisgarh and Andhra Pradesh. Gujarat, Madhya Pradesh, Chhattisgarh, Andhra Pradesh, GMCA. You remember that states. So GMCA and all states below that, it will be 22nd. And the remaining states above the GMCA will be coming under 24th. Okay. So then 22nd or 24th GSTR 3B, 22nd or 24th of the month following every quarter. Then the tax will be payable on a monthly basis, and that tax will be like by 25th of the month following every month for the first and second month. Why for the third month not required? Because anyhow for 3 months we will be filing a 3B. That's why for third month it is not required. So because we will be filing 3B, for the first and second month we need to deposit that money into the payment challan through the payment challan PMT6 by 25th of the month following every month for the first and second month. And we have 2 methods for computation, that is fixed sum method and self-assessment method. Like the 2 methods are there. And we will be reporting the GSTR1 as we file the GSTR1 on a quarterly basis. The recipient will be able to take the credit on a quarterly basis in order to avoid that discomfort to the recipient. So we can file IFF. Even though you are under QRMP, you can file the invoice furnishing facility on a monthly basis. So that is for the first and second month, you can file IFF, invoice furnishing facility, that contains the details of B2B invoices by 13th of the month following every month, so that this data will be given to the recipient in their GSTR2B and they will be able to enjoy the credit. And QRMP is to be selected registration wise. So it is not like composition scheme wherein all in or all out. All registrations into composition scheme or all registrations out of composition scheme. Like that it is not applicable. So we can choose between the registrations whether to go for QRMP or not. What is the time frame to opt in? So you remember, so before, that is 1 month after commencement of the quarter, 2 months before commencement of the quarter. Okay. So commencement of quarter, 1 month after commencement of quarter and 2 months before commencement of quarter, you can go into QRMP. So which means for the current quarter, April to June. So when you can go 2 months before, that is February 1st. And 1 month after, that is by April 30th, like that we have. Okay. So then even the same time limit to opt out also. That is like every quarter we will be deciding whether to go into QRMP or not. Condition to opt in. Whenever we are opting into QRMP, we should ensure that the last 3B has been filed. last return must have been furnished on the date of exercising the option. And GSTR1 or availing IFF facility, we can decide between GSTR1 or IFF facility. IFF facility is not mandatory, so invoice furnishing facility we can do it on a optional basis. So if you are filing IFF, but you need to ensure that not more than 50 lakhs worth of invoices, not more than 50 lakhs worth of invoices can be reported in 1 month in IFF. So I don't know why that restriction is given, but not more than that. And B2B invoices only we will give. Whatever details that we have given in IFF will be automatically coming in GSTR1. Again, we don't have to do the data entry. Only the third month data we need to enter. Okay. Then suppose if you are not going for IFF, then all 3 months data we need to enter in GSTR1. And payment method, so at the option of the taxpayer, he can choose for each month fixed sum method or self-assessment method. Fixed sum method says that we need to take the previous GSTR 3B. If the previous GSTR 3B is quarterly, whatever is the amount paid through cash ledger, out of that 35% we will pay for the first and second month during the current quarter, okay, as tax. That much money we need to deposit into the cash ledger. Suppose if the previous 3B is monthly, whatever is the amount paid through cash ledger, out of that 100% we will deposit into the current month, that is current quarter, first month and second month, okay, assuming that that much is the liability. So therefore we need to see the previous quarter 3B or previous month 3B. Previous quarter 3B means 35% of the liability paid through cash ledger. Monthly means 100% of the liability paid through cash ledger. Under self-assessment method, we will actually compute how much is the amount that we need to pay, and that much money will be deposited, okay. So, but what is the disadvantage in self-assessment method? In self-assessment method, suppose if you deposit some amount computed, but the actual amount is more than that, so then for the differential amount, you need to pay interest from 26th of the next month till the time you pay the differential amount. But under fixed sum method, whatever money you paid, and suppose if the actual amount is more than that, no need to pay any interest. If the differential amount, you discharge it by GSTR 3B due date, okay. But under self-assessment method, we need to pay that interest. Any change in the manner of filing 3B, no change in the manner of filing 3B, the same way we will file. And compulsory opt-out whenever the aggregate turnover exceeds 5 crores in a quarter in the current financial year, automatically will come out of the QRMP. Interest on non-payment or short payment, that's what I was referring to in case of fixed sum method. So you don't see for first month and second month actual versus how much you deposited. So now first month amount you have to pay by 25th. If you are not paying by 25th, for delay you have to pay the interest. And second month also you have to pay by 25th of the following month. Otherwise for the delay you have to pay. And so GSTR 3B needs to be filed by 22nd, and by that time all the amount to be paid. And if you are not paying beyond 22nd, if it gets delayed 22nd or 24th, for that you need to pay interest. But self-assessment method, extra one more interest also will come. That is differential amount. Actual versus how much you deposited, you need to check on the differential amount from 26th of the next month till the time you pay the differential amount, we need to pay interest. So that is there. Under self-assessment method, one more extra interest we will get. And late fee. For non-payment of tax, there won't be any late fee, but non-filing of returns, there is a late fee. For GSTR 1, there is a late fee. GSTR 3B, there is a late fee. For IFF, there is no late fee. So this is with respect to QRMP that you need to remember. If at all the questions are tested in QRMP, interest computation will be tested, and otherwise MCQs only. Then now look into time limits of various returns. So GSTR 1, so what is the time limit? Normal means 11th of the month following every month. QRMP means 13th of the month following every quarter. IFF means 13th of the month following every month. GSTR 3B normal means, so that is 20th of the month following every month. QRMP means 22nd or 24th. Okay. Then CMP 8. CMP 8 is a composition scheme, so that is 18th of the month following every quarter. GSTR 4 is an annual return filed by composition scheme dealer by 30th April of the succeeding financial year. GSTR 5, a non-resident taxable person will file. A non-resident taxable person will get a temporary registration, that is 20th of the month following every month, or 7 days from expiry of registration, whichever is earlier will be taken. So 20th of the month following every month, or 7 days from expiry of registration, whichever is earlier, because the registration granted to them is a temporary registration. What about a composite CTP? So casual taxable person. Casual taxable person will file regular returns, GSTR 1 and GSTR 3B. GSTR 5A is a return to be filed by OADR supplier located outside India who is making supply to a non-taxable online recipient in India. That will be GSTR 5A, same 20th of the month following every month, and there is no temporary registration for them. There will be permanent registration only. GSTR 6 is a return to be filed by input service distributor by 13th of the month following every month, and then GSTR 7 and 8 TDS TCS 10th of the month following every month. GSTR 9 is annual return 31st December of the succeeding financial year. 9B e-commerce operator, same 31st December. 9C self certified reconciliation statement not audited, and that is to be filed by 31st December of the succeeding financial year if the aggregate turnover during previous year exceeds 5 crores. That is important. If aggregate turnover during previous year exceeds 5 crores, then only it will be applicable. GSTR 10 is the final return. GSTR 10 to be filed by a person who makes application for cancellation, or so officer cancels his registration. That is, whenever there is a effective date of cancellation, so from the date of cancellation 3 months, or order of cancellation, the date on which order of cancellation is given, so whichever is later will be taken. Okay. Then GSTR 11 is a return to be filed by UIN holder for the purpose of claiming the refund. They need to give the details of all their inward supplies. That is, at the time of filing refund claim, they will be furnishing. Then person who is not required to file GSTR 1 or GSTR 3B. So remember, T square tonic in the tonic T square. Okay, 2 times T. So T for TDS TCS, and then OIDR supplier. Then N for non-resident taxable person. Why TDS TCS director will be filing GSTR 7 and 8. OIDR supplier GSTR 5A. Non-resident taxable person GSTR 5. I input service distributor. C for composition taxpayer, that is CMP 8. Then who are not required to file annual return? Tonic. So same, T is TDS deductor because TCS deductor will be filing annual return in 9B, and ON9C. C alone will change, casual taxable person not required to file annual return. Even remember, controller and auditor general is also not required. That is CAG. Note. So registered person whose books are subject to audit, registered person whose books are subject to audit, whose books are subject to audit by CAG. So books are subject to audit by CAG, also not required to file, annual return. Also not required to file annual return. Okay. So this is with respect to that. Okay. Then next, late fee. Now there is a late fee, revision in the late fee. So first we need to understand. So GSTR 1 and GSTR 3B, what is a late fee? If it is nil return, so generally what's the basic late fee? 100 rupees per day subject to a maximum of 5,000 rupees. That's a general late fee. Now there is a revision in the late fee. If it is GSTR 1 3B, nil return, 10 rupees per day subject to maximum 250 rupees. This under each act. For example, 30 days is the delay. So 30 days into 10, that will be 30 days into 10 rupees, that is 300. The maximum is 250. So 250 rupees is only payable. If it is other than nil return, per day it is 25 rupees. Okay, but the maximum will change. If the aggregate turnover during the previous year does not exceed 1.5 crores, then 1000 rupees. Exceeds 1.5 crores but does not exceed 5 crores, 2500 rupees. Exceeds 5 crores, then it will be 5000. So remember, 5000, half of that, that is 2500. Half of that, 1250, round it up to 1000 rupees. Okay, so therefore exceeds 5 crores, 5000. Does not exceed 5 but exceeds 2.5, that is exceeds 1.5 crores, 2500. Half of that. Exceeds, does not exceed 1.5 crores, then half of that 1050, but you take rounded off 1000. Okay, this will be taken as the maximum late fee payable. Okay, then this is per act. Then GSTR 5 and GSTR 5A and GSTR 6, in all these cases same. So nil return 10 rupees per day, other than nil return 25 rupees per day, but maximum they did not change. Maximum will be 5000. GSTR 7, so that is TDS return will be, that is 25 rupees per day subject to maximum 1000, and TCS normal 100 rupees per day subject to maximum 5000. GSTR 4 who will file? Composition scheme. When composition scheme is applicable, if the aggregate turnover during previous year does not exceed 1.5 crores, correct? 1.5 crores limit. So like GSTR 1, what is the late fee? 1.5 crore does not exceed 25 rupees per day subject to maximum 1000. You incorporate that here. 25 rupees per day subject to maximum 1000, nil return, so 10 rupees per day subject to maximum 250. GSTR 9 or 9C, that is 0.25% of the turnover is a maximum, that is 100 rupees per day subject to maximum 0.25% of the turnover, and this is the late fee that is payable under CGST Act. The same amount of late fee is also payable under SGST Act. Okay. And whenever there is a nil return means all the entries in the return should be nil. Then only it will be called as nil return, and that nil return can be filed through SMS. So what are the nil returns that can be filed through SMS? GSTR 1, GSTR 3B and CMP 8. Okay. So GSTR 8 is not there. So please incorporate for GSTR 8. That is, apart from this, any other case it will be 100 rupees per day subject to maximum 5000. So that is GSTR 8 is there. So please incorporate that. For GSTR 8 it is 100 rupees per day subject to maximum 5000 rupees. Okay. Because for GSTR 8 they did not give any revision in the late fee. Then rectification of the returns. Rectification of the returns is like whenever I reported the data in GSTR 1, now I wanted to rectify that. Is it possible? Yes, it is possible. What is the time limit for rectification? The time limit for rectification is whatever is the due date of that return for the subsequent year September month. So for example, during this financial year, I filed GSTR 1, I need to rectify that. Next year, September, what is the due date? 11th October or date of filing and return, whichever is earlier, is the time limit by which rectification of return is possible. Then, how the outward supply details are reported in GSTR 1. So if it is B2B supplies, always it should be given invoice wise. If it is B2C supplies, again divided into two: interstate supplies or intrastate supplies. Intrastate supplies we can consolidate. Interstate supplies with the value of invoice per invoice exceeds 250, it should be given invoice wise. If it does not exceed 250, we can do state wise consolidation. Consolidation we can do, but state wise we need to do. So that is with respect to this details of invoices in GSTR 1. Then annual return you can see. So annual return currently, that is from financial year 2021-22 onwards, GSTR 9 is mandatory irrespective of the aggregate turnover. 9B also mandatory, and GSTR 9C is now self-certified whenever the aggregate turnover exceeds 5 crores. 9A like that one return was there, now it is not applicable. GSTR 4 is also like 5 to be filed, mandatory irrespective of aggregate turnover. Okay, so I gave you a table, but what you need to remember is this financial year 21-22 onwards. Okay, so as you will get confusion, that's the reason why I gave you this table. So with this we completed returns under GST. So there is one query here: if QRMP opted, IFF not filed, even though payment need to pay or not in the first and second month. IFF, whether you are filing or not, you need to pay her. So under either fixed sum method or self-assessment method, you need to pay. IFF is irrelevant. Whether you file IFF or not, you need to pay the tax under QRMP. Okay. And sir, first month can I go for FSM and second method can I go for SAM? Yes, you can do that. Then the next area that is there in this is advance ruling. So have a look into that advance ruling. So where is that here? Advance ruling. So segment number 17, advance ruling. Have a look into that, page number 119. Advance ruling. So authority for advance ruling, and there are two authorities. That is authority for advance ruling, appellate authority for advance ruling. Authority for advance ruling will be like whenever we have a question that is doubt with respect to certain issue. So what are the questions for which we can go for advance ruling? So we have a list of questions for which we can go for advance ruling. With respect to these questions, when we knock the door of advance ruling authority, so they will be giving us a solution for that. That is whether a particular activity is supply or not. So from the beginning, if you see, so whether an activity is supply or not, and thereafter what should be taken as the tax liability, that is composition scheme, what would be the tax liability computation, then registration, then classification, valuation. Classification refers to supply of goods or supply of services, valuation, time of supply, input tax credit, and exemptions, applicability of notifications. So what are the cases where you cannot go for advance ruling? So advance ruling not possible. Advance ruling not possible in few cases. So what are the cases where advance ruling not possible? What are the questions where advance ruling not possible? From this we can say that is place of supply. number 2. So that is related to what like returns, payment process, then other department procedures, offenses, penalties, etc. Other department procedures. On that we cannot go for advanced ruling. Understood or not? So in That's It book, actually I have already given GSTR 8 ka late fee, but in some books that is printed little before. Actually this time we printed 4,000 books. We printed 4,000 books, and in that actually that got printed in 2 batches. So in that one batch, maybe the GSTR 8 was missing, that is old, little old. So then thereafter, again next set of batch when it is printed, so I have incorporated that. Okay, so for that reason there may be an issue. If it is not there, you add that. So now advanced ruling is not possible in these cases. Okay, so these are the only cases, that is where an activity is supply or not, what should be taken as a value, what should be the time of supply, and whether input tax credit is available or not, what should be the exemption, liability, whether it is FCM or RCM. So all these cases we can go for advanced ruling. When we go for advanced ruling, we need to pay a fee. How much fee we need to pay? 5,000 rupees under CGST, 5,000 rupees under SGST. And when we make a application for advanced ruling, that application will be like national or regional, that is state wise. So we don't have national advanced ruling authority, we have only state wise, state level authority only we have. Suppose if there is like whether one person or group of people will be giving the decision, there will be a group of members. What if there is a confusion between the members, or if they are not able to give the advanced ruling, then the matter will be referred to appellate authority for advanced ruling. What is the time limit within which they need to pronounce the ruling? 90 days. Within 90 days from the date of application, they need to pronounce the rulings. And whether that ruling will be binding, yes, that will be binding on the applicant and that will be binding on the department. But any other person having the same facts cannot rely on that rule. And suppose if the advanced ruling is obtained by by giving misrepresentation of facts or false information, then the advanced ruling will be void ab initio, and advanced ruling application will be rejected if the matter is already decided by court or is pending in the court. And suppose if the advanced ruling authority gave a decision, and on that if you are not willing, like not accepting, you can go for appellate authority for advanced ruling. And what is the time limit within which you can make an appeal? 30 days plus 30 days. For that the fee will be 10,000 plus 10,000, and that is also a state level authority only, and they will be pronouncing the ruling within 90 days from the date of application. And suppose directly from advanced ruling authority, directly if it goes to appellate authority for advanced ruling, so no need to pay any fees because it is forwarded by the advanced ruling authority, so no need to pay this fee, that is 10,000, 10,000. Only when the order is given and then when you file appeal, so then only 10,000 plus 10,000 is payable. So this is about advanced ruling here. Then even payment process also we did not discuss. Have a look into that payment process topic. Payment process under GST. So see that segment number 10, page number 98. So payment process, here we are trying to understand what are the various ledgers which are maintained by GST network. So there are basically 3 ledgers which are maintained by GST network on behalf of every registered person as per section 49. That is electronic liability ledger, electronic credit ledger, and electronic cash ledger. So electronic liability ledger contains the liabilities. Okay, whatever is our liabilities which are reported in GSTR1 and GSTR3B, that will be there in the electronic liability ledger. The liabilities are divided into total 5. T, I, P, F, O. T for tax dues, I for interest, P for penalty, P for late fee, and O for others. That is any other amount that is payable to the government. So these are the 5 dues that will be there in the electronic liability ledger. Now electronic credit ledger, whatever is the balance, that can be used only for payment of tax dues, that cannot be used for payment of other dues. And electronic cash ledger balance, whatever is there, that can be used for payment of both tax dues as well as other dues. And how money will come into the electronic credit ledger? The day when you are taking the credit in GSTR 3B, then it will come into the electronic credit ledger, that will be used for payment of tax dues. And how the credit, like how the money will come into electronic cash ledger? So whenever we make a deposit through payment challan PMT6, then money will be credited, that can be used for payment of liability, or if any refunds we are getting that money, or TDS, TCS deducted also will come into electronic cash ledger, that will be used for payment of liability ledger. Okay, then there is a format electronic liability ledger is PMT1, electronic credit ledger is PMT2, electronic cash ledger is PMT5, electronic that is challan, payment challan is PMT6. And now what is PMT3? So whenever we are making the payment through credit ledger and we claim the refund, to give the refund back into the credit ledger, they will be passing an order, that is PMT3. And PMT4, if there is any discrepancy in the ledger, to communicate the discrepancy, we will be filing a form, that is PMT4. Okay, then whatever balance that is there in the electronic cash ledger, we will be able to get as the refund. There is no restriction. Whatever balance in the electronic credit ledger, we can get as the refund only in two cases. What are those two cases? Zero rated supply and inverted tax structure. Only in those two cases we will get refund of balance from the electronic credit ledger. And what are the various modes of deposit into the electronic cash ledger? Either you can make a deposit through internet banking, then we have NEFT RTGS, or we can make it through debit card, credit card, or over the counter. Debit card, credit card is not there in practice, but as per law section 49 it is there. Okay, and over the counter payment, that is cash deposit not more than 10,000 rupees per tax period, that much only is permitted. And refund order PMT3 and discrepancy PMT4. And then PMT5 cash ledger, PMT6 challan, PMT7 is there. That is whenever money is debited from our bank account but not got credited into cash ledger, we can communicate to the bank or the payment gateway through the portal, that is PMT7. And PMT8 we don't have, PMT9 we have for shifting of the balances in the cash ledger. In the cash ledger we make deposits. While making deposits, we by mistake deposited into IGST. From there we need to shift into CGST, SGST. Yes, we can do that. Okay, there are total 4 major heads and 5 minor heads. CGST, SGST or UTGST, IGST and cess. These are the 4 major heads, and 5 minor heads are tax, interest, penalty, fee and others. So there is a 20 cell matrix. From any cell to any cell we can shift the balances, so using the PMT9 challan. Okay, then next, refund to the original source. That is whenever there is an excess payment of tax, now that excess payment of tax will be refunded. So when there is a refund, so now other than zero rated supplies and deemed exports, whenever we pay the tax, to get it as a refund, so first it will be refunded to the original source. But how do they know whether we paid through cash ledger or credit ledger? For whichever month we are claiming the refund, for that month in 3B we paid through partly cash ledger, partly to credit ledger. For example, 20 lakhs paid through credit ledger, 10 lakhs paid through cash ledger. Then in the 2:1 ratio, the refund will be given back to credit ledger and cash ledger. That is this point. Okay, then restriction on utilization of amount available in the credit ledger, rule 86A. So rule 86A says that whenever a person, that is supplier, is not doing business from the place where they have obtained registration, or the supplier is missing, recipient is missing or recipient is not doing business from the place where they have obtained registration, then receipt of goods without invoice, ITC availed without invoice, okay, and then ITC availed against invoice but the supplier has not paid the tax, or invoice or debit note against which we have taken the ITC is not in existence. These 5 cases, the proper officer will suspend the credit for utilization for a period of 1 year. Okay, and after 1 year, so that credit will be taken and that can be utilized. That is with respect to this rule 86A. Then rule 86B is like, whatever is our gross liability, out of that gross liability, 1% of the gross liability should be paid through cash ledger. Even if we have sufficient balance in the credit ledger, 1% should be paid through cash ledger. For example, my liability is 20 lakhs and I have 25 lakhs in the credit ledger. But out of the 20 lakhs, so 20 lakhs into 1%. So 20 lakhs into 1%, that is 20,000 I have to pay through cash ledger only. Then how much I can use through credit ledger? So 19 lakh 80,000 I can use from the credit ledger. Okay, so that is that point. To whom it is applicable? Turnover in a month greater than 50 lakhs. Month. So it is not turnover in a year, turnover in a month. Remember, turnover in a month, not turnover in a year. Turnover in a month is greater than 50 lakhs. So those people will be able to get, are required to follow this rule 86B, turnover in a month greater than 50 lakhs. When you compute the turnover, please take out the exempted supplies and please take out the exports, that is zero rated supplies also taken out. And what about non-taxable? That should also be taken out. And taxes, that should also be taken out. So turnover equals to total supplies minus exempted supplies minus zero rated supplies minus taxes. Okay, and pay 1% of the gross liability through cash ledger, even if there is sufficient balance in the credit ledger. And this is not applicable to government department, that is government, PSU, local authority and statutory body mainly. So this is to create a cash flow only. What's the point in if you apply these people? So the cash will be rotating internally only, there is no benefit. So therefore for cash inflow only they created this provision. So to these people it is not applicable. And further, in few cases it is not applicable. That is if a person has deposited income tax more than 1 lakh for the each year in the preceding 2 years, and if there is any refund that is payable to a person more than 1 lakh, but if it is not paid, that will be withheld. So therefore that person also not required to pay 1% through cash ledger, and you have maintained 1% during the current year from the April to the current month. So in the current year, you are maintaining 1% payment cumulatively, payment through cash ledger. So 1% of your gross liability, then also for the current month not required, because already you are maintaining 1%. So therefore you are not required to. So these are the cases where a person is not required to pay 1% through cash ledger. Okay. So with this, payment process is over here. Now look into the last area, that is segment 20. So we have few concepts related to that. So segment 20, liability to pay tax in special cases. So take page number 128. Take page number 128, liability to pay tax in special cases. So first, section 85 says that whenever there is a transfer of business, both transferor and transferee are jointly and severally liable to pay. And section 86 says that whenever there is an agent who is liable to, who is making supply on behalf of principal, that agent is jointly and severally liable along with the principal. Okay, so principal and agent are jointly and severally liable for payment of the dues. Only when agent is making supply on behalf of principal. When agent is not making supply on behalf of principal, then only agent, the principal is only liable to pay, not agent. Then section 87, in case of amalgamation or merger of two companies, they are considered as a single entity only from the date when they are notified by the court. So court order only should be taken. Before that, in principle an approval is given, but they are treated as two different persons only. And in case of company into liquidation, section 88 says that first a receiver will be appointed, and that receiver shall intimate to the commissioner within 30 days of his appointment, and commissioner shall notify the dues within 3 months, and that should be considered as the statutory dues for payment by the official liquidator. And suppose if a private company is converted to public limited company, so then the company liquidator will be appointed, etc. But if it is a private limited company, the directors will continue to be liable. Okay. So if a company is private company, all directors shall be remain liable jointly and severally. Then as per section 90, liability in case of partners of a firm. Firm and partners are jointly and severally liable for the dues here. Okay. Then retiring partner will continue to be liable till he gives his notice of retirement to the commissioner. If such notice is not issued within 1 month from the date of retirement, what does it mean? So which means that if I give the notice within 1 month of my retirement, up to the date of retirement only I am liable for the dues. If I am not giving notice within 1 month, then till the date I give the notice at a later point of time, so I am liable for the dues even though I am not there in the partnership firm. That is that. And all the partners are jointly and severally liable, even the newly admitted partners also. Then what about the liability of the guardians or trustees? So they are liable as if the minor becomes major, or they are carrying out the business on themselves. So the guardians and trustees are liable even when minor becomes major also. So for the period before the date minor becomes major, the guardian will continue to be liable for those dues. Then liability of court of wards, just like guardian appointed for minor, so court of wards will be appointed, that court of wards will be liable. And whenever there is a death of a person, whether business is discontinued or not, you need to see. If business is discontinued, the legal heirs is liable for the GST dues. When the business is not discontinued, so the business is not continued, then the legal heirs are liable to the dues only to the extent of estate inherited by them. Okay. And whenever there is a partition of HUF, whenever HUF or firm or AOP, so there is a dissolution or partition, etc., all the members are jointly and severally liable. And so whenever a newly admitted partner is there, the newly admitted partner is liable for the dues even before the period he has been admitted into the partnership firm. So he need to enter into an indemnity clause with the other partners. Okay. And then suppose if the partnership firm is dissolved, still the assessment is completed, all the partners are liable. So this is with respect to liability to pay tax in special cases. Maybe somewhere in MCQs it could be asked. Then the second area, e-way bill. So e-way bill is a very important area. First we need to understand what is the purpose of e-way bill. E-way bill is required to be given whenever there is a movement of goods, so that we are communicating the goods from which place to which place we are taking, and if any goods that are transported without e-way bill are liable for confiscation. Okay, and the provisions of that seizure and confiscation will be coming into the picture, section 68, section 129 and section 130. And first it should be generated before movement of goods, and e-way bill is not applicable in case of exempted goods, only in case of taxable goods. What if in a single invoice there is both taxable goods as well as exempted goods? Take out the value of exempted goods and see what is the value of taxable goods. If it exceeds 50,000, then e-way bill will be applicable. So 50,000 is the limit. 50,000 is the limit. While computing 50,000, we need to add taxes. Okay, we need to add taxes. Don't forget, we need to add taxes while computing 50,000 limit. And some states, they will be giving a state specific limit that is applicable only for intra-state movement. So recently also Rajasthan has given 2 lakhs and West Bengal has given 1 lakh. So therefore that is for within the state movement, but otherwise 50,000 is only the limit that will be taken. And so here in case of job work and handicrafts, whether the value exceeds like 50,000 or does not exceed 50,000, definitely e-way bill is required in these two cases. What are they? Goods sent on job work and handicrafts are transported. And in e-way bill there will be two parts, that is part A contains the invoice details and part B contains the vehicle details. Part A will be generated by the person who is causing movement of goods. Part B will be generated by the, suppose if it is own conveyance, the person who is causing movement of goods, otherwise the transporter will be generating, like entering the part B details. And validity of e-way bill. So once a e-way bill is generated, that will be valid for a period of, for a period that is counted based on the kilometers. For every 200 kilometers or part thereof, the validity will be 1 day. For example, 380 kilometers. For 380 kilometers, the validity will be 2 days. For 430 kilometers, the validity will be 3 days. So that's how it will be calculated. For every, 200 kilometers or part thereof 1 day. But if it is a over dimensional cargo wherein the tile of the cargo is very big, that is the big cargo, the vehicle is big, or the multimodal transportation wherein one leg of the journey involves transportation by vessel up to a distance by vehicle, up to a distance by railway, and thereafter by vessel, waterways, and then again by roadways, like that. Multi-mode of transportation, one leg of the journey involves by vessel, then also it will be 1 day for every 20 kilometers or part thereof. The validity should always be counted from the midnight of the day to the midnight of the next day. Okay, so therefore always the e-way bill expires by the midnight, and within 8 hours after expiry the e-way bill has to be renewed. Okay, that is this. And some FAQs on e-way bill: when e-way bill is not required to be generated. If it is a non-motorized vehicle, e-way bill is not required. And for transportation of goods from port, airport or land customs station to inland container depot and container freight station, so for this movement also, because this will be under the control of customs, so e-way bill not required. Even for taking the goods to the warehouse also, e-way bill is not required, because still the goods are under the control of customs. Then transit cargo transported to Nepal and Bhutan. Already we discussed that in GST exemptions, the goods are unloaded in India and it is going to Nepal and Bhutan through roadways. So that also do not require e-way bill. And movement of goods by Ministry of Defence also do not require. When empty cargo containers are transported, not required. And consignor transporting the goods from the location to the weighbridge, 20 kilometers. So within 20 kilometers, if there is a weighbridge for transporting the goods to weigh the weight of the goods, so then also e-way bill is not required. Okay, then goods transported by rail, where the consignor of the goods is the government, and goods specified as exempted from e-way bill by the respective state, and some notified goods. What are those notified goods? So that is LPG for supply to household, that is the red color cylinders, kerosene oil under PDS, postal baggage, then natural cultured pearls, jewelry, because jewelry and pearls and all, if it is transported, if it is known, then it is difficult, so due to that reason. And used personal and household effects, these are the notified goods. So in these cases e-way bill is not required. Okay, then whether e-way bill is required if the movement of goods is not for supply? Yes. Whether it is of supply or not supply, e-way bill is required. So delivery challan plus e-way bill is there. And whether 50 per thousand limit is for taxable goods or exempted goods, so that is for taxable goods. And while computing invoice, whether GST to be included? Yes. Who will generate e-way bill? Registered person causing movement of goods. If the supplier is registered, supplier will enter party details. If supplier is unregistered and recipient is registered, recipient will enter. both are unregistered, transporter will enter Part A details. Part B details will be entered by transporter only. If it is own conveyance, the registered person who owns the conveyance will be entering. If the goods are handed over to railways or airways or vessel, then we cannot enter the vehicle number, so we need to enter the transport document number. Then suppose if each invoice, that is there are multiple consignments which are transported in a vehicle and each consignment value does not exceed 50,000, but overall all consignments transported in the vehicle exceeds 50,000, whether transporter is required to generate e-way bill? Yes. And there is something called as blocking of e-way bill. Now blocking of e-way bill means whenever you are not filing returns, so for consecutive 2 periods, so then in that case e-way bill will be blocked for outward supplies against your GSTIN. Against your GSTIN, you or transport or any other person for outward supplies cannot generate e-way bill, but for inward supplies it is possible. That is with respect to this. Then the other points, in case of bill to ship to transactions, one e-way bill is only sufficient and multi-vehicle updation is possible. Part B should be updated within 72 hours and Part B may be updated by supplier, recipient or any other person. Okay, so that is Part B should be updated within 72 hours, which means that it is like, so within 72 hours it should be accepted. Part B should be accepted by the recipient within 72 hours. That is actually, okay, accepted by recipient within 72 hours. And what is the time limit for updation of Part B? For updation of Part B, it is 15 days. For updation of Part B, 15 days from generation of Part A. 15 days from generation of Part A. So Part B details needs to be updated. So that is accepted by the recipient within 72 hours. That is that point. Okay. Then look into the next area, summary of various important circulars. That is, whenever there is an interstate movement of conveyance, so whenever there is an interstate movement of conveyance that is carrying the goods, so then in that case, so that particular conveyance no need to pay GST, only on the goods in that conveyance we need to pay GST, and even the conveyance sent for repairs also no need to pay GST, but the other person who is doing the repairs needs to pay GST. This is in case of transaction between distinct persons, that is the circular. And then when an agent is called as acting on behalf of principal, if the agent is raising invoice in his name, then he is acting on behalf of principal. In case of purchase transaction, the invoice is in the name of the agent, then agent is acting on behalf of principal. Okay. Then this circular, already when discussing the question we discussed, that is in case of printing job, there are two elements, material and printing. So if material constitutes principal supply, entirely it is treated as supply of goods. If printing constitutes principal supply, entirely it is treated as supply of services. And then activity of bus building, we need to classify based on what constitutes principal supply. Usually there it will be service only, so it will be classified as supply of service. Rethreading of tire, suppose if I get the old tire and I do the rethreading and give it to you, then it is supply of service. If I buy the old tire and sell you the rethreading tire, then it is supply of goods. And priorities entire vending certificates are transferred by one bank to another bank which has not achieved the target of loans to the priority sector, and these priority sector lending certificates are treated like goods only. And whenever an artist is sending the artwork to the other person, so that artwork he is not required to pay GST. Now only when the art gallery sells it to a buyer, GST is payable by the artist. That is the time of supply. Then tenancy rights. In case of tenancy rights, remember whatever tenancy right, that is tenancy right refers to the premium received by the person. So when he transfers the tenancy right from one person to another person, say I am a tenant, I have a tenancy right, I will be transferring the tenancy right to another tenant, for which I will be receiving a premium. On that premium amount, whatever I am receiving, so I will not be paying GST or I will be paying GST. I will definitely pay GST, whatever is the type of property. Now I will share a part of the tenancy premium with the property owner. So only if it is residential property, so then it is exempted. Otherwise, if it is a commercial property, rent is taxable, tenancy premium also taxable. If rent is exempted, tenancy premium also exempted, like that. Okay. Then GST on director's remuneration, already we have discussed. If TDS is deducted under 192, then that is excluded from supply. If TDS is deducted under 194J, then it is covered under supply. Then del creator agent, whenever there is a del creator agent who is getting an interest for giving the finance facility, that interest, suppose if del creator agent is raising the invoice, that interest is for delay in receipt of consideration, so that interest is taxable. When del creator agent is not raising the invoice, when principal is raising the invoice, for the buyer, del creator agent is mere financier and the interest received will be exempted under the grounds of interest on loans, advances, deposits. Then the next area, GST practitioner. GST practitioner is a concept that is created by the previous finance minister. So in order to facilitate filing of returns, but not all works can be done by a GST practitioner. Only some specified set of works only can be done. That is, they can file the returns and they can apply for registration and they can make the payment of taxes and make application for refund, and they can act as authorized representative, plus they can furnish the details for generation of e-way bill, and they can furnish the details of ITC4, that is goods sent on job work, receipt from job work, file an application for amendment, that is unique enrollment number. Every transport or warehouse keeper should get a unique enrollment number, so they can make an application for amendment or cancellation, and they can file intimation to pay tax under composition scheme or withdraw from composition scheme. These are the activities that can be done by a GST practitioner. And eligibility condition, they should not be citizen of, they should be citizen of India, and they should be person of sound mind and not adjudged as insolvent, not convicted by a court for imprisonment more than 2 years. Up to 2 years imprisonment means it is allowed. Okay. So then responsibility for correctness of the particulars. Who is responsible for the correctness of the particulars? Not GST practitioner, it is a registered person only. So GST practitioner, before filing returns, to take a confirmation from the registered person, and so that confirmation if not sought, then GST practitioner can file the returns, but the responsibility for correctness of the information lies with the registered person only. Okay. So with this, we completed entire GST and customs. So this pocket book revision here. Okay. So therefore, I told you category ABC analysis already I told you, and you are doing this revision. So with this, so the entire part of pocket book revision is over, and we are left with few questions only now. We are left with few questions to be discussed. Okay, so those questions we will complete. So with this, Mighty 50 will also be over. So few questions are left in GST that needs to be completed. Have a look into that. Yes, up to this question we completed, and then the next one, question number 28. Question number 28, Manihar Enterprises. So please take your that PDF, whatever I have shared, 9050 PDF. So 26th to 27th we completed. 26, 27 we completed this. Up to this question we have completed in the last class. So 28, Manihar Enterprises registered in Delhi. So he is engaged in supply of various goods and services exclusively to government departments, agencies, etc. and persons notified under section 51 of the CGST Act, that is TDS. This question is based on TDS. It has provided the following information relating to supplies made. Their contract values and payment due is as under. So first of all, in TDS you need to remember the contract value should exceed 2,50,000. Then only TDS is applicable. First case, supply of stationery to Fisheries Department of Kolkata, 2,60,000 inclusive of GST. So what is the rate of GST that should be taken? 18%. So therefore 2,60,000 into 100 divided by 118. How much? 2,20,000. It does not exceed 2,50,000. So therefore TDS is not applicable. Second case, supply of car rental services to Municipal Corporation of Delhi. So 2,95,000 into 100 divided by 118. So that is 2,50,000, exactly 2,50,000. Then also TDS not applicable. So TDS is applicable only when the value exceeds 2,50,000. Then supply of heavy machinery to public sector undertaking located in Uttarakhand, 5,90,000. So definitely it will be applicable because 5,90,000 into 100 divided by 118. If you see 5 lakhs, it exceeds 2,50,000. TDS is applicable on this 25,000. We need to compute, but wait. Supply of heavy machinery to public sector undertaking. Where is this person located? Delhi, and it is supply of goods. Supply of goods to a person in Uttarakhand. So therefore, as per section 10(1)(a), supply involves movement of goods as per IGST Act. The place of supply will be ending point. What is the ending point? Uttarakhand. So supplier Delhi, place of supply Uttarakhand, it is interstate supply. So therefore, on the 25,000, what will be the TDS? 25,000 into 2% will be the TDS, 500. Under IGST, that 500 will come. Clear or not? Under IGST, that 500 will come. So therefore, like that we need to compute. And remember, not on the contract value we need to compute. the TDS, but on the payments made to the supplier, on that only TDS should be computed. Supply of taxable goods to Delhi office of National Housing Bank, a society established by Government of India under Societies Registration Act. So here 6 lakh 49 definitely it exceeds 2 lakh 50. Now 50,000 rupees, 50,000 rupees, but location of supplier Delhi, place of supply also Delhi, ending point. So therefore intrastate 50,000 into 1% towards CGST, 1% towards SGST. So 500 and 500. Okay. Then the next one. The next one is interior decoration of Andhra Bhavan located in Delhi. Service contract is entered into with Government of Andhra Pradesh. 12 lakh 39,000 registered only in Andhra Pradesh. Now listen carefully. So location of supply is Delhi. Place of supply will be where? Delhi. But the recipient is located in the other state. So intra-state supply recipient located in the other state. TDS cannot be deducted. TDS cannot be deducted. Okay. Why TDS cannot be deducted? Because the recipient is located in another state. They are not registered in Delhi. So how they can pay 1% towards Delhi SGST? So due to that reason. Okay. Then supply of printed books and printed postcards to West Delhi Post Office out of the total contract value of 9 lakh 72. Contract value for supply of books is exempted 7 lakhs. And for supply of printed postcard taxable is 2 lakh 72,000. Now 2 lakh 72,000 only you take into 100 divided by 118, that is 2 lakh 30. So there is no TDS in this case. So point number 5 and 6 also there is no TDS. Understood? Then maintenance of street lights in municipal area of East Delhi. The maintenance contract entered involved with the municipal corporation also involves replacement of different lights, and the value of goods is not more than 25%. So this is services provided to government where the value of goods does not exceed 25% of the total value is exempted. So as it is exempted, there is no TDS that is applicable. Okay. So that is the answer for this question. Then question number 29. Miss Ditya has the following balances in her electronic cash ledger as on 20th February as per GST portal. The major heads CGST, SGST, minor heads tax, interest, penalty, SGST, tax. Her liability for the month of February for CGST, SGST was 75,000 each. Now, in case of SGST, 75,000 can be paid, but in case of CGST, 40,000 will be paid out of this, and 1,000 rupees interest also should be shifted, and 800 also can be shifted, and here 5,000 also will be shifted. So therefore 40,000 plus 1,000 plus 800 plus 5,000. So which means that 1,800. So 46,800 will be paid. 46,800 will be paid, and the remaining amount has to be paid through cash ledger. But here what happens, you see, she failed to pay the tax and contacted you as a legal advisor on 12th April to advise her as to how much amount of tax or interest she is required to pay, if any, by utilizing the available balance to the maximum extent possible as per GST law. She wants to pay tax on 20th April. Actually, which month liability it is? The liability of February. February liability to be discharged by when? 20th March. So 20th April means 1 month. So 1 month interest needs to be payable, that is 30 days. 30 days or 31 days. 20th March to 20th April. 21st March to 20th April, 31 days. So for 31 days you compute 75,000 into 18% into 31 divided by 365. That is 75,000 into 18% into 31 divided by 365. That is 1,146. 1,146.57, so 1,147. So therefore tax 75,000, interest 1,147, SGST, CGST. Now how much tax we have? So first balance in the electronic cash ledger we will adjust. So tax 40,000 we have, we will adjust. Interest 1,000 we have, we will adjust. And here 80,000 we have, and interest we don't have anything. Interest we don't have anything with respect to this. So interest is also there? No. So therefore the remaining amounts are payable. How the remaining amounts are payable? So that can be transferred from the cash ledger. Okay, that can be transferred from the cash ledger balances, and the remaining amount has to be paid through paid deposit. Then question number 30. With reference to the provisions relating to e-way bill, prescribed under GST law? Answer the following questions. Sindhi toys manufacturers, registered in Punjab, sold electronic toys to a retail seller in Gujarat at a value of 48,000 excluding GST. After adding GST, how much? 48,000 plus 18%. That is 56,640. Now it wants to send the consignment of such toys to retail seller in Gujarat. You are required to advise Sindhi toys on the following issues. Whether e-way bill is mandatory. Yes, it is mandatory. Who is required to generate e-way bill? Sindhi toys manufacturers, Gujarat. What will be the consequence for non-issuance of e-way bill? The goods transported are liable for confiscation. Okay. Then next, Power Electricals Limited, a registered supplier of air conditioners, is required to send from Mumbai, Maharashtra, a consignment of parts of air conditioner to be replaced under warranty at various clients' locations in Gujarat. The value of consignment declared in the delivery challan is 70,000. Power Electricals Limited claims that since movement of goods to Gujarat is caused due to reasons other than supply, e-way bill is not mandatory. No. So whenever there is a movement of goods under the cover of a delivery challan, e-way bill is required. So irrespective of the fact whether that is under supply or without supply or not. Okay. Then look into the next question, page number 51, question number 31. Divi Trader obtained permission for provisional assessment and supplied 3 consignments of furniture on 28th April 2018. The tax payment on provisional basis was made in respect of all the 3 consignments on 20th May. So 3 consignments provisional assessment is done. Consequent to the final assessment order passed by the Assistant Commissioner on 21st June, a tax of 1,20,000 and 1,50,000 became refundable on first and third consignments. So 1,20,000, 1,50,000 became refundable and 1,20,000 for second consignment became payable. Divi Trader applied for the refund of tax for first and second consignment on 12th July. So when are they making application? 12th July. And pays the tax due on second consignment. Now wait, tax was actually refunded of first consignment on 8th September. So 12th July they made an application for refund. So in July 12 days. So which means 19 days in July. Okay, 19 days in July. And then 1 second. 19 days in July. And in August 31 days, and in September 8 days. So 58 days. It does not exceed 60 days. So due to that reason, no interest. Whereas the third consignment on 18 September. So 18 September, again you count. So in July 31 minus 12. So 19 days in July, 31 days in August, 18 days in September. There is a delay by 8 days. For that 8 days, they need to get the interest. How much interest? 1,50,000 into 6% into 8 divided by 365. So 197.26. So that will be the interest that they should get. Don't include 12 July. Don't include 12 July. Exclude 12 July. Exclude 12 July. Date of application should be excluded. Okay. And then with respect to the second consignment, they need to pay. How much they need to pay? 1,20,000. So for that interest rate is what? 18% per annum. This is GST. 18% per annum. From when? From the date, from the first date after due date. Actually, what is the month for which this consignment is done? 28th April. Means 20th May is the due date. So from 21st May you count. 31 minus, so 20, that is 11 days in May, and June 30 days. So when are they making payment? So second consignment on the same day, that is 12th July. 12th July. Okay. So in May 11 days, June 30 days, and in July 12 days. For 53 days we need to compute. For 53 days we need to compute on how much? 1,20,000. 1,20,000 into 18% into 53 divided by 365. So 3,136.44. So that will be taken as the interest. Okay. So previous question part 3 I did not do. What is that part 3? Sorry, I missed this part 3. So please see this. Beauty Cosmetics Limited has multiple wholesale outlets of cosmetic products in Mumbai, Maharashtra. It receives an order for cosmetics worth rupees 1,20,000 inclusive of GST, leviable at 18% from Prasanna, owner of retail cosmetics store in Delhi. While checking the stock, it is found that the order worth rupees 55,000 can be fulfilled from the company's Dadar Mumbai store, and remaining goods worth rupees 65,000 can be sent from Malad Mumbai store. both the stores are instructed to issue separate invoice. Then we need to see that separately. So for the first one and the second one, two separate EVA bills are required. Two separate EVA bills are required. Okay. So beauty cosmetics would be required to prepare two separate EVA bills. So each invoice value exceed 50,000 na. So that's why two separate EVA bills is required in this case. Okay. Then question number 32. So we'll take a small break here. Just a 5 minutes break. So water break. I'll just consume some water. A 5 minutes break we will take and then we will continue. Okay. Okay, welcome back. See this question, question number 32. Pursuant to audit conducted by the tax authorities under section 65, a show cause notice was issued to Home Furnishers, Surat, a registered supplier, alleging that it had wrongly availed the input tax credit without actually receipt of goods for the month of July. In the absence of a satisfactory reply from the Home Furnishers, Joint Commission of Central Tax passed an adjudication order dated 20th August, received by Home Furnishers on 22nd August, confirming a tax demand of 50 lakhs, CGST 25 lakhs and SGST 25 lakhs, and imposing a penalty of equal amount under 122, that is 122 subsection 1. Home Furnishers does not agree with the order passed by the Joint Commissioner. It decides to file an appeal with the appellate authority against the said adjudication order. It has approached you seeking advice on the following issues. Can Home Furnishers file an appeal to appellate authority against the adjudication order passed by the Joint Commissioner? Yes, they can go to the appellate authority. So who passed the order? The order is passed by Joint Commissioner. Then the appeal will be made to Commissioner Appeals. If yes, till what is the date? So it is a date 3 months plus 1 month condonation of delay. Correct? So 3 months plus 1 month condonation of delay. So should be taken. Okay. So it is a date of communication. So that is 22nd August is the date of communication. So from there within 3 months plus there is a 1 month condonation of delay. Does Home Furnishers need to approach both central and state appellate authorities? No. So there is a cross empowerment. If they are filing with one appellate authority, that is sufficient. GST law make provision for cross empowerment. So any one officer, that will be sufficient. And then number 3, Home Furnishers is of the view that there is no requirement of paying pre-deposit of any kind before filing an appeal with the appellate authority. Give your opinion. No, they have to pay pre-deposit. How much pre-deposit they need to pay? So that is 10% of the disputed tax. Assuming that everything is disputed, so therefore, 10% of that, 50 lakhs into 10%, 5 lakhs. That is CGST 2 lakh 50, SGST 2 lakh 50, they need to pay as pre-deposit. Understood here? So this is the question related to appeals. Then looking to question number 33, answer the following questions. Radhaswamy owns and supplies certain goods costing 30 lakhs in a conveyance hired from money current transporters. Market value of the said goods is 40 lakhs and the tax chargeable thereon is 4 lakh 80,000. The goods supplied by Radhaswamy and the conveyance owned by money current used for carriage of the goods are confiscated since Radhaswamy has supplied said goods in contravention of the provisions with an intent to evade. So contravention, so because of that confiscation order is passed, confiscation is done. Now the question is, how much is the redemption fine payable for release of the goods, for release of the conveyance? What is the redemption fine that is payable for release of the goods? So maximum redemption fine will be market value of the goods as reduced by tax chargeable thereon. What is the market value of the goods? The market value of goods is 40 lakhs minus tax chargeable thereon 4 lakh 80,000. So therefore the redemption fine of 35 lakh 20,000 needs to be levied as the maximum redemption fine. And what is the redemption fine for release of the conveyance? So that is whatever is the GST payable on the goods transported thereon, that is 4 lakh 80,000 will be taken as the maximum redemption fine. Okay. Then next question. Raghuram is a registered supplier in Madhya Pradesh. He failed to pay the GST amount to 7,400 for the month of January. The proper officer imposed a penalty on Raghuraman for failure to pay the tax. Raghuraman believes that it is a minor breach. What is a minor breach? Less than 5,000 is only a minor breach. This is not a minor breach. So therefore, penalty shall be imposed in this case. In order to become minor breach, it should be less than 5,000. So in this case, the amount is 7,400, not a minor breach. So penalty cannot be waived as per section 126. Then question number 34. From the following details, see these are the questions on the other topics. So other than input tax rate, etc. So these are the questions that are capable of coming in the exam. Okay. From the following details, calculate the amount to be paid for release of goods. For release of goods detained or seized under section 129 of the CGST Act if the owner of the goods does not come forward for payment of applicable tax and penalty. See, if the owner is coming forward, if the owner is not coming forward, like the two provisions are there under section 129. If the owner is not coming forward, first look into the question. So value of the goods 30 lakhs, applicable GST on such goods 5 lakh 40, GST already paid is 3 lakh 60. So what is that we need to do? If the owner is not coming forward, 50% of the value of goods as reduced by GST paid thereon. What is the 50% of the value of goods? So value of goods is 30 lakhs into 50%. So that is 15 lakhs minus GST paid how much? 3 lakh 60,000. 3 lakh 60,000. So that will be taken. Okay. So 15 lakhs minus 3 lakh 60,000. That is the penalty. And what is the tax payable? 100% of the tax payable. Okay. That is 5 lakh 40,000 plus 50% of the value minus tax paid. 16 lakh 80,000 is the amount payable. But there is another view also. For exam, you need to take, there is an alternative view also. So for that alternative view is that we will take 50% of the value of the goods and tax payable 5 lakh 40 minus 3 lakh 60. Anyway, you can take, but actually this is the correct one that you need to follow. Okay. So whatever I have given is correct. So this is not required. View 1, view 2. So like that, don't get confused. 50% of the value of goods minus tax paid thereon. You remember that. Suppose if tax paid information is given, you take that. Okay. What would be your answer if the goods are exempted? So this view 1, view 2 not required, remove, because that is because of the interpretation issue, remove that. And what if it is exempted goods? If it is exempted goods, 5% of the value subject to maximum 25,000. So what is the value of the goods? 30 lakhs into 5%. So maximum 25,000 rupees that will be taken. Okay. Then what if the owner is not coming forward? If the owner is not coming forward, we have taken. What if owner is coming forward? If the owner is coming forward, so then the penalty will be 100% of the tax payable. That is 5 lakh 40,000. 5 lakh 40,000. So 5 lakh 40 plus 5 lakh 40, that is 10 lakh 80,000 is the amount payable. Okay. Now, so one student has asked me that, sir, in ICI material, so there is a different provision that is given for this. See, actually that is because of the amendment here. I'll just show you that, because you also might have this doubt related to this. So study material, this penalties, offenses and penalties, if you see, so here they gave section 130, 129, okay. So 129, if you see the penalty, when the owner of goods come forward, and 100% of the tax when the owner of goods not come forward, penalty equals to 50% of the value of goods reduced by tax amount paid thereon. So this is only given, okay. But there is an amendment in this place. That amendment they gave it in the last, okay. That is for November 22 exam. So here one amendment they have given, but it is yet to be notified. That is up to your exam it was not notified. So this is for November 22 exam only, not applicable for you. So don't get worried. So therefore, you just refer to whatever information I have given, that is sufficient. Okay. Then question number 35. Examine whether offences committed in each of the following independent cases are bailable. So bailability of the offences we are going to discuss. Further determining the quantum of punishment on prosecution, that is imprisonment under CGST Act in each of the following cases. First, Homi Gaba collects 240 lakhs as tax from its clients and deposits 150 lakhs. So 240 minus 150, how much? 90 lakhs. With the central government, balance amount of tax is not paid to the central government. It is found that he falsified financial records. So collects 240 lakhs as tax. This is collected amount as tax and not paid. So what will be the imprisonment? Imprisonment will not be applicable in this case because the amount involved should be more than 1 crore. And here the amount involved does not exceed 1 crore. So there is no imprisonment in this case. Because if you see the imprisonment starts only greater than 1 crore. That is 125, 135, 125, 135. Okay. So more than 1 crore. Here it is not more than 1 crore. Okay. It is found that he has falsified the financial records. In case of BOT, if you commit BOT, books of accounts default, obstructing an officer from doing duty, tampering material evidence, then in that case, up to 6 months or fine or both. So therefore, for the first time, it is up to 6 months or fine or both that will be taken. If it is subsequently up to 5 years plus fine, okay, that will be taken as the imprisonment. And these offense will not lead to cognizance of offenses, okay. So that is what we need to write. And next, number 2. Datukeshwar Dutt collects 630 lakhs as tax. Amount collected as tax, but deposits only 120. So more than 5 crores. And more than 5 crores means collected amount as tax and not paid. And more than 5 crores. So it is a cognizable plus non-bailable offense. And the imprisonment will be up to 5 years plus fine. Even subsequent imprisonment also up to 5 years plus fine. So it is a cognizable plus non-bailable offense. Okay. And the imprisonment is up to 5 years plus fine. Understood or not yet? And so this is about that. Okay. What would be implications in the above case? Homi govern that case where that repeat the offences. That's what I told you. 5 years plus fine will be taken. So this is purely on the imprisonment provision and bailability. Okay. Then question number 36. This is related to advance ruling. See this. Ranjan intends to start selling certain goods in Delhi. However, he is not able to determine the classification of the goods proposed to be supplied by him. For classification, can he go for advance ruling? Yes. Place of supply? No, he cannot go for advance ruling. Ranjan's tax advisor advised him to apply for advance ruling in respect of these issues. He told Ranjan that the advance ruling would bring him certainty and transparency in respect of the said issues and would avoid litigation later. Ranjan agreed with this view but has some apprehensions. In view of the information given above, you are required to advise Ranjan with respect to the following. The tax advisor asked Ranjan to get registered under GST law before applying for advance ruling, as only a registered person can apply for the same. No, registration is not required for applying for advance ruling. Even an unregistered person also can make an application for advance ruling. Okay. Can Ranjan seek advance ruling to determine classification? Yes. Place of supply? No. Ranjan is apprehensive that if at all advance ruling is permitted to be sought, he has to seek it every year. Not required. So till the time there is no change in the law, the advance ruling will be valid. If there is any change in the law, so the amendment in the law, then only advance ruling will be not valid and we need to again get a new advance ruling. And then the tax advisor is of the view that the order of authority for advance ruling is final, not appealable. No, on that we can go for appeal to appellate authority for advance ruling. Shambhav, Ranjan's friend is a supplier registered in Delhi. He is engaged in supply of goods which Ranjan proposes to supply at the same commercial level. But Shambhav cannot rely on the advance ruling that is given to Ranjan, because whenever advance ruling is given, that will be binding only on the applicant and the department, but any other person cannot rely on this advance ruling. So they need to make separate application for advance ruling. Then look into the next question, question number 37. Seema has self-assessed GST on service rendered by her and declared it in the return. She has paid 80% of the self-assessed tax, and for want of liquidity, the balance 20% has remained unpaid for more than a year. The officer has proceeded to recover the unpaid portion of the self-assessed tax by invoking the provisions of section 79. Seema argues that she would have been issued show cause notice. Invoking 79 to recover the unpaid portion of the tax is an action beyond his jurisdiction. False. See, whenever there is a self-assessed tax, that self-assessed tax can be directly recovered and there is no need of issuance of any notice. So in this case, notice is not required, so they can initiate the recovery for the 20%. Okay. And interest is payable. However, penalty will be levied and that penalty will be general penalty. Okay. That penalty will be general penalty that is payable in this case. How much is the general penalty? Section 125 up to 25,000 will be payable. Okay. Now, look into the next one. This is the answer for that. Suppose if section 73 is given. Suppose if section 73 is given. Mr. Anand Kumar Gupta self-assessed his tax liability 90,000 but failed to make payment. Subsequently, department initiated penalty under 73. Now, in this case, so penalty under 73 will come. See, when they give, in the invoke show cause notice under 73, then the penalty will come. That is, 10% of the amount that we or 10,000, whichever is higher. What is the tax? 90,000. So 90,000 into 10%, which will be 9,000 or 10,000 rupees, whichever is higher. So will be taken. So the penalty will be 10,000. Okay. So assuming that this 90,000 is the CGST liability. Failure to pay GST and issue show cause notice which was received. Mr. Anand Kumar Gupta deposited the tax along with interest on 25. Actually, notice is served on 14/8. He paid on 25/8. Within 30 days from notice he paid. So in that case, will there be any waiver of penalty? No, that is not applicable in this case. For self-assessed tax, payment of self-assessed tax within 30 days from show cause notice will not lead to any waiver of penalty. We need to definitely pay that penalty. Understood? We need to definitely pay that penalty and there is no waiver in this case. You understood? So for the first case, you should not write penalty under 73. That is general penalty. For the second case, only you need to write penalty under section 73, 10% of the tax. Please go through the answer I have given there. So because of the CBSE circular, so in the first case, whenever section 79 is invoked, so we will not get penalty under 73. Okay. Then this is a question related to refunds. Look into that question number 38. Kailash Global Private Limited supplies various goods in the domestic and international market. It is engaged in both manufacturing and trading of goods. The company is registered under GST in the state of Karnataka. The company export goods without payment of tax under LUT, which means that as per company's policy, they are going for refund of unutilized ITC. Okay, the company has made the following supplies during a tax period. Export of product A to UK, $10,000, assessable value under customs in Indian rupees. Export duty is levied. When export is subject to export duty, we can claim refund only under export upon payment of IGST. But as a company's policy, they don't want to pay tax, which means refund not possible in this case. Refund not possible in this case. Can't they get refund of unutilized ITC? No. Because refund of unutilized ITC, we have a restriction. When exports are subject to export duty, we will not get refund of unutilized ITC. Only one option, export on payment of IGST. But here the company policy is that they don't want to go for that refund upon payment of IGST. So therefore, no refund in this case. Then second, domestic supplies of taxable product B during the period, excluding tax at 5%. So inputs used in manufacturing such goods are taxable at 18%. Inverted tax structure. So the tax rate on outward supply is less than the tax rate on inward supply. So this is an inverted tax structure and these goods should not be notified for non-applicability of refund. And it is not notified. So therefore they will get refund. Refund possible. Refund possible. But this refund is on account of what? Refund on account of inverted tax structure. Inverted tax structure. Then supply of goods to EOU. ITC has been claimed by the recipient. Means what? So whenever we supply to EOU, that is a deemed export, we have two options. We can recover the GST from the recipient or we cannot recover GST from the recipient. If we recover GST from the recipient, that is a normal sale for us. And in this case, we recover GST. Otherwise, how ITC can be availed? So this is like a normal sale. Refund not possible in this case. And export of exempt supplies. Export of exempt supplies will become zero rated, so refund possible. Only in the two cases refund is possible, that is in case of 2 and 4. 2 case it is inverted tax structure, 4 case it will be refund of unutilized ITC on account of zero rated. And we have the inputs data, input services and capital goods data. Now determine the maximum amount of refund admissible to Kailash Global. First we will see inverted tax structure, how much will be the refund. First take net ITC. What is the net ITC? Net ITC will be only with respect to inputs, not with respect to input services. So 3,50,000. Sir, but 50,000 is for export of exempted supplies. The day when you export exempted goods, it will become zero rated. So you can enjoy the ITC. So take entire 3,50,000 net ITC. Total ITC availed on inputs procured during the month into inverted turnover. Out of this, how much pertains to inverted turnover? 10 lakhs. 10 lakhs is the inverted turnover. What is the adjusted total turnover? So please do the adjusted total turnover. 7 lakhs plus 10 lakhs plus 5 lakhs plus 6 lakhs, that is 28 lakhs is the adjusted total turnover. So take 28 lakhs. So into 10 divided by 28. So 3,50,000 into 10 divided by 28, that will be 1,25,000. This much is pertaining to inverted turnover. Out of that, how much GST you are paying on inverted turnover? Inverted turnover 10 lakhs, 10 lakhs into 5%. So that will be what? 50,000 minus 50,000 you pay. So how much it will be? 3,50,000 into 10 by 20, 1,25,000. 1,25,000 minus 50,000, that will be 75,000 will be taken as the refund. Okay, 75,000 will be taken as the refund in this case. In which case, refund on account of inverted tax structure. Now, that is, first we need to take how much is the refund attributable to inverted turnover. From that, how much is the GST payable on inverted turnover? If you take out, the remaining 75,000 will be taken. Okay. Then, next one is like, suppose if it is zero rated, how to compute zero rated? Net ITC. How much will be the net ITC? 3,50,000 plus input service also will be taken here, but input services excluding blocked credits. So 18,000 outdoor catering blocked credit. So 2 lakhs minus 18,000, that will be 1,82,000. So 3,50,000 plus 1,82,000 you take into how much is the zero rated turnover? 6 lakhs. But zero rated turnover, why can't we take the 7 lakhs also? Because that is export without payment of IGST. Then only it will be coming. So, but in this case, it will not come because we are not claiming any refund there. And whenever we are making exports, we need to compare with 1.5 times the value of domestic supplies. But we don't have that information. So, directly we are taking 6 divided by total. That is 28. 28. So 28. So first case 3,50,000 into 10 by 28 only. No. Yes, correct. So 3,50,000 plus 1,82,000 into 6 divided by 28. So 1,14,000 we will get as a refund. Okay. But refund is subject to balance. If you have that much of balance, you will get refund. So 75,000 plus 1,14,000 you will get as a refund. So this is a very good question, combining both refunds. Combining both refunds, and again deemed exports also we need to touch here. Okay. Then the next area, question number 39, that is also related to refunds, but this refunds is on account of inverted tax structure. Have a look into that. Super engineering works. A registered supplier in Haryana is engaged in supply of taxable goods within the state. Given below are the details of turnover and applicable GST rates of the final product manufactured by super engineering works, as also the input tax credit availed on inputs used in manufacture of each of the final products and GST rate applicable on the same during the tax period. There are 3 products. Product ABC. Turnover is there, GST rate is there, ITC availed is there, input tax is there. Now, one product is notified for no refund. What is that? Product B is notified. So then no refund in this case. Okay, leave it. Then product C not inverted, because rate of GST on outward and rate of GST on inward will be same, not inverted. But product A will be inverted because the rate of GST on outward is less than the rate of GST on inward. So therefore that is inverted. So now don't do calculation only for product A, not like that. First net ITC. When you take net ITC, take all 3. When you take net ITC, take all 3. That's why I gave this question. So when you take net ITC, not for product A alone, take the net ITC all. So that is 54,000 plus 10,000. So therefore net ITC you take 1,18,000. When you take 1,18,000, then out of this 1,18,000, how much is attributable to inverted turnover? How much is attributable to inverted turnover? 5 divided by total. 5 divided by how much? 9.5. 5 divided by 9.5. So 1,18,000 into that 5 lakhs divided by 9,50,000, that will be 62,105. 62,105 minus how much GST we pay on inverted turnover. So that is 5 lakhs into 5%, 25,000. So the balance we will get as a refund. Okay. So minus 62,105 minus 25,000. So we will get 37,105. Okay. So that is how we need to take. So how much we got? 37,105. Understood or not? See, what is the mistake that we do in this is that we take only for A inverted, means A alone we will take. No. Total ITC. Total ITC. Net ITC means total ITC into how much is that attributable to inverted turnover divided by total turnover minus on inverted turnover how much GST we are paying. That is the formula prescribed. So as per that formula only we need to do the computation. Okay. Then question number 40. This question number 40 is related to that exempted turnover, taxable turnover, that computation and ITC. Okay. So this question you take for practice here. This Skylar question is there, na? That question you take for practice. You can try that. You will be able to get that question. Okay. And the next question, that is we need to just bifurcate that. So whether it is supply of goods or supply of services, and we need to compute the liability, nothing else in that. Okay. So you can try, only the question seems to be big, but you can do that. Then look into the next one. Question number 41. Sukhdev is a mining engineer. He has crossed the threshold limit for registration under the GST law and is duly registered in the state of Maharashtra. He effects the following transactions in the month of March 2019 and wants you to compute the tax payable in cash. He has filed a bond or LUT to claim benefits from zero rated supplies. The following are the particulars furnished by him. Sukhdev, being an operating member in the mining and exploration services at Mumbai High, has provided certain services to the joint venture in which he is also a participant. He believes that consideration received from the JV is cost petroleum and not taxable. Okay. Is it a contract with government? No. Only when it is a contract with government, the cost petroleum is exempted. This is not a contract with government, so therefore it will be taxable. Whereas, if you see point number E, he gets a portion of the petroleum silt as a part of compensation while exploring the petroleum reserves in the Bombay High, which as per the contract with the government is a part of cost petroleum. So only when it is a contract with government, that is cost petroleum, that is exempted. Okay. So but whenever it is not a contract with government, that is not called as cost petroleum, therefore it will be taxable. So the first one will be taxable and the 6 lakhs will be exempted. So the 12 lakhs will be taxable and 6 lakhs will be exempted. And in case of this 12 lakhs also, where is he located? So he is located in Maharashtra. And whatever is the money that he is getting is also from Maharashtra. So therefore it will be coming in intrastate supply. Okay. Then the second one, he has purchased certain machinery from outside the state to render the services to joint venture at Mumbai. So this is procurement. So on that procurement, so GST paid, that can be taken as ITC. Okay. So inward supply. So he procured one machinery. He has purchased certain machinery to render service to joint venture. Then he has obtained legal opinion from a local firm. That is also inward supply. He has obtained accommodation from the state government. That is also inward supply. Now he sells the petroleum silt to SEZ developer in Mumbai. So that is deemed interstate supply. The 6,80,000 will be deemed interstate supply. Okay. And what is happening is that that says zero rated supply also. And wherever there is zero rated supplies, they are filing a bond or LUT. Means it is without payment of GST. It's a deemed interstate supply and without payment of GST. So therefore it will be nil. Consideration received towards transfer of tenancy rights, which according to Sukhdev is not liable to GST. No. So the tenancy rate will be taxable. Whenever he gets a tenancy rate, that will be taxable. So that 8 lakhs will be taxable, CGST, SGST. Okay. Then next, on violation of the terms in production sharing agreement, Sukhdev has paid liquidated damages to government. So this is amount paid to government, not received by the Sukhdev, paid to government. So that will come under inward supplies. He has been assigned the right to collection royalty. So excess royalty collection contractor, he noticed that the mining leaseholders have short paid 2 lakhs. So as IGST from what has been exempted to him under the assignment, then that he need to pay. Okay. So that he need to pay with respect to that excess royalty collection contractor. Okay. So whatever is that amount, Assignment of right to collect royalty, the 2 lakhs. The 2 lakhs he need to pay. Understood here? So under RCM. Then next, he has sold self-fabricated machinery through his agent in Mumbai that has been used for 2 years, the value of which is not available in the open market through his agent. The agent sells it immediately to unrelated customer 10 lakhs. So we will take 10 lakhs into 90%, 9 lakhs. So 9 lakhs on which GST payable. This is the GST payable on outward supplies, okay. Then on inward supplies we will see. For example, first on legal services you need to pay GST under RCM. So that should be taken like that. So what I gave you is that first outward supplies, then GST payable on inward supplies, okay. That is this year. Then computation of net GST liability. So you go through this question, arrive at the answer and then cross check with the answer, okay. Then question number 42. Last question, have a look into this. This is an MCQ based question. ABC Petroleum Limited is engaged in the business of refining and marketing of petroleum products. It has one refinery in each of the states of Tamil Nadu, West Bengal and Maharashtra, and numerous administrative and marketing offices spread across the country. The company has a separate marketing cum administrative offices for every major state and common administrative cum marketing offices for a group of small states. Example, all northeastern states are covered under one marketing cum administrative office. The company also blends lubricants in its blending plants located in the state of Maharashtra and Tamil Nadu. As a policy, all the place of business of the company in a state are registered under one registration. So all the place of business are registered under one registration. Imported crude is used as input in refinery and the following major products are extracted. Group A products are chargeable to GST. Group B products are not chargeable to GST. Okay. Now base oils are further sent to the blending plants where they are blended with additives to produce lubricants. So they gave the following data. Now first, the value of company's supply in the Union Territory of Puducherry is 32,34,000 Group A taxable goods, and in the state of Goa is 18,38,000. So 32,34,000, 18,38,000. So they are engaged only in supply of goods. What will be the applicable threshold limit? Suppose if one of the state is a MMTN use stamp, the applicable threshold limit will be 20 lakhs. So now they need to register in Puducherry as well as Goa. So required to get registered both in Puducherry and Goa. Option C is the answer. Okay. Then what is the applicable threshold limit for them? The applicable threshold limit is 20 lakhs. The applicable threshold limit is 20 lakhs. Then the next question you see. The eligible ITC available at the marketing cum administrative office located in the state of Maharashtra. First, marketing cum administrative office. Marketing cum administrative office located in Maharashtra. Okay. So what is it they are asking? What is the eligible ITC? First, what is the ITC 3? That is rupees in thousands. Rupees in thousands, 3,000. Okay. So first ITC availed 3,000. ITC availed 3,000. So but 3,000 will not be the answer. Minus ITC reversed. How much is the ITC reversed? So therefore 3,000 into exempted to total. What is the exempted turnover in Maharashtra? Maharashtra exempted is Group B. Group B is exempted products. So value of supply Group B 3,400. But be careful, don't take 3,400. That includes all taxes and duties. In input tax credit chapter, while computing turnover, we need to exclude the old indirect taxes. So take out excise duty and take out VAT. So 3,400 minus 1,600, that will be 1,800. Group A will be 200. So the exempted supplies will be 1,800 divided by 2,000 should be taken. How? 1,800 plus 200, 2,000. So therefore 3,000 into 1,800 divided by 2,000, that will be 2,700. So 3,000 minus 2,700, the net eligible ITC will be 300. Option B will be taken as the answer. Again I am repeating, while calculating the turnover under input tax credit. So this I have given in the last page turnover, you can see. Okay. in all the turnover computations I gave you. So what is that I told you? That is, see here, while computing the input tax credit, old indirect taxes, the old indirect taxes should not be taken. So that's why we are excluding that old indirect taxes here. Whatever is the old indirect taxes, excise duty and VAT, that is excluded. So that's where we arrive at the value. Okay. Then the eligible ITC in respect of capital asset procured in the state of Tamil Nadu. So in the Tamil Nadu, how much capital asset is procured? 12. 12. Only one. That is 12. So therefore ITC availed. ITC availed. This is capital goods. When it is capital goods, so what you need to do? So minus ITC reverse. Minus ITC reverse. Common ITC divided by 60 months. So 12,000 divided by 60. Because the life of the capital goods is taken as 60, if there is no information given, into exempted by total. Again, Tamil Nadu, what is exempted? 1650 minus excise duty minus what? So 1650 minus, so 750, so that will be 1650 minus 750, that will be 900. So exempted is 900 divided by total. Total is how much? 900 plus 100, 1000. So therefore, what we need to do? 12,000 divided by 60 monthly ITC into 900 divided by 1000. So that will be 180. 180 rupees we need to reduce. So the remaining 180 minus 12,000. So that is 11,820. Option D will be taken as the answer, because this is rule 43. Capital goods. In case of capital goods, what we need to do? So ITC reverse will be total common ITC divided by 60 months into exempted divided by total. Okay. Then next, number 4. Lubricant valued at 10,000 has been stock transferred from the blending plant located in the state of Tamil Nadu to refinery located in the same state. Now listen carefully. So there is one point which they gave. Actually, within each state, the company has a policy that they will not take more than one registration within the state, which means, first of all, this is not a supply. When they are sending it within the state, it is not a supply. So therefore, the transaction is nil, as it is not treated as supply. Okay. Then point number 5. Due to sudden fire in the storeroom of the refinery located in Maharashtra on January 28, the entire quantity of this spares procured in the month of January gets destroyed. What action is required from ABC? So same month they procured, same month it got destroyed. So they should not take ITC. Okay, they should not avail ITC. Suppose in this month they procured, next month destroyed, take ITC this month, next month it will be reversed. Simple. So with this, the mighty 50 questions are over, including one integrated case study. Okay, so let me rectify the small corrections which needs to be done. So that I will do it, and I will share that with you in the Telegram group. So please join my Telegram channel, and also please subscribe to this YouTube channel. I will be posting lot of videos related to GST till the time you go for exams. So tomorrow I will be posting amendments, and thereafter even solved workbook revision is there. So that solved workbook revision also I will be doing parallelly. So therefore, you please subscribe to this and also join my Telegram channel. So a lot of updates I will be giving to you. Okay, in the Telegram channel I will upload this, and even the Google Drive link, whatever you have, I will correct it, and I will upload this mighty 50 question and one question which got repeated in customs. I will add one more question, you try that. Okay, that is with respect to this. And thank you for having patience. Actually, I thought of completing it in 3 days, but it took 4 days, but I feel it is worth it. And so thank you all, and I will be in touch with you. Whatever is your doubts, from tomorrow I'll be all yours. I'll be clarifying all your doubts, and I'll be available. Okay, so solved workbook, I think I don't think so. You check with our office, if it is available they will be able to send. Okay, thank you all, thank you all, take care.